it's just, antitrust risk is similar. I mean, really? The board leaves non-material evidence?
Either of these deals can get done. Both of these deals will have to fight their way through the DOJ. And so, as is always the case, I was on the AT&T board when AT&T did the deal with Discovery.
To acquire Warner.
Yeah. And we're going to see a familiar face in that process. Each of these deals will have their challenges, but merging studios, merging streamers, they all have issues, but we think they're both highly likely to get.
You do. Both highly likely.
We just highly likely.
By what might be the president's potential opposition to Warner?
I'm not gonna go there. I mean, I have enormous respect for President Trump, and
He's not going there.
Following the precedent, we think either of these deals will get done. I think introducing CFIUS and FCC in the Paramount deal, which they did for a while, and then they began to move away from it.
Yes.
That only complicated it. Netflix is clean, direct path to closure, and it's highly cash. It's a great company. They will let us operate. They'll let us spend the Discovery Global. It was a compelling offer.
When are you gonna have a shareholder vote to tell us about?
We haven't set the date. We want to get through these issues first, but it'll be in the spring sometime.
In the spring.
Spring or early summer, but it'll be as soon as we can get to
You're
it.
going to be getting a sense from your shareholders prior to that as to how they're going to vote.
Yeah, and we hear from our shareholders. And our shareholders are very pleased that we're representing them. We're not representing anything else. And so they're very encouraged by the fact of what we've done to this point. They want to see us to have a deal that brings them value, considers risk and cost, and can get closed.
Right. No, understood. It comes back to where we started. Sam, certainly appreciate you taking the time here. Obviously, we'll be following this closely, perhaps speak again prior to that yet-to-be-set shareholder vote.
Happy to do it.
Sam DiPiazza, the chairman of Warner Brothers Discovery. Becky, send it back to you. By the way, we do have Greg Peters joining us. About 20 minutes or so from now, I believe.
David, that was
great.
so interesting. So many things to think about, like what this means. And the part about the bridge loan and leaving something to be lacking there, that was not something I understood. That's a really interesting point. And all of that obviously is going to play into this. Thank you.
You're welcome. No,
Thank you.
Absolutely.
And we will see you again in just about 20 minutes' time for that next interview with Greg Peters. By the way, we have another headliner coming up in between that. House Speaker Mike Johnson is going to be joining us ahead of a vote on the GOP's health care bill. We'll also get into the affordability issue and more. That's coming up at 8 a.m. Eastern Time. Squawk Box will be right back.
House Speaker Mike Johnson and Fed Governor Chris Waller. We got a lot going on this morning between that and Warner Brothers Discovery and the CEO of Netflix in just a little bit. Don't go anywhere.
Time now for today's Aflac trivia question. Which is the only Sesame Street character to have a star on the Hollywood Walk of Fame? The answer when Squawk Box returns. And now the answer to today's Aflac trivia question. Which is the only Sesame Street character to have a star on the Hollywood Walk of Fame? The answer, Big Bird.
All right, welcome back to Squawk Box. I'm Dominic here with a check on your morning movers. We're going to start with shares of Lennar, currently the worst pre-market performer in the S&P 500 this morning after it missed on its fourth quarter earnings report last night. It also gave weak current quarter guidance for deliveries, more than 2,000 units below analyst consensus estimates. The home builder also missed estimates on new unit orders, and its backlog. CEO Stuart Miller cited macro pressures in those results, saying that even as interest rates moved slightly lower in the quarter, the overall market remained challenged. Those Lennar shares down 4.5%. Meantime, Sweet Green is moving to the downside by 2.5% this morning after it was downgraded to an equal weight rating from an overweight again this morning for some of these things in terms of an analyst call there. So keep an eye on Sweet Greens as well in this particular move. And then we'll end with a check as well on another analyst move here in Robinhood Markets. So Robinhood Markets moving about 1.25% to the upside as well. So keep an eye on that with regard to some of these analyst actions coming out here. Now for that and other calls of the day, just head over to cnbc.com/pro where subscribers get all the access to detail around those big calls, guys. I'll send things back over to you.
Okay, Dom, thank you for that. We got a lot more coming up on Squawk this morning. There's so much going on. We've got Netflix's co-CEO, Greg Peters. He's going to be our special guest in just a moment. as Warner Brothers Discovery telling shareholders this morning to reject Paramount's offer and stick with the streaming giant. Plus, House Speaker Mike Johnson's going to be with us. We'll talk to him about the GOP healthcare bill, which is expected to be voted on today. That's happening at 8 a.m. Eastern Time. Our own Steve Leisman is going to be sitting down with Fed Governor and Central Bank Chairman candidate Christopher Waller at the Yale CEO Summit today before he has his own interview with the White House. Squawk Box coming right back after this.
Welcome back, everybody. We've been talking this morning about the new filing coming from Warner Brothers Discovery. It put out its reasonings this morning in an SEC filing for why it thinks Netflix was the better deal, why it went with that offer over the Paramount Skydance offer. David Faber was here with Samuel DiPiazza just a little bit ago. He's the chairman of the board at Warner Brothers Discovery, laying out his argument for why the board thought this was a better deal. In part, they said it was because of the financing that's out there, not having a personal guarantee from the Paramount Skydance offer coming from Larry Ellison, coming from a trust instead. He basically, though, said that this is going to be up to the shareholders and they're going to be making their case to the shareholders. I reached out to Mario Gabelli, who is a shareholder in Warner Brothers Discovery, to get his take on this. About a week ago, he was saying he was leaning towards the Paramount Skydance offer. He had listened to Paramount Skydance at a UBS conference and basically said it sounded like it was more money. It sounded like it was cash up front. Well, I just called him to see what he thought about Warner Brothers' latest. He said he hasn't read through the filing, he isn't familiar with the details on some of those things. Said at this point he's still waiting to see what happens, but he said basically the most important part is to keep it in play, meaning they want to see more back and forth from Netflix. I think he has said he would like to see Paramount Skydance raise their offer as well, but he's looking at all parts of this. He looks at the idea would be to give Netflix a higher cash part of that offer. That's what he'd like to maybe see, eliminate the collar on the stock that exists with that. But from the shareholders' perspective, at least Mario Gabelli, whose firm owns about 5.7 million shares of Warner Brothers, which was valued at about $160 million, he basically liked just to see more from all sides on this. And that's how somebody like Mario is kind of playing this.
Right.
They want to keep it in play, they want to see more, see what's to come on these things.
The only thing I was going to mention that to me is so interesting about this is that ultimately this thing will get decided by shareholders simply probably on just dollars and
Yeah,
cents.
and that's kind of what Mario's take on all of this is. We'll see. He's not making any comment about
he
where
just
he
wants the most money, but he's not.
Show me the money.
But it's not a story about who's the best steward for the asset or anything else like that.
Not for somebody like Mario.
Not for somebody like Mario.
Mario also owns shares in both Netflix and Paramount Skydance. So an interesting play to see some of the media investors who are involved with this, which is
Well, that's
what
the
you said
interesting
too, is they think there's more coming, and that's what.
Well, they all think there's more coming, but it's interesting because I wonder whether he would ever say, given that he owns these other assets, that they're paying too much. And what, again, the other piece you don't know is, does he own a little bit of Paramount and a little bit of Netflix and a lot of Warner Brothers Discovery because he's making, so.
About 5.7 million shares of Warner Brothers Discovery. I don't know what he owns on both Netflix and Paramount.
But, right, if he owned a lot of Netflix, for example, and he didn't own these, it might be a different situation. So you got to always figure out
But the soap opera
what
continues.
the true incentives
And in
are.
fact, Netflix co-CEO Greg Peters will be joining us with David Faber in just a few minutes. Pretty interesting news flow on all of this, and we'll have more from him coming up in just a little bit. In the meantime, John Ford is here, and he joins us with some merger news as well. Good morning, John.
Morning, Becky. Yeah, ed tech platforms, major education technology platforms, Coursera and Udemy, announcing they have agreed to merge in an all-stock transaction expected to close in the second half of 2026. If that deal does close, Coursera CEO Greg Hart will continue as CEO of the combined company, and he joins us now first on CNBC interview to discuss. Greg, welcome. So tell me, this is big. You guys and Udemy are two very big public names in this space. The stocks have suffered since 2021, but you in particular, Coursera, continue to grow across your universities, business with degrees, the consumer, and the enterprise. What's the rationale for combining?
Well, I think the rationale is pretty straightforward. The world has never needed the ability to skill and upskill more than it needs it today. The World Economic Forum forecasts that 39% of skills are going to need to change by 2030. That is a staggering amount of skill change. And this combination gives us an amazing ability to meet that need. So it unites our consumer business, which we're strong in, as you mentioned, with Udemy's enterprise strengths, creates a comprehensive ecosystem of expert instructors from leading universities, companies, and a dynamic instructor marketplace. And by doing all of that, allows us to better serve our core markets with shared innovation, data, and tech, and bring that to learners around the world. The combined company has more than 270 million learners around the world and nearly 20,000 enterprise customers.
You say you can get annual run rate cost synergies of $115 million within 24 months of closing. How do you do that?
Well, obviously, there's a lot of work that's going to go into that between sign and close. But we believe there are real opportunities to look at where we can be more efficient across sales and marketing, G&A, and ensure that we're continued to be able to invest in the future of the company by bringing more technology to our learners and enterprise customers, and really leveraging AI to accelerate the pace of innovation for the combined company. By doing all of that, we're confident that those $115 million of annualized run rate synergies are going to help us get to an expanded adjusted EBITDA margin that is closer to 20%, which is really compelling from a shareholder perspective.
Does the Udemy brand continue, survive? Its consumer business really hasn't been growing recently while you have. So what happens with the brands? What do you emphasize versus pull back on, assuming these two brands combine as you plan?
The brands will combine. They will live on underneath the Coursera brand. And obviously, we'll be really thoughtful about how we do that. We are big fans of the strength that Udemy has, in particular with their enterprise business and their dynamic instructor marketplace. Those are two incredible assets, and we want to build on those. And we believe that the combination of the two entities gives us the ability to have a shared technology platform and a single brand that delivers more value to individual consumer learners and enterprise customers.
you and I have talked recently about the role AI is playing, particularly in driving demand for Coursera's business right now, as so many workers try to upskill, enterprises try to upskill their workers. I also wonder what effect you're seeing in customers, enterprises trying to use AI on their own to upskill, and to what degree Udemy has something to add to what you already have and built out.
Well, Udemy has a thriving enterprise business with 17,000 enterprise customers, and they leverage AI and MCP to deliver that in the workflow for some of their enterprise customers. We believe there's an opportunity to combine that with our strengths on the consumer side and really provide a much better foundation. Obviously, all of Udemy's enterprise customers will also gain access to our amazing catalog of content from the leading universities and industry partners. So we think there's an opportunity to really double down on all of that and really expand the opportunity and the ability to better serve those enterprise customers as they're looking, how do we upskill and reskill our workforce to ensure that they have the right talents, the right skills for what their job needs today as that changes at an unbelievably fast pace.
Finally, Greg, so feel free to add whatever concluding thoughts you have in here as well. Duolingo, last quarterly report, and that was kind of a retrenching, a need to reinvest in the foundations of what they do because of this AI opportunity. As you look at this combination, how much cost might you have to pour into it as well to standardize the platform across both companies? What should shareholders expect?
Well, obviously there'll be some one-time integration costs, but one of the benefits of this combination is that we'll only have to have one platform, not two separate platforms. And so as we work through that integration, we'll be able to invest more in a single platform that serves a larger customer base, so that investment obviously gets amortized over more learners, more enterprise customers, more revenue, and the adjusted EBITDA margin and the profile of that improving so dramatically gives us a foundation that enables continued investment to ensure that we're not just keeping pace with technology change, but we're also enabling our enterprise customers to do that themselves as well by serving them better.
Greg Hart with big news on this merger of Coursera and Udemy this morning. Thanks for joining us first on CNBC.
Thank you, John.
I want to get back to David Faber. We've got so much going on. He's got big interviews all morning, and now he's got Netflix's co-CEO Greg Peters with him.
And you guys will join in this as well, but certainly very happy to have Greg Peters, the co-CEO of Netflix, join us now in a morning in which, of course, their deal to acquire Warner Brothers Discovery has been reaffirmed essentially by the Warner board. You heard from Sam DiPiazza just a little while ago right here. Greg, great to have you with us this morning. Thank you.
Good to be here.
Let's just start with antitrust, because it has been one of the key risks seen for both your deal and potentially as well for the Paramount deal. In its communications this morning, the Warner Brothers board says, despite media statements to the contrary, they don't think there's a material difference in regulatory risk between the two deals. How do you see it for Netflix as the path to getting approval here, given so many people seem to have objections to putting together the #1 and #3 streamer in both Netflix and HBO?
Yeah, we believe the regulatory process will ultimately conclude based on the facts, and we feel those facts really support the approval of the deal. We're confident regulators will ultimately see this as pro-consumer, pro-creator, pro-worker, pro-growth, pro-innovation, and pro-competition. You came up with a few examples of how you might define the market. We look at the market definition in a couple different ways. A key one for our side is just who's winning TV view share, and I think if you look at that, we're way low in the rankings. We're 6th behind Google and YouTube, behind Disney, behind Comcast, NBC, Fox, Paramount. Even when we put HBO Max and HBO on top of the Netflix viewing, that still puts us behind YouTube and Disney. So we believe there's a really good story as to why this is a deal that's good for consumers at the end of the day. It doesn't creators anyway, and we're already engaged with competition authorities, including DOJ and EU Commission, to explain that to them.
You are. So you've already begun that engagement. Can you describe at all what you're seeing there, and or what is giving you perhaps confidence that you can in fact meet any objections they may have?
Well, I think it's just, helping them, with the facts essentially around what's happening. And I think, we mentioned the view share on TV. Another way to look at this is I've heard people talk about combining the number of subscribers. I think it's important to understand that, the two services are highly complementary. More than 75% of HBO Max members also subscribe to Netflix. So this creates actually an opportunity to offer consumers a more tailored, better optimized subscription plan, more value. We also think, when you think about the number of buyers that are out there on the creator side, we've got new buyers coming in like Amazon, with Apple, we've got the fast services, like Tubi. So there's a tremendous number of ways to get your project made and get it out to an audience.
Yeah, and to those who would say, well, really, they're just buying HBO, obviously it's part of this overall deal, but HBO in particular to kill it. You talk about the overlap. To put a key competitor out of business, how do you, or to really pull it aside and sort of undermine it, how do you respond to that criticism?
Well, I think that would be a very bad idea because, we think there's a tremendous value in HBO, and it's an amazing brand. It says prestige TV. We're excited to double down on that promise. I think actually the HBO brand and service gives us another tool for how we think about assembling our plans, how do we deliver different offerings to our members. We've just gone through a similar exercise with our ad plans where we had to think about how do you compose the right set of offerings to satisfy different consumers while maximizing the value for the business. That sort of key thesis with regard to the HBO brand and service is a key part of value for us. So we want to see HBO thrive rather than the opposite.
Yeah, to come back to antitrust for a moment, the president's going to play an important role here. Is there any indication you've gotten from the administration in terms of how they're going to view this transaction?
I think just stepping back, the president and this administration, they care about American industry, they care about the success of American companies. I think we have a great story there. We've created over 140,000 jobs in just the last 4 years in the United States. We think about production, post-production, construction. We support small businesses and local communities. So I really think this deal is a win for the entire industry. It brings an important, iconic studio into a sustainable model that means more investment. That means more opportunities, more American jobs, more union jobs, more production staying in the United States.
The EU is going to play an important role. You raised it as well. What are your expectations there? We oftentimes can just get, overly focused on the U.S. regulatory process.
Yeah, and as I mentioned, we're already engaged with the EU Commission as well. I think we have a similar story there where we can bring more opportunities for creators in the European Union to tell their stories in big ways and bring that to a bigger global audience. One of the things we love about this deal, the other big center of value for us, is there's an incredible library of content out there in the Warner Brothers catalog, and we can bring that to more people around the world and create value for consumers and for creators as a result.
Becky's got a question.
Thanks. Greg, just spoke with one of your shareholders, Mario Gabelli, a little bit ago, and just asked him what he thought about all of this with the filing coming out today and seeing what's happening. And Mario's firm, Gabelli Funds, I think owns about 5.7 million shares of Warner Brothers Discovery. It's going to be a big question on what shareholders decide to do with all of these issues. He said basically, he most importantly would like to continue to see this whole deal in play. With looking at Netflix on this, he said he'd love to see a higher cash portion of that offer coming in cash from Netflix and maybe eliminate the collar on this. But ultimately, he said he's still deciding where he thinks this is going and would like to see this still in play. Is Netflix going to sweeten its offer?
Well, I would say I don't want to speculate on what's going to happen from here. We are pretty happy that we've presented a pretty strong deal, and I think the Warner Brothers Discovery Board sent a pretty clear message that they believe that this is the best value. It's the most certain path forward. Our deal structure is clean, it's certain. We're a scaled company with over $400 billion market cap. We've got strong investment-grade balance sheet. This deal offers flexibility for Warner Brothers to do what they're planning on doing, which they think is best for their business, which is separate Discovery Global. So we believe this is a great deal, and would love to see this through.
Greg, if I could step back for a minute and just sort of, given I haven't had a chance to ask you this question or to Ted, why are you doing the deal? I mean, there have been many who were sort of questioning it throughout, saying they're not really serious here. My reporting indicated otherwise. But they worry about your multiple. They worry about what it says about how you view your own ability to grow. and that your multiple therefore will take a hit longer term here as you integrate this. They worry about integration. You've never done a deal, let alone a deal of this size. Why is this worth undertaking all of this distraction and risk?
Yeah, I think we're in the business of doing things that we've never done before and learning how to do them well. I mean, we didn't do ads before, we didn't do live before. I think those are been quite successful and additive to the business. We're going to make them even more successful. At the end of the day, you know, we like our organic growth path. You know, we're on a great trajectory to deliver double-digit growth still. We see that coming for, you know, many years. But we saw, as we got into looking at this opportunity, basically the opportunity to accelerate that. And we think about the catalog of titles. We think by bringing those to, you know, bigger distribution reach, by having a best-in-class product experience, we unlock more value for both consumers and for creators. We do that day in and day out. So this is just another opportunity to do that more. I mentioned the HBO brand. We think there's an opportunity to bring that into the mix, and that helps us elaborate our plan offering and optimize value both again for consumers as well for the business. So we looked at this and we said, hey, you know, it's probably irresponsible for us not to actually bid on this and bid on it in a disciplined way. And if we can, you know, bring it in, then we'll figure out how to do the integration just like we figured out how to do a bunch of stuff that we've never done before.
Yeah, and you're not concerned ultimately? I mean, your multiple to earnings has been the envy of the media business for years. Are you concerned at all that you put that in danger?
I think, you know, we'll prove it just like we proved it every, you know, previous quarter, you know, that we can actually make value out of this, and we'll show our shareholders how we're doing that, and I think the results will speak for themselves.
When it comes to whether you would raise, Becky asked the question, but I'm curious, obviously you don't need to now, you've got a deal, it's been reaffirmed, but there certainly is the possibility that Paramount will come back, and it is possible they will meet many of the objections raised by the board. If that does happen, will you guys fight to keep this asset?
Let's see what happens. I would also say that we have shown, you know, again and again and again through multiple deals. You think about licensing deals, and we bid for, you know, rights for live events, etc. You know, we do the work to establish what's the value to the business. You know, we bid aggressively up until that point, but also we, you know, are this passionate when it comes to the fact if somebody's willing to bid more, then we say, okay, you know, Godspeed, and we'll exercise the same discipline here.
Yeah. When it comes to the sort of the Hollywood community, I had Bob Iger on with me last week as well, sort of talking broadly in terms of would it be healthy for Netflix to own Warner Brothers? What will the impact be on the creative community, on the ecosystem of television and films, particularly motion pictures? What do you say to those who are very concerned ultimately that you're still going to follow the Netflix model? You're not going to really release as many movies, and ultimately this could be damaging to that entire community, some of whom have stood up already and indicated their concern about the deal itself.
Yeah. We will maintain Warner Brothers operations. That means we're 100% committed to releasing Warner Brothers films in theaters with industry standard windows. And I think if you step back, you know, Warner has 3 core businesses that Netflix doesn't have. It's got a successful theatrical film division. It's got a world-class television studio. It's got HBO. We mentioned that before. We see these as assets, not as liabilities. We want to preserve their value. We want to preserve their contributions. We're going to operate them as such. You know, we've debated building these businesses multiple times in the past, and we thought they were good businesses. It's just that we had other things to focus on. But now, as part of this transaction, we bring mature, world-class versions of these businesses in-house, and we're looking forward to adding that expertise. So I'd say, you know, this is complementary. We want to keep that value, and we're going to keep those operations essentially as they've been running before.
Yeah. There had been some talk, let's call it, that you and Sarandos had a different view of this, and that you were not nearly as enthusiastic about the transaction. Is that true?
No, it's been remarkable because I think that we assumed we might come in with different perspectives on it as well. But you know, we did the work, and really the work speaks for itself, which is you get in and you actually build the models. You understand how would these titles contribute. Again, remember, this is an exercise we do day in and day out, where we're looking at various different licensing opportunities, understanding how will titles perform on our service. So we have a very elaborate, deep understanding of how that works. And when you've got that, you know, that model, then you do the hard work and you beat it up and you challenge yourself on all the assumptions. But when you conclude at the end of the day that there is a tremendous amount of value creation in this kind of deal for our members, the people that we serve, for the creative community as well, we look at it and we say, you know, we're excited both to move forward.
Yeah, and finally, Ray, back to the sort of antitrust, the gamut of things you run. When do you see the deal closing? What are your expectations in terms of when you will actually own this asset?
We've been looking at this as a 12 to 18 month process. Obviously, you know, there's different regulatory paths across different jurisdictions. But again, you know, we think that we've got a very clear message. It'll, you know, regulators will do their work as they should do. That's fine. We expect them to do. We will support them through that process. But we believe at the end of the data is going to speak for itself.
And if you're taken to court, will you fight?
Yeah. We have a good case, and we believe that we should defend that case and make that case strongly.
Greg, very much appreciate you taking time this morning. Thank you.
Thank you.
Greg Peters, co-CEO of Netflix. Becky, send it back to you.
David, fantastic interviews today. Thank you for bringing them to us. Obviously, we're going to be watching all this very closely, but this has been one that not seen just over yet. But man, this is interesting stuff. David Faber. When we come back, we've got House Speaker Mike Johnson. Welcome back, everybody. It is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Andrew Ross Sorkin. Joe is out today. Let's take a look at what's been happening with the futures at this hour. Right now, we are in positive territory. Dow futures indicated up by about 85 points after 3 down sessions in a row through yesterday. S&P futures are also indicated higher, up by about 19 points after it's also been down for 3 sessions in a row. The NASDAQ was higher yesterday, and it's indicated up almost 100 points this morning. If you check out Treasury yields, you'll see that they were a little higher as well. Right now, the 10-year is yielding 4.17. The 2-year is at 3.5%. House Republicans will vote today on their proposed health care plan, but an amendment vote on the Obamacare subsidies has been ruled out by Republican leadership. Joining us right now is House Speaker Mike Johnson. And Speaker Johnson, thank you for being with us today. People had been waiting to see what you would do, and you decided to go with the more conservative part of your party, to the consternation of some moderates, including Mike Lawler. What happened? What made you decide to go this way, and what do you do with the moderates who are unhappy with this decision?
Well, it wasn't the Speaker's decision, it was consensus of the body. We have 220 Republicans here, and lots of different opinions, lots of different dynamics in their districts across the country. This extending of the COVID-era enhanced subsidy, the premium tax credit, has been a big issue around here of debate for months now. We knew that we were coming to the end of the year when it would expire, and remember, the Democrats created this COVID-era subsidy. They are the ones that put the expiration date on it, and now they're turning to Republicans as if we should save that in some way. We couldn't find consensus on it with the body in order to pass it. Here's the reason. Everybody needs to understand there's a false narrative out there about these subsidies. It's subsidizing insurance companies, and when you do that, you're masking the cost, the rising cost of healthcare, and you're making the premiums rise even further. But here's the false narrative. The Democrats are pretending as though this affects everybody in the country. It affects 7% of Americans, this extended subsidy, and of those, even if it was extended without any reforms at all, it would only reduce that small group of Americans' premiums by 5.7%. The Democrats have tried to pretend as though this is all about
Americans. No, I understand this is not for everybody, but it's 22 to 24 million Americans, and there are some Republicans whose districts are going to face some real trouble and some real issues with this. We've talked to some of them. I understand that Mike Lawler from New York was particularly upset yesterday, that he was kind of furious about it, said it's idiotic, it's political malpractice. That's what he told Axios on some of this. They said they could hear him yelling from outside the room yesterday where all of you were meeting.
Well, no. I was in that room with him, and Mike Lawler's one of my close friends. In fact, I was with him in his district in New York City just 2 weeks ago, campaigning for a couple of days, raising him money and helping him get reelected. He's an essential member of our conference and a really smart guy. And what he was arguing for is this 7% of Americans, but here's the point. What we're going to do today is the first of multiple steps to help not just 7% of Americans, but 100% of Americans reduce their premiums, actually reduce their premiums, not subsidize insurance companies to raise the premiums, but reduce them. And the first of those votes is today. But this is the Lower Premiums for All Americans Act we're going to have on the floor, and it's going to actually achieve, if it's signed into law, exactly what we're saying. It has many components. Among them are the cost sharing reduction programs, which will reduce all premiums across the board by at least 11%. And by the way, save taxpayers tens of billions of dollars. We have the health association health plans that will be part of this today, which will give more flexibility and to small businesses and others and insureds in the marketplace. You've got PBM transparency as a part of this, and the choice accounts. So there'll be a lot more flexibility in the system. Consumers will be able to have more choices, and their cost will go down. We'll also increase access to care through these reforms. And again, this is just the first of many. We're going to do more of this in the first quarter of next year. Republicans are the ones who will fix health care. It is the Democrats who broke it. Remember, when they passed Obamacare, the Unaffordable Care Act, it was 15 years ago now, they promised us that it would enhance care and the premiums would go down for everyone and you'd have more choices. None of that was true. So we have to fix it.
I hear your point. I hear your point that these subsidies would only help a portion of the people who are dealing with much higher premiums with health care. That's certainly fair. But to be trying to change the healthcare system at a point where the subsidies are going to go away and raise insurance for 22 to 24 million Americans, premiums starting in a couple of weeks, the moderates on both the Republicans and the Democrats have said, okay, we don't want to necessarily go along with extending those for 3 years as the plan laid out by Hakeem Jeffries, but why not do a 1 to 2 year extension while you're trying to make some of the changes that you're talking about? Because these changes are coming so late, because they're not things that are going to bring down premiums tomorrow, why not extend some of those and try and find some way to blend these two sides to say, okay, we're going to try and change the healthcare system and bring down premiums for all. It's not going to happen overnight, so in the meantime, we'll extend these subsidies.
Well, a couple of important points. First of all, the subsidies are not going away. And again, this is an enhanced subsidy on top of the subsidy that everyone already has. And again, even if it had been extended for 3 years, as Hakeem Jeffries proposed, with no reforms, they would these same people who are achieving that and having that enhanced subsidy would only get 5.7% of savings. The point is, everyone's premiums are going up because the Democrats broke the system. The very people who are trying to continue to subsidize it and put more taxpayer dollars in a broken system are the ones that created the mess. We are coming into the middle of that to reform the system, to look at the root causes, the root problems of why everyone's premiums are going up. And yes, that takes a lot of hard work. It takes a lot of consensus building here, especially at a time when we have razor-thin margins, and no one on the Democrat side wants to do anything to actually help the problem. They don't want a solution to this. They want an issue for the upcoming election. And they have put all their chips on one slice in the roulette wheel, and their whole game is to try to blame healthcare costs on Republicans, which is comical when you look at the facts. They are the ones that broke it. They're the ones that continue to add to it, and that's what we're trying to address.
If we were to have this conversation 12 months, 18 months from now, and this bill goes into effect, how quickly, I mean, this requires sort of the market to do a lot of things, if you will. How quickly do you imagine prices come down if it works the way you think, despite the deductibility issues and everything else?
Yeah, well, it's a great question. Some of it is immediate. For example, PPM transparency, that will bring premiums down almost immediately and can be put into the system quickly. Expanding the market and expanding the choice and having other options will take a few months in some cases, some longer, but it's a series of changes that we have to bring about. Remember, this wasn't broken overnight. It took months and years to get into the mess we're in. It's going to take us all a little bit of time to climb out of it, but again, if we go into the first quarter of next year, we have these provisions that we would vote upon today, signed into law, and then we continue to add to it. We're looking at another reconciliation package, for example, in the first quarter of next year, which will have a number of other revisions and reforms to the system, and all of it is geared, again, for reducing premiums, increasing access to care, and quality of care. We have many specialties, for example, in healthcare right now that have a dearth of providers. We don't have enough people in the system, and so we're going to have a shortage of healthcare providers. So there's a lot of different issues that must be addressed in a very complex system. As you guys know as well as anybody, healthcare is a major part of the U.S. economy. It's entwined in so much of what we do, and so you don't just go flip switches and change it. It takes some time, but we got steady hands at the wheel, and we're working on that every single day.
Speaker, you mentioned the very thin margins that you have in your party in the House at this point. 4 Republicans would need to jump on to Hakeem Jeffries' bill to force a clean 3-year extension vote on subsidies. Are you convinced that they will not get 4 members of your party to sign on to that?
Well, we have to see what happens. I hope not. I've discouraged it. I mean, a discharge petition, by its very nature, goes around the regular order process of the legislative body, where consensus is built and good ideas are formed and passed into law. So, doing an end run around the majority party, the speaker, or the regular process is not the best way to make law. And
You're
I think
talking
they know
about
that, that's why there's
Gottheimer's.
been a reluctance.
You're talking about Josh
Well,
Gottheimer's discharge petition, or?
Well, there's about 3 or 4 of them pending right now in various timelines when they would extend the subsidies and different provisions. Some have reforms, some minor reforms, some have none. Notably, none of the discharge petitions include hide protections, which is a big thing for millions and millions of Americans. It's traditionally been true that we do not use U.S. taxpayer dollars to fund abortion. And these discharge petitions don't factor that in at all. So for the first time, you would have a vote, an affirmative vote, to fund abortion services with taxpayer dollars, and that's a hill that I don't think we want to climb here.
You said that the Democrats don't want to fix this, that they would like to use this as a political issue in elections next year for the House that come up in November. It's a pretty good issue if you have Americans who are paying a lot more for their health care insurance and feel like they can't afford it. Do you think that this is an issue that will hurt you come November?
Well, no, because what we do is confront false narratives with the truth. I mean, we can demonstrate the timeline of how and when Democrats broke the system and the timeline of what Republicans have done to try to fix it, what we are currently doing now to fix it. And I can show where the Democrats voted as recently as earlier this year, the big beautiful bill, the Working Families Tax Cut. We had, for example, the CSR programs, the cost sharing reduction in the House version of the bill that was sent over to the Senate. And it was the Senate Democrats that fought to pull that out. Remember, that provision alone would reduce premiums for all Americans by at least 11%. Those are outside analyst numbers, not ours. And it would have saved the taxpayers tens of billions of dollars. They decided to strike that out of the bill. So they demonstrate every day they really do want the issue, they don't want a solution. And to me, that's a very sinister and cynical way to look at this. I mean, to choose a political issue when you know Americans are hurting by the program that you broke. That's what the Democrats are doing right now. I mean, it's just objectively true, and we'll be able to show that to voters when we go out on the campaign trail.
Speaker, we're going to run out of time, and I'm going to spare you a question about Susie Wiles, but I'm going to ask you a question I don't think you're going to love, but I do want to ask you about it because you were asked it, but you didn't answer it earlier this week, and it's actually about the president's remarks about Rob Reiner and the murder that took place over the weekend, and some of the disparaging comments that he made. You've talked so much about character over the years, and I wonder if you would just speak to the comments that the president made, especially in light of the fact that, you know, he was shot a year and a half ago, and there are a lot of people on the other side of the political aisle who came to the president's defense, praised the president, and I think in a moment like this, when the country sees something like this, and then sees the president make these comments, and then you were asked about them and didn't comment on them, so I wanted to hear your thoughts.
Well, I did comment at length. They just didn't replay that part. No surprise here, Capitol Hill Press Corps. But what I said was straight from the heart. I heard about it coming out of an event in the morning when the news broke. And my comment was that, I mean, obviously it's an unspeakable family tragedy in the Reiner family. I mean, just a horrible thing to think of. The son is apparently the murderer of his parents, but it also speaks to the rampant evil and violence in our society, which is, there's root causes of that we try to address here every day as well, but it's ultimately a human heart issue. But I mean, our prayers are with the Reiner family and everybody involved, and I said, I immediately go to scripture in my head, and I was thinking of Psalm 34, and it says, the Lord is close to the brokenhearted, he saves those who are crushed in spirit. That's my reaction, that's what they ask me every day here.
I think you can hold two ideas in your head at the same time and say that you can praise the president about many things and you can condemn the president's comments about certain things. And in this case, I'm asking you about that.
Yeah, look, I know. I'm asked to give running commentary on everything that the president says every 5 minutes of the day, as well as all of my colleagues here. And yes, we got many ideas at the same time. I don't communicate the same way. I am my own person, and I speak, from my voice. And the president and I address issues differently sometimes. That's not the way I would have done it. It's not the way I have done it. That's my comment on it. I don't know what else I can say.
Speaker Jones, I want to thank you very much for your time today. It's good to see you.
Thank you. Appreciate it.
Meantime, if you missed it earlier in the program, breaking news right here on Squawk Box. Warner Brothers Discovery telling shareholders to reject Paramount's offer and recommending a merger with Netflix. We're going to have a lot more on that story in just a bit with our media analyst, longtime friend of the show, Rich Greenfield's going to join us. When we come back, we're going to get a live look into the Yale CEO Summit where Steve Leisman is on stage. He's going to be interviewing Fed Governor and candidate for Fed Chief Christopher Waller. His comments are coming up next. You do not want to go anywhere. Take a look at futures.
No, I think they know who they are. It's okay. Let me start. Governor Waller.
Just call me Chris.
Chris, okay, Chris. Let me start with the jobs data we got yesterday, which I think is, people are wondering how the Federal Reserve is processing and how you're personally processing this data here. We had a tick up to the unemployment rate at 4.6%, return to job growth in November after job losses in October What's the state of the labor market in your opinion?
Well, earlier this summer, when the jobs numbers were looking very good, I had a lot of anecdotal evidence talking to CEOs around the country and other sources of soft data that told me the labor market wasn't doing that well. People were kind of like, what's he talking about? And then the August 1st, the July jobs report came out, everything was revised down pretty dramatically. And so we've now come around to this view that the labor market is very soft. The jobs numbers are around 50 to 60,000 the last couple months on average. We know that that's too high, and those are more likely to get revised down when we get the unemployment insurance administrative data later. It'll take a while before we get that, but board staff is estimating to take off another 50 or 60,000 jobs. So we're close to zero job growth. Now that's not a healthy labor market. Now, we expect that to kind of come back in 2026 due to a lot of tariff uncertainty going away. Our rate cuts have helped try to soften things up going forward. That was the whole point of doing these preemptive rate cuts that we started in September. And then also a lot of the fiscal bill will probably have some impact, and then we'll see if the AI stuff really starts kicking in with serious measurable productivity. So 2026 could turn out to be a better year in terms of that. Now, whether that pulls the labor market along with it, I certainly hope it does. But right now, my focus as a governor has just been to focus on the labor market. Inflation, I'm not particularly worried about. I know it's above target, but I believe it's coming. It'll start coming down in the next few 3 to 4 months. And so the critical thing for me is the employment leg of our dual mandate, and inflation will come back down. And we see that when you look at market pricing, inflation expectations, tips, and things like this. It's pretty well anchored around 2%.
Chris, if you're already at zero, does that mean you're behind the curve?
Well, that's what I'm saying. That what we don't quite know is how much of this is like AI driven. When I go around and talk to CEOs around the country, everybody's telling me, look, we're not hiring because we're waiting to try to figure out what happens with AI. What jobs can we replace, what jobs we don't. That sort of stall in hiring could be just temporary. After a while, people are like, nah, we still need these people to do this or that, or they don't. So we don't quite know yet what the AI impact is going to be on the labor market. But I think we got started cutting in September. I think those cuts will come in as we go forward in the next year.
For the record, you wanted to cut in July.
I wanted to cut in July, yes. I felt like it was needed. That was before we got the jobs revisions. Again, people thought I was nuts, but the data came in and said, look, that guy was right.
I want to go back to the same question, though. If you're already doing a goose egg on jobs, are you behind the curve and is further stimulus needed now?
Well, I personally, I don't speak for the committee, but I personally think, because I don't think inflation's there's not going to be any re-acceleration of inflation. There's no forces that are suggesting that inflation's going to take off again in 26. If anything, the tariff effects, whatever they may be, those will start coming off as a one-time price effect. So we're not going to see persistent inflation from it. So if I believe inflation is under control, inflation expectations are anchored, standard central bank wisdom is you look through one-off price effects like a tariff would be if it has inflation effects, then the labor market's telling me we should continue cutting the rates. And that's kind of my view about things.
And the journalist central bank reporter handbook says to ask the governor, how much should you cut rates?
Well, I don't think there's we're not seeing a dramatic decline of the labor market going off a cliff. It's just kind of just continuing to just soften and soften. So we can go at a moderate pace. I don't think we have to do anything dramatic. If you have to do something dramatic, it's too late usually. You've waited too long.
So where's your neutral, and should the Fed be at neutral now or even stimulus soon?
Well, I tend to be on the lower, in the survey of economic projections, I'm kind of in the lower half of the...
So below the median?
Below the median, which is about 3. And I've been there since I joined the Fed. This is nothing new or different. That was my view a long time ago due to I gave a speech in Iceland about a year and a half ago, kind of laying out all the reasons I felt that way. So, I still think we're probably, maybe we're 50 to 100 basis points off of neutral. We still got some room we can bring things down.
Again, I hate to come back to the same question. If you're at zero, because I gotta, if you're at zero and you're 100 or 50 basis points above neutral, should the Fed be stimulating the economy now to spark job growth?
That's where the inflation comes in, right? So you're running about 2.8%, 2 is your target. So inflation's above target. I think employment's kind of potentially below target now,
Right.
with unemployment rising. And that's the committee's trade-off. Do you want to still keep things tight because of inflation when sure that it comes down, or do you start cutting to try to head off the stuff, the soft labor market? I think inflation's going to come back down. I don't see any evidence whatsoever that inflation expectations are taking off. In fact, even in the survey data, I'm a little suspicious of, they've been coming down. Market pricing doesn't show any future inflation beyond the next 6 months to a year. So I'm less worried about it. But I have colleagues that are very concerned inflation's going to get stuck, and that the only way we're going to get it back down to our 2% target is to keep rates where they are.
Chris, there's a chart that I saw yesterday which shows job growth. I could do one of my famous air charts. It goes along like this. Right here is Liberation Day, and then job growth comes down. Are tariffs responsible for job losses?
I don't have any direct evidence of that. There was an announcement, there was some put in, and a lot of them came off, but then they got paused. So it's very hard to basically say what happened. Again, like I said, at the time there was trade uncertainty, more about trading partners, not so much about the tariffs, where we were going. There was a lot of discussion about firms had hired a lot of people and they had maybe overhired when the labor market was tight, and it was time to let jobs just shed. So nobody was in a firing mode, they just weren't replacing or backfilling. That would have nothing to do with tariffs. And then AI. That is all I have heard since the summer. So those are the three factors that kind of came into being that I think caused the slow job growth.
You're going to be meeting with the president later today.
That's what I heard.
Yeah, we reported that. I want to thank you for continuing to keep your appointment for this conversation, which other people might have otherwise. But I'd like to say the president called me to do a pre-interview with Chris, but that's not precisely what happened. The president has said that he thinks he ought to have a say in interest rates. I imagine he might say that to you. I wonder if you might share your response to the president if he says he ought to have a say in interest rates.
Well, I think the president makes himself very clear on Truth Social what his views on policy and what they should be. I don't think there's any confusion about it. The one thing you want to do, I think there are other channels for that kind of communication rather than direct one-on-one. If there's something very pressing, I know in the past Fed chairs have talked to the president at certain times. But
in times of crisis?
In terms of crisis, and that is when you should have a coordinated response to things. COVID was clearly an example where you needed a coordinated fiscal and monetary response to the pandemic. There's nothing wrong. That's not a threat to central bank independence in any way, shape, or form. That is actually needed for the country when those type of events happen. But, the Fed chair and the Secretary of the Treasury have breakfast every 2 weeks. So that's a normal chain of communication where information can be passed from the White House to the chair about what the administration's views are. I think that's a typical channel of communication that's well understood. And I don't think there's anything wrong with continuing with that channel.
Will you emphasize to the president the importance of Fed independence?
Absolutely. I spent 20 years of my life working on central bank independence and why it was important. There's no doubt. I got a long paper trail of this. The one thing everybody always forgets in central bank independence is there's another side of it, which is accountability. There's no institution in this country that is unaccountable to the electorate. That's not, and that's what people often forget, is that we want central bank independence to be free of political interference, but we still have to be accountable to the American public. And we try to do that with the chair testimony to Congress twice a year. After every meeting, we make a decision, we have a press conference, the chair goes out, tries to explain to everybody why we did what we did, answer questions, and it's all about transparency and accountability. And that's my own view is that's the importance of having the press conferences. It's for us to try to explain to the American public and the markets why we
Okay,
can.
we've been listening to Fed Governor Christopher Waller live from the Yale CEO Summit. He's being interviewed there by our very own Steve Leisman. Just a few of the highlights from that conversation. Waller said that the jobs market is very soft. He did say it's a big question as to how much of that is AI driven, saying that when he's been going around the country listening to CEOs, they're all saying basically that they want to wait and see what happens with AI. He said that could change next year. Maybe they go ahead and they hire people as a result, thinking that they still need these workers, or maybe they don't. That's a big question for that. He did say, though, that 2026 could turn out to be a better year for the economy. And he said that inflation expectations are anchored. He said it's above target, but it should come down in the coming months. And of course, Waller is going to be interviewed by President Trump today in his continued search for who the next chairman of the Federal Reserve is going to be at the Federal Open Market Committee. You can catch the rest of Steve's interview streaming live on CBC.com.
Okay, coming up next, a look at where Tesla is trading this morning after a 3% jump yesterday to an all-time high. As we head to a break, check out the price of oil this morning after news of sanctions, the Trump administration deeming the government there a terrorist regime and ordering a blockade of sanctioned oil tankers. We're looking at WTI crude at 56.26. We'll come right back.
everybody. Let's get over to Dom, too. He's got a look at this morning's pre-market movers. Hello again, Dom.
Hello, Becky. Hello, Andrew. We're going to start things off with the big media news this morning. Warner Brothers Discovery telling its shareholders to reject Paramount Skydance's hostile takeover bid and recommending Netflix's approved bid. Warner Brothers Discovery Board Chair Samuel Di Piazza told Squawk Box earlier that it was not a hard choice when deciding between those offers, especially since Larry Ellison did not provide an actual guarantee in Paramount's proposals. Take a listen here.
To be very direct, nowhere in any of these proposals did Larry Ellison guarantee.
And that could have potentially changed the board's decision?
Well, obviously the ability to deal directly with Larry if there was an issue to close would be critical. Otherwise, closing might not happen.
All right, logistically, the shareholder vote will be set for sometime in the spring. Warner Brothers Discovery right now, you can see, is down about 1.25%. Netflix is up 1.5%, and Paramount Skydance down about 2% as well. Meantime, you got Ally Financial shares are in the green right now after an upgrade to overweight from equal weight over at Wells Fargo. Those analysts are citing the auto financing firm's strong results throughout the year, despite negative headlines in the auto lending sector. They also say a few more Fed rate cuts could make a big difference for their profit margins. So Ally shares up 1.5%. And Tesla is just about flat today after notching a new all-time high just yesterday, despite touching lows of around $215 back in April. As you can see there, we're back well above the 21% mark higher for 2025. But only about 2% higher over the last 12 months or so. But nonetheless, we're down 0.5% today, about $1.6 trillion in market cap, Andrew. I'll send things back over to you.
Okay, still to come, Medline raising close to $6.3 billion in its biggest IPO of the year. Company CEO Jim Boyle is going to be joining us ahead of the first trade here at the NASDAQ. Squawk Box coming right back. others making headlines right now. OpenAI is in talks with Amazon about a possible investment in using Amazon's AI chips. A source telling CNBC that deal could top $10 billion. Amazon has already invested at least $8 billion in OpenAI rival Anthropic. So this could get interesting to have Amazon involved in a couple of these. Waymo is in talks to raise $15 billion in 2026, a source telling CNBC the funding would come from parent Alphabet and outside investors valuing Waymo at up to $110 billion. Its latest funding round raised $5.6 billion at a $45 billion valuation. And Robinhood is expanding its fast-growing prediction markets, letting users place parlay-style bets on multiple NFL games, putting it in direct competition with traditional sports books. So it's getting interesting fast in the prediction market now sports book phase.
Up next, Rich Greenfield will join us on the latest move by Paramount, telling shareholders to reject a takeover offer from Paramount Skydance. And then the CEO of Medline, Jim Boyle, on the company's big IPO right here on the NASDAQ today. Squawk Box will be right back.
Yeah, we believe the regulatory process will ultimately conclude based on the facts, and we feel those facts really support the approval of the deal. We're confident regulators will ultimately see this as pro-consumer, pro-creator, pro-worker, pro-growth, pro-innovation, and pro-competition.
That was Netflix's co-CEO Greg Peters earlier in the program, Warner Brothers Discovery, telling shareholders to reject Paramount's offer and go with the Netflix merger. Joining us right now is Rich Greenfield, LightJet Partners. You've probably now had some opportunity to go through the document that Warner Brothers put out. You've seen what Netflix had to say about it. Which, in your mind, is the better deal, Rich? Putting aside whether we get to a bidding war, which I'm sure we will, but or we may at least, right now.
I mean, I don't even think it's close, Andrew. I mean, think about the things that you learned in this document. I mean, just right off the bat, there was somebody bidding for Discovery Global. Like, the cable network piece, like, so much of this discussion is like, oh, is it worth $1? Is it worth $3? How will it trade versus Versant? Somebody actually made a bid for the cable network person. I don't know who that is. Like, it's not obviously disclosed. It's company C in the document. But somebody was bidding for the cable network piece. To me, that changes everything. Like, think about how much value this split could unlock. I think that was one of the things that really came clear in the document, and you heard it earlier in the SAM conversation with David, is that if you go with the Paramount bid, you get stuck owning. You can't spin off the cable networks. The cable network business for both Paramount and Warner is getting worse. And God forbid you don't get approval. Not only are there costs associated with not splitting at this point, but you would get stuck with this asset in 2027, and who knows if you could even spin it off or what that does to you. And so I think the certainty of getting the spin done in the first half, or sort of over the summer of 2026, is a very important part of this deal. And knowing that there's a bidder that wants to buy it means that the value, this $1 versus $3, maybe it's more than both of those, because there's actually a buyer for these assets that no one's even aware of until they saw this document. I think that's a very big deal. And then on top of that, the fact that on December 1st, like that seminal week when all of this is going down, the offer that comes in from Paramount is this, I mean, this pun is intended, but it really felt like a house of cards when you looked at like how all of these different, investors, if one pulled out, the whole deal could fall apart. The portion that the Ellison family was putting in wasn't even clear the Ellisons were putting it in. It could be syndicated out to any number of other parties, and so it wasn't even clear that there was any money behind all of this in terms of like who was actually funding it. We've been asking this question now for months. Is Larry Ellison writing a $75 billion check? And I think, Andrew, the clear answer is no. Most of this was being financed through debt, levering it to 7 times, and even worse, the actual amount of capital that was being put in on the equity side, most of it was coming from the Middle East, because I don't think most investors want to invest in a cable network company levered at 7 times.
Okay, so let me then ask this question. Do you imagine this turns into a bidding war, which means, do you think that Paramount is going to come back with an upgraded offer? And I don't know what upgraded offer means. More money itself, maybe they have to, given what you're saying about this, the spin and how much value that might have. If they come back and say, you know what, forget about all of these different trusts and other things, it's just a flat offer, here's what it is, no strings attached. Does that do the job?
Look, if Larry Ellison's willing to sell down his Oracle position, put it in escrow, $40+ billion in escrow, then I think this might be a different story. Now look, there's still a bunch of like the operating covenants, while this transaction is occurring, they weren't allowed to change salaries of any employees, they couldn't make a licensing deal over $10 million. Like, there was a lot of very restrictive covenants on this transaction. It's actually funny, Andrew, these are things that I think actually were problematic when Skydance was buying Paramount, that inhibited Paramount from running their business. Warner Brothers basically said, no freaking way, like there's no way we're going to allow this. And the Paramount team didn't seem to listen to those comments from the board. Very different when you read the back and forth between Netflix on the board and Paramount on the board. It seems like night and day. And so my point of that story is, I don't think it's simply about going from 30 to 32 and having more certainty on the cash component. I think it's also the entire structure of the deal. It was more problematic. And so I don't think it's that simple. Now look, Paramount comes back with $40 a share, all cash, Larry Ellison's signature. He's selling his Oracle stock to buy WBD. Great. But the reality is the fact that they've had this many opportunities, and most of the cash is coming from the Middle East, and even the Ellison piece could be syndicated out to others, God knows who.
I mean, look, I don't know. $40 seems. I think a lot of people think is rich across the board. I mean, my question is, do you see them coming back at $33, $32? I don't know. And then what does
I don't think
Netflix
32
do?
gets it done. But I don't think 32 gets it done, and so that's the problem. So yes, sure, they could come back at 32. My guess is Netflix would go up a couple of dollars if they needed to. I'm not even sure they do, because there's a lot of other. My point is, there are many pieces of this offer from Paramount that make it clear it is not comparable. And I think that is the key. You know, not spending.
So let me ask you about one piece of comparable or not comparable, which is the regulatory environment. I'm imagining that if this is going to Netflix, that you are going to hear from Paramount, you might ultimately hear from Disney and so many other media companies that are going to talk to the Department of Justice, they'll talk to the EU, they'll talk to all of the different various regulatory jurisdictions, and they will try to throw a wrench in this thing. And by the way, similarly, I imagine something like that would happen in the Paramount context as well. I don't know if you think that they both are equal, on equal footing when it comes to the regulatory environment, the way Warner Brothers described.
They are different, Andrew, for sure. I think you can't compare a horizontal, two studios, two cable network groups merging with, you know, again, I'm just going to use Document. Here is a company, you know, Paramount today. If you merge it with Warner Brothers, you have about 12 to 13 billion dollars of EBITDA. They're saying 9 billion of synergy. So, like, you know, 75% increase, but it's all coming from essentially cost cutting. So that's going to be looked at by the regulators very differently than Netflix, which is essentially doesn't have the assets that are being acquired, and they're not even buying the cable network piece. So these are very different, you know, regulatory analyses. I honestly believe both of them, I do agree, both of them can get done. Is the Paramount theoretically easier if Trump is on board? Sure. I mean, that's been the pitch from the very beginning. Although, as I know you and Becky have pointed out, Trump's made some comments in recent days and weeks, and it's not even clear, you know, whether he actually does prefer one of these bids or not. You know, Trump is the most transactional president in history, it feels like, and so who knows what it will take to get either deal done. But it doesn't feel like regulatory approval was a key swing factor in how they approached this.
Okay, Rich Greenfield, always great to see you, get your perspective on all of this.
Andrew, what do you think happens next? What do you think the next play is?
I would imagine the next play could take weeks, if not months, and maybe Paramount comes back with a stronger bid in the context of both a higher number, I would imagine, and some strengthening around how the financing is structured. Meantime, I imagine there'll be a lot of back and forth on the antitrust side to try to show that one side or the other is not going to be able to get to the finish line. But you know, I think this one's going to go for a while. That's my guess. What's yours? I think you're in the same boat.
No, I mean, my guess is Paramount doesn't have the money right now, and they are out searching for dollars because, as you see, they wouldn't have gone to the Middle East if they had the money. Obviously, Larry doesn't want to spend the money himself, and so the question is, where are they going to come up with this much money? And even, is Jared pulling out a sign that the Middle East money is going to pull out? I think that is a big question. Like, there are definitely, I don't care what they say.
I read that slightly differently. I read that as, let's take that potential conflict problem off the table.
Well, what if they take the Middle East money off the table? Is that going to stick?
That becomes a different problem piece. We got to run, Rich. It's good to see you. We'll talk to you soon.
Up next, Medline raising more than $6 billion in the biggest IPO of the year. The CEO, Jim Boyle, joins us ahead of the first trade right here at the NASDAQ.
Welcome back to Squawk Box. Medline going public today right here on the NASDAQ, the medical supply company raising nearly $6.3 billion. It makes it the largest IPO since Rivian's IPO back in 2021. Joining us right now, first on CNBC, is Medline CEO Jim Boyle. Good morning to you.
Good morning.
Congratulations. This has been quite a road for you to get to this point. Why go public now? What's the thinking in terms of where you came from and where you are right now?
As you know, we've been a private company for 58 years, with 58 years of consecutive growth. We just feel like this is the right time for us to kind of expand our voice. Historically, we've done very little advertising and very little marketing, and this gives us a way to amplify our voice and actually expand really the receptivity of who we are. We are the largest company you've never heard of, and we happen to be everywhere, which is a pretty interesting thing.
How much of this is, though, about an exit, if you will, for the private equity folks who've been backing this company for the past couple of years?
Part of it is that, right? Private equity invests in business to create a return on invested capital. However, I mean, this has been a journey for 58 years for us to prepare for tomorrow. And so it's a blend of both, right? It allows them to create an exit and allows us to create the next step in the journey.
For the investor class that's looking at this and saying, should I be buying in now? Where do they see the valuation? Who do you think are your comps, if you will? Where are the companies that, from a valuation perspective,
I don't know that I have an N01, a comp. I consider Medline an N01. My aspiration is to be hospital healthcare. What I mean by that is, if you think about Costco, they have a membership model that people pay to be a member of. Medline has a prime vendor model that both the vendor community and our customers pay to be a member of. They have a Kirkland brand that drives savings and value for their membership and accretive margin for Costco. We have the Medline brand that does the exact same thing. They have an extremely loyal customer base. We have a 99% retention rate. And when you think about the supply chain in and of itself, Costco has a pretty robust, resilient supply chain, and we have over 335,000 products with 29 million square feet in the U.S. that we serve customers from.
Can I ask you a question? We just had Mike Johnson on the broadcast talking about healthcare costs in America. What are the margins like at your company?
The margins at our company are built around making sure we can continue to invest in the business to serve our customers. And we have, listen, we sell things that cost pennies. We don't sell things that cost thousands of dollars. So the margin profile is managed in a way that delivers best-in-class value.
We can go look in the documents.
It's 13% EBITDA margin.
So my question to you is, given all of the pressures on the healthcare complex, do you think that those margins long-term can be maintained, can be expanded, get pushed?
Well, the way I look at it is we are the value player in the marketplace. We are best in class from a cost perspective and a price perspective. So I think that can be maintained. The reality is with what's happening with tariffs, cuts in Medicaid, Medicare, I mean, we have to continue to drive down costs to deliver value for our customers.
Hey, Jim, one of the questions has been the amount of debt that the company has, because with private equity, obviously there was some debt that went into it. I think as of the end of September, you had a net debt of about $15 billion and a net debt to EBITDA ratio of 4.5. No healthcare companies in the S&P 500 have a net debt to EBITDA ratio greater than 3.8. Where will you be post-IPO, and how quickly can you pay down that debt?
Yeah, we're raising $5 billion in primary. $4 billion will be used to buy down debt to get us to 3.25, with the goal to get sub 3 over time, which we can get to pretty quickly with free cash flow generation.
Where do you see this whole healthcare debate going, and also just the strength of the consumer in this moment right now as it relates to either your own products or what you're seeing?
Listen, healthcare is going through a crisis of complexity, right? You have cuts in reimbursement, Medicare and Medicaid. The Affordable Care Act is going through some interesting kind of dynamics right now. You have shifting sites of care. The total hips, total knees, open hearts are all leaving the four walls of the hospital. They're going to the surgery center space. You have a challenge from a labor management perspective. I mean, it is a challenging space. And the way we look at it is we have to make sure we're delivering the right product to the right place at the right time at the best delivered value for our customers, to ultimately give caregivers what they need to serve patients. And we're in the boat with our customers. Our customers are struggling, and our job is to deliver solutions to value that yield better outcomes.
In terms of product, what's the highest margin product? What's the growth? What's the growth product side of this? What does the sort of portfolio look like?
Well, when you think about the products we make, exam gloves, we make 900,000 custom kits that are used both in surgery and in the nursing procedure tray. That's our largest product category. And our blended margin across all of our categories, surgical solutions, frontline care, and lab and diagnostics, are pretty consistent at that 13% EBITDA margins. When I look at the business, we're really excited about the lab and diagnostic space. It's a market that's $25 billion that we only do $1 billion in, that's ripe for disruption and opportunity for us to grow. And I look across the rest of the landscape, there's tremendous opportunity in pretty much every category we sell. Just for context, we sell exam gloves, personal protective apparel, DME, so crutches, canes, and walkers. I mean, we have a pretty robust product portfolio.
And for better or worse, healthcare is not an industry that's going away anytime soon. It is not going to be here for a very long time. I wish it was. I think we all wish it was. Yeah. Anyway, thank you for coming in. We wish you a lot of luck. We hope to follow your progress. So come on back.
Thank you very much.
Thank you.
All right, big day of breaking news on Squawk Box. The board of Warner Brothers Discovery unanimously recommended that the company goes with Netflix's bid instead of an offer from Paramount Skydance. Board Chair Samuel DiPiazza told us this morning that Paramount Skydance's offer came with risks and, in his words, was inadequate. Christopher Waller, a member of the Federal Reserve Board of Governors, said that he is not worried about inflation and believes that it will keep falling, but he was less certain about the labor market in the new year. And Morgan Stanley raising its price target on Apple from $305 to $315 a share. That stock is at $275 this morning. That's about 5% from the 52-week high that it hit earlier this month.
President Trump planning to deliver a live address to the nation from the White House tonight. It's going to happen at 9 p.m. Eastern Time. Press Secretary Caroline Leavitt saying that Trump will tout the administration's accomplishments from his first 11 months in office, as well as his plans to, quote, continue delivering for the American people over the next 3 years. So we will have a lot more on that, I'm sure, tomorrow morning.
All right, let's get one more look at the markets before we hand things over to Squawk on the Street. We've been in the green all morning long. At this point, it looks like the Dow is about its highest level of the morning. It's up by almost 100 points. The NASDAQ indicated up by about 75 points this morning. The S&P futures up by 15. Both the Dow and the S&P have been down for the last 3 sessions in a row. We'll see how things go as we get closer to the opening bell. If you've been watching the Treasury market, you'll see right now that those yields continue to be higher. The 10-year is sitting at 4.16 right now. The 2-year is actually just below 3.5%. It's sitting at 3.49. And then oil prices have been higher as President Trump and the administration continue to put pressure on Venezuela. You can see this morning the WTI is up by almost 2% to $56.34 a barrel. Crypto prices look like they have been, well, Bitcoin's a little bit higher this morning, 87,632. And then the dollar this morning, we'll let Squawk on the Street get you caught up with that. Make sure you join us tomorrow. Right now, it's time for Squawk on the Street.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Keaton here with Jim Kramer and David Faber at post 9 of the New York Stock Exchange. Futures are stabilizing after 3 straight declines for the S&P. A lot of pots boiling today, whether that's Waller in the search for a Fed chair, Warner, Oracle, biggest IPO of the year, 10-year 4.16, oil's up $1, silver 66. Our roadmap begins with no deal. Warner Brothers Discovery's board unanimously recommending shareholders reject the Paramount Skydance takeover offer. The board chair telling David, quote, it was not a hard choice.
Plus, it is the biggest IPO of the year, the largest listing in the last 4. Medline is returning to the public markets. What that means for the IPO pipeline, of course, as we head into a new year. And we are also celebrating a big anniversary right here for Squawk on the Street. They're telling me it's 20 years since our debut, amazingly enough, right here at the New York Stock Exchange. All right, let's start off, of course, with that news we got. 7 a.m. was that long-awaited filing, long in the sense of at least it's been almost 10 days, from Warner Brothers Discovery. It's a so-called 14D9, but what it really is the explanation to its shareholders as to why it said no to Paramount's all-cash $30 a share offer for the company, and yes to the $27.75 in largely cash, but also some stock to Netflix. And remember, the Netflix bid does not include the global networks business, which will trade on its own and will have some value, although frankly that is a subject of great debate and conceivably is the difference in terms of the overall view of value of some. But that was not the gating issue for the board of directors of Warner Brothers. They were very much focused on what they felt was a lack of guarantee in the financing being proposed. Not on the debt financing, but on the equity financing, some $40+ billion from Larry Ellison, from sovereign funds, including, of course, many in the Mideast, and others. And I asked the company's chairman right here on this set a couple of hours ago, what exactly was the lack of specificity in that offer that gave the board pause?
Netflix made a compelling offer. It was heavy in cash, certainty of close, a high termination fee. It had all, and they responded to the operating issues that we were concerned about. Pete Sky had every opportunity to deal with that broad range of issues, and they chose not to. And ultimately, the equity stack is always important here. And to be very direct, nowhere in any of these proposals did Larry Ellison guarantee.
And that could have potentially changed the board's decision?
Well, obviously the ability to deal directly with Larry if there was an issue to close would be critical. Otherwise, closing might not happen. And some of the proposals, and you've read them now, some of the proposals gave multiple ways for that equity stack to disappear. Now, he guaranteed it through an irrevocable trust at the last minute. And frankly, that wasn't as good as an investment-grade company that purported strong value, great response to our concerns of what it took to operate. So I have enormous respect, as does the board, for the Ellison family and for the Paramount company. They just didn't measure up on these bids.
Now, while financing was one of the key points, guys, the other, of course, was the fact that they believe that both deals face a commensurate regulatory or similar amount of scrutiny from the regulators. Many people would disagree with that, viewing Netflix as perhaps one that will take longer and get more scrutiny. But I did have a chance to speak to Greg Peters, the co-CEO of Netflix, who explained at least how they view the regulatory challenges for putting together Netflix with what is also one of the top streamers, HBO.
We look at, the market definition in a couple different ways. A key one for our side is just, who's winning TV view share? And I think if you look at that, we're way low in the rankings. We're 6th behind Google and YouTube, behind Disney, behind Comcast, NBC, Fox, Paramount. Even when we put, HBO Max and HBO on top of the Netflix viewing, that still puts us behind YouTube and Disney. So we believe there's a really good story as to why this is a deal that's good for consumers.
So there you have it, guys. Not a surprise in the sense of the rejection. And now we're going to be waiting. DiPiazza said to me the shareholder vote may not be scheduled until, he said, spring or early summer. So, Jim, that's a long time between now and then to sort of just be hanging out there. Things will likely get quite a bit quieter, given we now have gotten the main response from Warner Brothers.
It's interesting you say that, because these two interviews were fabulous and great gets. And I said, okay, it's over. And wait this long. It's over, right? I mean, you basically had interviews which indicate, unless, illusory.
Well, if Paramount comes back with a personal guarantee from Larry Ellison. Now, they claim, of course, and I want to make this clear, that what they have offered is typical of so many deals that have been done in the past, saying that this is completely customary and enforceable equity financing commitments. It's identical in all material respects to equity financing terms they had for the likes of Paramount Skydance when they did that deal. Nonetheless, if they were to come back and change the language, say it's a personal guarantee, and then raise the bid, the board would certainly be under pressure to potentially say that is a potentially superior proposal and have to go back to Netflix. Unclear whether, in fact...
We have the blueprint. You have to do a Twitter Musk.
Right, Musk personally guaranteed the Twitter deal, which is one key reason why he did complete it, despite the fact that he knew he was overpaying, Carl, way overpaying.
Right. And so we wait for spring, early summer on this vote?
I mean, conceivably, that's, kind of, the tender is not really of any consequence. You can't buy the shares. It's just sort of out there. It's really about the shareholder vote. So yeah, unless Paramount decides to try to move this clock up, or unless shareholders overwhelmingly are telling Warner Brothers along the way, there's no way we're voting in favor of your deal. But even that is going to be a ways away.
Meantime, you raised the post by the president yesterday criticizing CBS and 60 Minutes and saying that these are my friends that hate to see my enemies. That kind of points to, I guess, directionally the idea that both offers will have to fight the DOJ, as DiPiazza said.
Yeah, I think they view it as equal. I think many others don't. Peters said 12 to 18 months in terms of how they're viewing the timeline from Netflix's perspective. I think there are those who believe that is somewhat optimistic. When I did ask Peters whether in fact they would go to court if they had to do so to save the deal, he said yes. That was an important answer from his part, certainly indicating that. And by the way, they also indicated that while they're disciplined, they certainly didn't shut the door on having to raise their bid if in fact Paramount were to come back.
David, let me ask you, when you have these incredibly long interregnums, what have you seen happen in the actual acquirer? Because as far as I'm concerned, I'm taking Netflix off my screen as something I should watch for the next 6 months because they're in deal purgatory.
They are potentially in deal purgatory. We'll keep an eye on the stock price to see how it impacts. It is below the bottom of the collar. That does impact very slightly at this point, given where it is, but to some extent, the overall value of the deal by like 20 cents or something like that. But you're right. I did ask Peters, about sort of the view overall of the deal and this question that we've all been trying to entertain about Netflix, which is, aren't you putting that incredibly enviable price earnings multiple at risk? What does this say about your growth trajectory? Do we have that? Do we have that sound ready, guys? Okay, let's take a listen to what Peters had to say in answer to that.
We assumed we might come in with different perspectives on it as well. But we did the work, and really the work speaks for itself, which if you get in and you actually build the models, you understand how would these titles contribute. Again, remember, this is an exercise we do day in and day out, where we're looking at various different licensing opportunities, understanding how will titles perform on our service. So we have a very elaborate, deep understanding of how that works. And when you've got that, that model, then you do the hard work and you beat it up and you challenge yourself on all the assumptions. But when you conclude at the end of the day that there is a tremendous amount of value creation in this kind of deal for our members, the people that we serve, for the creative community as well, we look at it and we say, we're excited both to move forward.
And that also was an answer to the question that I've been hearing, that, well, Peters perhaps not as enthusiastic as Sarandos. He says no. He answered it right there.
Pretty serious.
Yeah.
And enthusiastic. Look, I just have to tell you that I'd always felt that the great reason why I like Netflix is they offer superior content at a lower price than the other guys. And David, Warner Brothers high price.
Yeah.
They're high price.
HBO. Yeah. Well, everything's gotten pretty high in terms of what you're paying for streaming these days.
But when you watch a lot of Apple Plus, it's Warner Brothers. When you watch anything, it's Warner Brothers because their studio is so great. So I understand why you would want the greatest studio in existence. But I also just say, geez, I always liked how inexpensive Netflix was. It was about taking your time. They've got more of your time each time. And then they had football and really exciting things. And then they're this.
Yeah. I know it does make you question. To your point as well, Carl, in terms of the administration and how they're going to be looking at this, and Trump at this point seems to be sort of saying either side. We should point out Jared Kushner has withdrawn. It was a $200 million equity commitment, barely moves the needle, but seen as more important than that. I'm told not to read into it too much. A distraction in part is one of the key reasons why he wanted to. A distraction not for him, but from the overall bid he felt that wasn't worthwhile. Still supportive. We'll see. Doesn't mean it puts in any danger. At least it would seem the equity commitment from the key partners in the Middle East who are contributing as much as 24 of the 40+ billion in equity, at least.
In itself is a cultural issue when it comes to Hollywood's view of outside parties investing in their industry.
Yeah.
No doubt about that.
No doubt. That said, let's not forget the Saudis are going to own Electronic Arts soon.
Right, and they but that was scary.
And by the way, that's, you know, we don't like.
Well, they're business people. When I talked to them about it, they said, listen, this is scarcity, these are great products. I said, you've been watching the shows. No, we actually do our own work.
And MBS loves video games. But no, your point's an important one. Again, this goes back to the equity financing and the concerns that the Warner Brothers board had with it, because yes, you may have others there, but their feeling was it doesn't mean that they are going to show up. And at the end of the day, who do we go to get the money if they don't? They did not feel that the Ellison Trust was enough for them to trust. There's a lot of debate about that, by the way.
Let me pose something to you. How did Larry Ellison become the key man when it came to the data center and the key man when it came to the
I was just thinking that. He's at the middle of
It
conversations.
is amazing, isn't it? Even today, with Oracle, by the way, potentially getting hit on that FT story.
Well, no kidding.
Yeah. About Blue Owl not financing a Michigan-based data center.
Look, Sam Altman is Sonny Corleone, and the war has to end among the founders.
The Wells desk just now. The limit does exist, they say, for some of these financiers. It seems to come down to financing, but they point out Owl has plenty of exposure right now. Hyperion and
Hyperion's got
they're not lean,
they're not losing it. You know, we're sending soup to people who don't feel well. I want some soup, but I have to tell you that there is without a doubt discipline coming. And it's Don Corleone just said, look, I'm going to overlook what's happened to Sonny. We can't keep spending.
But isn't that like the end of Reservoir Dogs, where you want everyone to put down the gun, but you don't want to put down your own gun?
Well, I think they all want the guns put down because their gross margins go up, and that's all they really give a damn about anyway.
Are you Mr. Pink? Who's Mr. Pink?
Why do I have to be Mr. Pink?
It's a good movie. Harvey Keitel.
He was great in that movie.
But I'm just saying,
listen, this is a key thesis you keep introducing. You started yesterday, this idea that somehow there's going to be an agreement to let's pull back a little bit.
Oh, no. Larry Ellison's not going to ruin his balance sheet. He's not. He's not ruining it for this, and he's not ruining it for that. Blue Owl, I don't know. I mean, Blue Owl, they came on. I thought they acquitted themselves quite well.
Yeah, the stock has actually rebounded from where it was
good. It was kind of like a
before we joined that day.
It was like a Jonathan Gray B-Read gambit.
But what Oracle shares, which of course we've talked about a lot, being down so substantially. In fact, below the day that it was up 36% on an incredible RPO day, where much of it, of course, was OpenAI commitments, but it is now down 43%.
Well, because it did turn out to be the one-pass option, and they're running. They're running away from this stuff. They know. Look, Oracle is a real company. Their balance sheet is not as real as some of the other. Have you looked at the balance sheet? It's rated X. It's a rated X. They still rate things.
It's still investment grade.
Yeah, but if you can sink that investment grade, if you had to play ball with Sonny, with Sam Altman.
Well, there was some reporting last night on the Q and how it includes some additional leasing commitments that were not in the earnings release.
This stuff is ending. This is all ending right now, and it's good. Because that means that Zuckerberg doesn't have to put that much. It means that Amazon doesn't have to put that. Oh, the Amazon deal. That's enough to talk about lazy Susan. Here, you take my 10 and then you give it back. I remember when I was involved with this during the street, and there was a lazy Susan deal proposed to me. I went right to my lawyer. I said, do I have to go to the Justice Department? He said, no, don't worry about Justice Department. We're already into it. You can't do these deals. These deals are not real.
So private credit starts to pull back a little bit, and then what? The commitments slow.
Yeah. Look, this is all, it's becoming sham-like, and we all know, we don't want to talk about it. In the year 2000, those of us who had to deal with these deals where it's like, here, you take this and I take that, those weren't against the law.
The circular deals. By the way, we got this one too. Now this is a.
Well, that's a solid deal. Give me $10 billion, and you know what? I'll buy your chips. Are you kidding? I really respect Amazon, and this shocks me that they even want to put up with this.
Man, you just come in here every day on fire.
Because it's got to end. Because it has to end. It has to end, or we're all fools, and we're just playing the game like they did. And it's 2000, and we're saying, hey, you know what? InfoSpace is going to a trillion partner. Well, I'm not playing that game. We want to stop this right now. And Larry Ellison knows this, and Safra Katz knows this. I don't know what OpenAI knows, but this is over. All this stuff. Amazon, come on, Brian. Come on, Andy. Don't play this game. You're real. You are serious business people.
It's moments like that that make the show so special. And it's actually a special day here at the NYC.
That escalated quickly.
Yes, I know. We are celebrating a milestone for the show. 20 years ago this week, Squawk on the Street debuted here at the Big Board. This is how it sounded on that first morning.
Coast, 6 on the West. 2 p.m. in London. I don't know what it is in Singapore. The opening bell is less than 30 minutes away. Good morning, everyone. I'm Mark Haynes. Here we are at the New York Stock Exchange, debuting a brand new program where we just walk on the street. We're going to take you right into the heart of the game. It's going to be like covering a football game while we're standing right next to the quarterback. We're not going to stand next to the linemen because they get hurt. Well, the quarterback gets hurt too, but you got a better shot back here with the quarterback. Joining me here, the newest member of the Squawk team, Erin Burnett. Delighted to be working with her. And back at CNBC Global Headquarters, a familiar face, Da Brain.
The peerless Mark Haynes. David, you were part of that original crew. Becky and I were being introduced on Squawk earlier in the morning.
Right. Yep. That was a big transition, obviously, followed by a number of others that we all know about. But
and our great friend Art, just doing perfect stuff.
I continue to be stunned by the passage of time. What can I say? And when I have to look at myself from 20 years ago. Yeah, but Mark was amazing. Interesting to note how much more crowded the floor was back then.
Yes.
Of course.
Done some good work, chopped a lot of wood since then.
You certainly have. Certainly have.
There's just a lot of this is a great place to break your news. What David did today. You think the Journal had that? The Wall Street Journal down at the Times? Remember the Times? Comes up first.
We have you.
People do that.
You escalated and now you're calm
No,
again.
I'm done with the 2000 stuff. I'm done with it. And it's just over. And we can sit here and we can just bless everything. And say, yeah, Amazon, 20 billion, Disney, we give them stock, they buy it, they take our content. I mean, or we can say, you know what, I see it. I see it. And look, I was part of it in 2000, but I hated it and I called it out then and I went to my lawyers because I thought it was illegal. I went to Paul White and said, you can't do this, right? He said, no, you can't do it. But it's done every day, and everyone's looking at each other and saying, hey, that's a good deal, it's not a good deal. I'm not in it to damn toll booth.
I hear you.
I'm not going to toll booth. Okay? Which wasn't really done.
That was Sunny. Yeah, got it.
Yes.
Sorry. I got to keep, I got to rewatch The Godfather like 10 times to keep up with you.
It was made on aircraft. It was made on a
Okay.
Yeah, it wasn't a toll booth. But I'm just saying, we have to stop. I don't want to be the guy who said it was happening right in front of me and I said nothing. And I'm not scared. I don't play for dinner. Every one of these guys is scared from. Look, I had to look under my car for a bomb for 6 months, and I was sleeping in it. I'm not scared of these guys. What are they going to do? 83-5918. That's my late mom's phone number. You call her, she'll yell at me.
We'll have a lot more on our anniversary later on this hour. Sarah's going to join us here post-9 as well. Talk about, as David said, subsequent chapters of the show. Take a look at the pre-market, little constructive tone, as we got a bunch of upgrades today, which we'll get to. Procter, Airbnb, Gap, Texas Roadhouse, and others when we return.
Welcome back to the Squawk on the Street. Time now for a mad dash. Of course, 7 minutes before we get started with trading here at the New York Stock Exchange. Let's talk a bit about Apple.
Right, okay, refreshing. Two pieces, one by Morgan Stanley, the other by Ben Reitzes at Mellius. Talking about, well, here's one, the price target is too low. That's Morgan Stanley. They are taking that up to 335 from 315.
Okay.
But the most important thing, I like Mellius, but just says, listen, you want to fade the AI? You done? Well, then buy Apple. Remember, Apple doesn't play any of these games, by the way. They have the best balance sheet I've ever seen. And they also have unbelievably fantastic CFO, as they did previously. They don't play this stuff. They just deliver great numbers. And I got to tell you, David, I think that this is the one. I still believe this is the one that's a beneficiary. You know, I think that when you look at all these different ones, there's not you know what's a commodity? ChatGPT. I mean, did you see that this morning? Musk says that his is best, the Grok and the Perplexity. I don't know how you feel about the Anthropic, and I go right now. I'm using the Gemini 3. Well, what I'm thinking is they're all just commodities. The only way you can distinguish yourself is you write Apple a check for the 1.5 billion people who use their phones, and then you're de facto. And someone better be de facto. I think it's going to be Gemini, because right now Google hasn't made a wrong move in a year.
Yeah, no, Google obviously has been the beneficiary in the stock market as well, Jim.
Oh, by the way, they don't play the...
But that said, so
Susan
instead of many who are saying they have no AI strategy, you say they're going to be a beneficiary of having no AI strategy.
David, let me tell you something. The trading desk, it's better to be lucky than good. And they're lucky because they never developed. They never spent $100 billion.
No, Siri's like in the dark ages.
You know, the other guys, they're ready to open up 3 Mile Island 2. That's how big they are. The other guys. Hey, you know what? Meltdown? So what? Get some discipline.
All right, real quick. Next year going to be better than this year? 2026 going to be better for the stock?
I sure think so, because we have a new Siri. And you know, a Siri that's really kind of more conversational.
All right.
I talked to Siri on a moment.
Opening bell just 5 minutes away, by the way. Exciting day for us right here, of course, and our entire team. We're celebrating 20 years since we debuted right here at the New York Stock Exchange.
$315 for Apple, $295.
You're watching Squawk on the Street here on CNBC Live from the New York Stock Exchange.
got the biggest IPO of the year today, the largest since Rivian back in 21. Medline raising nearly $6.3 billion in its offering, priced at 29. That's near the high end. Implies a valuation of more than $53 billion. Medical supplies firm listed on the NASDAQ under MDLN. Another important listing here at the NYSE today is Anderson Group, the tax advisory firm, which started following the collapse of the accounting side, set to begin trading under the symbol ANDG. We've had a couple hundred IPOs this year, Jim. That's up 41% year on year.
Ignited here. It's been a terrific run owned. I like the health of that market. I think this deal is a disciplined deal this morning. They're going to pay down debt. Don't worry, 6 months from now they won't look like that at all. Right now they're tax professionals.
Yeah, and then Medline, obviously a PE deal from a few years ago. They took it private.
I can't hear from them.
We'll talk more about those during the course of the day. Let's get the opening bell and the CNBC real-time exchange. The big board, as we said, it's Anderson, celebrating the IPO, and Medline, provider of medical surgical products, biggest of the year. CEO on Squawk earlier today. We got some volume in the room today, Jeff.
I like excitement and substance. This is an interesting company. I like a deal that's not priced well above and goes crazy. But it's also, let's not forget, the PE deal. They need these deals to come public, and they have to have some winners.
They do. Obviously, typically in a PE deal, you will raise money and you will pay down debt that was associated with the take private itself. It's only 4 years since they went private. A very strong deal for the sponsors, though, in terms of where it's coming public, Medline, and the valuation. And then you would monetize that over time as well once you have that public equity. But you're right. We have been waiting to see PE firms get some exits so they can start to actually put some money to work again as well, because a lot of their funds, people are saying, well, give me some, I invested 7 years ago in fund whatever, and I haven't gotten my returns yet really on it, so before I put in money in the next fund.
Yeah, and the stocks have been bad, so they need this. I mean, I think that they have been terrible investments versus Goldman, versus Citi, which has been a great investment. So it's good to see them maybe get a plus.
Yeah, we were at Goldman yesterday. They're a lead on Medline. Good. They're actually pretty constructive on next year, Jim, as they have been for most of the year. Speaking of which, December we're slightly red, and there is some chatter that if Santa's going to show, he's got limited time.
Santa's got to show real soon, like today. I mean, this is the day where Santa starts showing. I'm not going to bet against this market now. I just want to see discipline in the one aspect of the market that appalls me, which is the desire to keep the balls in the air on the $1.4 trillion commitment open out.
Now that is a long-term commitment, we should point out, that is going to stretch over many years to obviously get the compute that they need to conceivably be there.
You can't even get cement in this country. You can't get workers in this country. You're going to have trouble getting the steel in the country. But no, they're just full bore. Slow it down.
Yeah.
Slow it down.
I got no problem with that. It probably means the societal impact of AI is going to slow down a little bit.
Actually, it's Forrester has some survey data. Their view is that probably 25% of companies will delay their 26 AI spend by about a year. Either because of the financing limitations, the infrastructure limitations, the labor, the materials,
we don't have power. We don't have the ability to do it. I mean, maybe we'll be ready with quantum power by then. Maybe IBM has some quantum power.
We're going to talk to the mayor of Chandler, Arizona later today, by the way. They just killed the data center deal. The political pushback at the local level because of the strains on water and utilities.
And on the grid.
Yeah.
I mean, we're going to see, some of my favorites are going to go down, and video will go down short term. They've got plenty of business away from this, but I do think that we have to start realizing that it's pie in the sky, and then when you do these deals where you give money to one side and then they give money to the other, that is not proper. We have to start saying that so that we're not part of this morass. It just look the other way and say, yeah, Alton's really smart, he must really be doing great. We can't do that. We have to play our role. In honor of Mark Haynes, we have to play our role. We have to just say truth to power, guys, you can't do this. And you pretend it. Like, do you think that we really are that dumb? That you can give somebody $10 billion and then they'll buy your chips, and somehow that's considered to be the way business is done in our country.
Well, there's the circular nature of it. By the way, interestingly, that $100 billion investment from NVIDIA in OpenAI has never closed. It hasn't closed. We haven't even gotten a lot more details on it. And NVIDIA has done other deals since that was announced. That's an important amount of cash over time for OpenAI as well. I would point out. Obviously, OpenAI doesn't trade. We can't look at what it's doing.
They're a great company, okay? And they came up with ChatGPT. I'm not talking about whether they're great or not. I'm just saying we have to say to people at home, we're wise to this. We're wise to what's happening. You can't just be part of the giant suboptimal counting that they're doing.
Well, so then, if you're right and the build-out slows incrementally, that's going to have an impact on how far GDP's build out so far this year.
Good, it's not going to be reckless. We don't want reckless. We saw reckless in 2000. Almost wiped down a whole generation of investors. We don't want to be part of that. I know that when I was in, I felt like I was in Fox then. I felt like I had a shot to scream from the rooftops that you can't do this stuff. I didn't do it because that was not necessarily the way we worked over there. But I do think that it's time to say, you know what, this stuff, it's not possible. You can't build it. You got to pull back. You got to blink. Well, just blink. They blinked.
Well, the FT reporting they're not going to make a $10 billion commitment to an Oracle data center project in Michigan, conceivably. And Blue Owl was up on that. That said, it's not like you're still not seeing deals. HUT was a Bitcoin miner at one point. There's the story I'm referring to. They signed a new 15-year AI data center lease at Riverbend with at least 245 megawatts, $7 billion contract. Anthropic, backing by Google as the guarantor. And so you can take a look at HUT because that stock is up. So it's not like people aren't doing deals. That stock is up a lot. It's a small company. Don't get me wrong. It's a $4 billion market cap, but it's up 18%.
I'm talking about the kind of deal where I give you money and then you just turn the real lazy Susan. If people don't know what a lazy Susan is, we have one on our dining room table. It's like, hey, Mom, could you pass me the cranberry? Yes, if you pass me the turkey.
Does that mean that you would then get incrementally more cautious on CAT or GE Vernova? You will.
Not GE Vernova because we don't. They're sold out. We heard them. They're sold out. You can't get one of their gas turbines in 2030. I am incrementally negative when kind of like Jim Farley. The cleanest is not going to work anymore. And when you're opening up a nuclear power plant that was meant to be decommissioned, that is about as dumb, waste of money as possible. Just take the money and just buy a lot of trees, for heaven's sake.
You've been pretty negative on that space for a while.
Because these things are made. When you decommission your nuclear power plant, what that says is this will never be a nuclear power plant. And now you're recommissioning because you want to show that you're a good guy? No, I mean, look, I love that. It's terrific, but it's not. No, it's just not.
You mentioned Apple at the telestrator with Jim. The other part of that call, Jim, is memory forcing inflation in hardware, and they do see some risk around hardware budgets next year as a result.
Even though I thought Dell handled themselves very well in comp school, that was a mistake. HP does have some problems. I do think that tonight we'll hear Micron. I think Sandra Morota's terrific, the CEO, but it wouldn't surprise me if the stock initially opens up 10 and 14 after hours, and then does a pirouette. I don't like Broadcom. Especially if we hear that there's going to finally be something from lab research and applied materials, some way for equipment that would make it so we have to get to the equilibrium. Look at Seagate. How could Seagate and Western Digital and SanDisk be three of the top 5 companies in the S&P 500? That's just shortage. And you can pure shortage with more equipment. Look at these stocks. These are the best stocks in the S&P 500 because there's a shortage. Because no one ever thought that you would ever be able to buy these kind of hard disks and really need them. It's incredible.
Look at that. That is bananas.
That's what's winning. And those are just, they're not dumb companies. They're commodities. Except for Robinhood. Robinhood's up 50% net, 50% net.
Robinhood's had a great year. They got an announcement this morning as well, or it was actually after the close yesterday. But SanDisk is up 500% this year.
I did not know that. Hard disks. Micron is the fifth of those, and Micron has got high bandwidth memory. They've got that's a very proprietary product. And Sanjay is a total hitter, and I love the guy, but he's very cautious. And I think people who think he's going to say, you know what, this thing's going to grow the sky, have never paid a single word of attention to the way Sanjay speaks. He is not like that.
Right. Guys, coming back to our lead story this morning, I would note Warner Brothers Discovery shares, surprisingly perhaps, down about 1% after we heard from the company as to all the reasons why it rejected Paramount's $30 a share all-cash offer for the company, for the entire company, by the way. Netflix shares are up over 2% this morning. After we heard from the CEO, co-CEO Greg Peters this morning, talking about any number of things. Price discipline they've shown in the past, did not say whether in fact they would, if necessary, be willing to raise, but certainly did not say they wouldn't. And all the benefits they see from a Warner transaction as well. So interesting to note that. And then Paramount Skydance, it's a thin trade, remember, it's not a lot, so much of it's controlled by the Ellisons, but it is down. And that has continued, I think, to reflect the fears on the part of some shareholders that if they are not successful here, what do you do? What are you left with? And can you really rely on just the assets you have to deliver what you need?
Did you see Wolf wrote a report on your Comcast swap report yesterday?
I did.
And put some of the parts at either 39 or maybe 49 Comcast?
Yeah, this goes back to the report I made yesterday that Carl's referencing about Comcast unusual trading, certainly in the swaps market, indicative oftentimes of an activist in the shares. There you always have to remember you have a 33% holder in the form of the Roberts family. Vote. Not holder of economics. No, their economics are very small, but their vote is very large. And all that matters is a large, yes. It's about 0.6% of the economics. That is correct. That said, you would think that that would be something that would prevent activists from thinking they could ever really fully implement a plan that they might put forward and or bring a proxy fight, for example. Stock was up sharply yesterday, but you know what they're benefiting from, Carl, when they do the sum of the parts? They're benefiting from the multiple being put on Warner Brothers Discovery.
There's that, but even like a cable multiple, a Charter multiple on cable, or a Disney multiple on NBC, things like that.
All fair, but then you're getting this far in excess multiple now on Warner Brothers, 18 times or whatever, or 20, even higher than that, that is being applied on the overall Universal businesses that are left post-Versant leaving, and you get a price that's a lot higher, hence why the stock was up. There's a lot of frustration there on the part of shareholders. There has been a Comcast for a long period of time. We've discussed it any number of times. We want to know what the strategy will be. By the way, Comcast is in there too in this huge background we got on what Warner Brothers and all the negotiating they were doing.
Yeah.
If they had done a reverse Morris trust and loaded up leverage at the parent company, they might have been able to pull something off. They instead went with a deal that would have implied Comcast would have owned 51% of a combination of Warner Brothers and NBC Universal, which would have traded as its own entity, and they would have also added cash. Well, it was a serious proposal, but it was not one that the board thought was equal in any way to what they were getting from Paramount and, of course, ultimately Netflix.
Serious. Peters.
Greg Peters is serious, yeah.
That guy was such a hitter.
Yeah.
He was spellbound.
Yeah.
This guy's a hitter. This guy can't go away. He's not doing no lazy Susan. He's playing with real people. He's playing with real.
And we had a story yesterday about Instagram Shorts moving to television, basically, which kind of feeds the Netflix argument that, hey, we're fighting a bunch of pieces of competition for views.
I'm so into Zuckerberg, and his stock sucks here, man. I think he's a total winner. He's going to be fine. Once we get the discipline that I'm expecting, his stock is going to erupt. Because he's had to spend way too much. But that's all right. It's all coming to an end.
Well, and to Carl's point, the one that the Netflix side will make is, it's not streaming, it's just viewing. Streaming's here, viewing's here. And if you view us as just time spent viewing and TV, so to speak, then we're not in any way going to be a dominant player.
Sarah's here at Post 9 as we celebrate our show's special milestone. 20 years ago this week, Squawk on the Street did usher in the opening bell for the first time. Take a listen.
I'm here. Trading activity underway here at the New York Stock Exchange. Aaron?
All right, Mark, well, today we're watching Dow 11,000. We're getting close, folks. Last check, 10,885 for the Dow Jones Industrial Average. Keep in mind that if we hit that 11,000 11,000. It's a level we haven't seen since the beginning of 2001.
You got a problem with that?
We will leave the NASDAQ, the great unmentionable.
My theory is everyone will be so excited about having Squawk on the street down here that they'll push it to 11,000.
I think we should take full credit when it
Yes,
happens.
when it happens, we will take credit.
That's right.
Because nobody's going to give it to us if we don't take it.
I could watch those clips all day.
Does that mean we get credit for 48 hours? No, I mean, it's been, I've been on the show for 10 years, actually, which makes me the newest of the group here. I mean, what a remarkable show. What a privilege.
It's remarkable. That's what you are.
I was like so young when I started here in 2013. Unmarried, no kids.
You were like 18.
A little more information than we prefer.
I was more than 18. I was just going to say it's a privilege to be able to speak to every day 3 people who I really respect and admire and have totally different views and perspectives than I do and different backgrounds. But all of us, and this is something that Jim always says, do our homework. And I think that that's what we can bring people. It's a homework show.
A homework drive show. Like every single great professional operation, you do the homework, you win.
Yeah, but also we get the moments, you know, the market open to have the first crack at the most important stories, the biggest interviews, the memorable moments that shape the trading day and the entire agenda. That's what it is. And that's why I love it.
I remember when Sarah was at Bloomberg, and I would watch you, admittedly, instead of our network periodically, and I said to the bosses, hey, I got this person, she understands like everything, you know, like get her. And I was glad we did. You had a facility for more than just our kinds of news. You had a facility on what's going on internationally, a facility what's going on with currency. We need that.
Right?
It's true. I started out covering only currencies. 6:50 every morning.
I love that.
You know what? It's the best way to understand the markets. It's a good litmus test of the entire markets in the world. So yeah, I still love them.
Absolutely.
Let's expand it a little.
The other cool thing is sort of the things that haven't changed.
Okay, we're getting close to my low support here at 677.69. What do you got? Ooh, we're close. I got 69 right here, Randy. If it doesn't hold here, crowd's going quiet. Washboardjim looking at the calls. He just got in. Jake Paul, are you here? Oh, yes. So far, we're holding up. The crowd is going wild at the sports arena. 67769 needs to hold. $6.80 strikes. Whoa. $0.94. Okay, everybody's here at the sports arena. I really need to hold this support because this was my last one. Hurry up. Right about now. Run, dude. We're all got a little bit of leeriness in us in here. The 680 strike. At 0.92. We've got 89, you sucker. That ain't right. VWAP, VWAP, VWAP. VWAP. Okay, Jim could be done with the game right now. We're up 118, 120. We could hit the VWAP and then catapult. And I don't think we'd hold up too much at 67949. I think we'd catapult past that. Yeah, that's what I think. Now we're at 122. Make a business decision. NVIDIA, we've got a fallen wedge on AMD. We've got a little cup on NVIDIA. /ES has got the VWAP up about $11. What time is it? Oh God, 23 minutes already. There's the SPX off at 200. Oh, look at the SPX here. Today's Wednesday. This PX 6820s or the 6825s. Yeah, 6825s. There were 127. We're at the VWAP, so we're coming up to the 63. Yay. We're at the 63, so that's like an exit idea. $135. There it is, $137. I'm off to the beach. Off to the beach. You're not an idiot. Not in my trading room. Very good. Bingo. $63 in the VWAP. I mean, that's a definite profit-taking range.
Welcome to Morning Trade Live. I'm Sam by the Stock Exchange. We have plenty to hit on
Nvidia.
for the next hour. So here is a look at what is coming up. We'll gauge the health of the overall market with John Kosa from Asprey Research and examine the sector moves traders are making going into the end of the year.
So I think that was an A+ trade. I really do. I can't complain about that.
Rebounding this morning after a wobbly couple of sessions here for the major indices. We've got the S&P 500. Just a little bit of a recovery there. We're just on the high to the upside at the moment. The Dow Jones up 0.5%, and the Russell 2000 is outperforming right now, 0.6% higher. But we do have the Nasdaq continuing to remain on the back.
See that red? I don't know what that is.
Actually in technology after, of course, the later stage of the session kind of rebound that we've seen yesterday. So a little bit of a mixed picture. Still a little bit of caution out there, particularly with respect to some of the technology names, given, of course, some of the reporting we're hearing out around Oracle today with the FT, of course, around data centers. So it still looks like we have got some of these AI jitters in the market, but it looks like some rotation continuing right now into other parts of the market. Very much if you look at energy, which of course is tracking crude prices, and of course materials, industrials, healthcare, etc. So let's take a look at foreign markets. A mixed picture here. We had the Hang Seng Index up at 0.9%. We're going to get you across some of the lines coming out of China later in the show. We had a nice IPO over in Shanghai overnight. Nikkei 225 sitting up 0.3%. We've got some nice export numbers out of Japan overnight to 6.1% there for outbound shipments, beating expectations. We've got the DAX softer, but look at the FTSE 100. I believe we're on track for one of the best days in a number of months there off the back of softer inflation data, really setting us up for that BOE rate cut coming later in the week. So we have, of course, seen sterling coming off and also the gilt market, what is, of course, the British government bond yields coming lower as well. So that's something to look at this morning as we get up and running for trade today. We've got a lot of central bank action happening to cap off the week globally. Here's your futures products. We've got the 10-year yield remaining elevated here. We're at 4.16. We've had some Fed speak hitting the tape this morning. Waller out talking about inflation and soft jobs. We've got the US dollar index that's picked up right now. We're just below 98 at this stage. Gold catching a bit as well. We're at 43.72. Crude oil is a big story for us. We'll get to KG in a minute on that one. 1.3% higher. So we have rebounded off the lows that we were seeing yesterday. We're at $55 a barrel, and Bitcoin at 89,000. So just below that key 19,000 level that everybody's been watching, where it's really just been stuck. We're up 2%. So we've got green arrows across the board here for futures products. So let's get to KG on some of these top headlines and see what is driving the price action. And let's start with crude, because we of course are tracking trucks lines this morning about a blockade of these Venezuelan oil tankers. Just talk us through the significance of that story and the impact we're seeing in the market this morning, KG.
Yeah, you are seeing crude up about 1.3% so far. We actually did see a pullback here a tad bit. I mean, the supply glut narrative that's taking place in the market right now has really put a little bit more downward pressure on crude oil than the expectation that geopolitical risk or logistical risk could actually cause maybe a little bit of a disruption. But you are seeing a little bit of a bounce back at $55 level, obviously key after breaking 57.5. And this is after President Trump's comments around a blockade for these sanctioned Venezuelan tankers. Now, if you're kind of looking at marine traffic right now, I think there's between around 20 or 30 of these tankers kind of around Venezuela at the moment. So over the next couple of days, we'll see how serious this matter is going to be. We already have taken over a couple of these tankers at the moment, but is there going to be an escalation for a little bit more? Now, if you're looking at the overall production for Venezuela, they produce between 750,000 to around 950,000 barrels of oil per day. Around 80% of that's going out to China. So this will have an immediate impact on China if we do enforce this blockade. And we also do import Venezuelan oil even still right now because Chevron does have some operations within Venezuela. So could this have an immediate impact on logistics? It could. If you're looking at the longer term impacts, let's say even 1 million barrels coming offline on a global scale, especially heavy sour, there is reported capacity, especially if you're looking at OPEC Plus, to be able to compensate for that over the long term. So catching a little bit of a bid right now, but is this going to be the story that really rockets oil like $85 or $90 just based on this alone? Seems highly unlikely just given the supply fears that have been placed in the market. But once again, could be the start of a catalyst. If you do see maybe some retaliation from a country like Iran, which also will be impacted by this, and they start actually taking over tankers with a straightforward move, that's where you start seeing this escalation kind of move a little bit more, and that's where you can see prices elevated here. So geopolitical risk premium coming back into the market here doesn't seem like it's enough to really try to wake up oil, at least for the moment, but who knows, this could escalate fairly quickly.
So what's the outlook for oil then, moving into 2026, KG? Because as you say, a little bit of a geopolitical risk premium being injected into obviously markets right now. We had some softer data out of China earlier this week. That seems
Political
to
risk.
Somewhat a little bit, but obviously we continue to keep the tabs on the lines coming out of peace talks regarding Ukraine and Russia and everything else that's going on. What's your read? What's your pulse check on
It does too. It looks like it does.
Going into next year?
SPY just broke to 63.
Prices right now are pretty depressed. There's something called the crack spread, which really
And that's the first sign of bullishness. First sign is kind of creeping up on the VWAP and breaking it. Then was trending 3 black crows. Now triple top. Boom.
Looking at the equity front, you probably would see maybe a little bit more headwinds to start off the year, but we are seeing once again those byproduct prices coming down, and that could also then encourage a lot of these refiners to pull back on capacity, which could stabilize prices. Probably at first, especially in January and February, the demand picture doesn't look that great. You do have some supply side risk.
This is it right here.
The back region, maybe an Arctic blast that actually hit the United States that could push oil prices higher, but eventually a lot of these oil companies and exploration companies probably will pull back on production, tighten up supplies here a tad bit, and you could potentially see a little bit more of a rally for oil in the summer months as well as the fall months. So usually when a commodity like oil or energy uses in general
58.25.
these current levels, it's not really that hard to kind of re-rate prices higher once the supply story kind of gets fixed up here. So I would look at second half of next year oil getting a little bit more bullish than where it is right now.
Okay, and we're seeing a new come to the market today on the NASDAQ, Medline, which is certainly a fascinating story because, of course, it is in the business of medical products, which is something that we've been keeping a lot of tabs on with respect to.
So now we're under the VWAP.
Hit by tariffs over in places like China, Asia, broadly speaking.
China.
No doubt this is all
In the
part of,
video.
efforts too.
So right now we're below the VWAP and we're below the 9, so that's kind of bearish, but this could just be a little fake out.
Here in the US, I guess that's where
Usually plays out in 2 minutes, 2 to 3 minutes.
What are you seeing out there as far as this one?
Yeah, so the company has raised over $6.26 billion for this IPO. It's going to IPO on the NASDAQ, and as you talked about, it's not really a sexy name. It's nothing that's in technology or anything of that nature. It's medical supplies. If you're looking at surgical equipment, gloves within the
I'm just looking here at the history of it.
Items as well, but it has been able to raise a significant amount of
That was
cash
about
here.
3 or
It's
4
going to be able to
minutes.
Pay down maybe some existing debt.
Another 4 minutes.
Some of the infrastructure here in the United States.
3
Now, it's
minutes.
a competitive business. They do have some competitors like McKesson as well as Cardinal Health within this space, but just kind of reflects the fact that the appetite for IPOs, especially on the retail front and institutional front, is still
There's
fairly
3
healthy.
black
We've seen
crows.
some pretty large IPOs this year, and a lot of analysts are expecting that that's going to increase.
Okay,
and
the crowd's going wild here at the
increase
sports
as
arena.
next year. So let's see how this offering does take hold. It has been a couple of adjustments over the last 24 hours when it comes to this IPO. It does appear that they are expanding the amount of shares being offered, but also then kind of regulating or going to the
Make
lower
this
or middle
green.
end of the range when it comes to the pricing here. So let's see how this actually does resolve itself. It's not a technology name. I don't think the market's really expecting a 40%, 50, 60% move once the IPO hits. But this does once again kind of show that there is demand out there for raising capital. And this could also be a little bit more of an insight into the financial space as well. Goldman Sachs, those that kind of bring a lot of these IPOs to market, could actually see that deal flow increase next year. It could be a tailwind for their earnings as well.
68.25 is at $4.80.
Obviously, we know what the analysts have been saying, you know, going into this. Obviously, we know what this company is in the business of. You only have to look at the Samsung, the SK Hynix's numbers to see that, you know, we're probably...
Slash ES has 3 black crows. We have 3 black crows with a spinning top and an inverted hammer off the 200, off of the trend line.
I mean, you've got Seagate up, you've got SanDisk up over 4%. I mean, Micron is sitting at 1.4% right now. Morgan Stanley out with a really interesting note on Seagate, actually, suggesting underweight stocks with elevated memory exposure like Dell, HP, increasingly more cautious on memory exposed names. They're also talking about memory inflation becoming the key risk variable moving into 2026. You know, as we get these numbers and we think about the bigger picture now, what sort of themes we should be thinking about and how investors should be approaching this story across the whole space, what should we be watching given some of Morgan Stanley's notes out this morning?
Yeah, so memory is still a cyclical business. I think it has not been able to kind of enjoy the rally for artificial intelligence like an NVIDIA or an AMD, but now you are seeing a little bit more value being put into this sector or this industry, if you will. Going into this earnings announcement, I think what's going to be key, obviously the demand for high bandwidth memory, which has really kind of been on the forefront for Micron. Still a smaller portion of their business, but it continues to accelerate, so that would be a positive sign for them. But I think when you look at the stock price and the run-up, I think the market also kind of forgets that it is a very commoditized business. A lot of competitors within this space as well, and that could also push prices down in the longer term. Now, in the immediate term, we know that memory inflation is taking hold here. We have seen that and heard that on several different conference calls. But I'm not sure if this is going to be something that's going to last as far as a cycle for 1 year, 2 years,
it has to be now.
3 years for that matter. The last thing about Micron, do they actually have capacity to meet the demand? I think it's going to be something to watch, and I'm not sure if this is going to be a huge mover for the overall semiconductor space as a whole, though.
Okay, good to know. A tricky needle to thread with some of the demand and supply we're seeing in these chip space, but particularly with some of the memory names as well. Thanks so much for that, KG. I'll speak to you a bit later on. Coming up, we'll dive into the health of the overall market and what to expect with stocks in 2026 with John Kosa from Asbury Research. Morning Trade Live is back after this.
Boeing's up, Netflix is up, Coin is up, Mr. is up.
I'm Nicole Pedalides at the New York Stock Exchange.
Chipotle's up.
Interviews, market movers,
Why Chipotle buyback may not be enough to revive the stock.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
There's SPX.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low
right
fees.
now on the slash ES is at
Technical difficulties. Carl.
Schwab. A modern
58,
approach to
59, 40.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
back on Morning Trade Live. Warner Brothers Discovery's board has recommended shareholders reject Paramount's all-cash bid for the company, saying it believes Netflix's proposal for Warner Brothers Studio and HBO Max
No, I didn't take
is
that one.
superior of an offer. In a letter to shareholders, Warner raised concerns about the credibility of the equity offered by Paramount and added that Paramount has, quote, consistently misled Warner shareholders. Netflix is trading higher off the back of that news. We're up 2.6% right now. Warner Brothers down around 0.5%, and Paramount Skydance is really feeling it off the back of that rejection, 4.7% lower for that stock. So let's take a look at the
Always
leaderboard,
clean.
shall we? We've got Albemarle in the business of lithium rallying today off the back of these higher prices of the commodity. This coming off the back of course, China revoking some mining permits in a key producing hub over there. So we've got that up around 5.5%. And the laggards, as I mentioned, Paramount Skydance right in there, down 4.7% right now off the back of no deal there for that company. Oracle also lower today off the back of the FT reporting that $10 billion of a Michigan data center is now in limbo because of some funding perhaps stalling. We've actually seen a response out from Oracle as well regarding that, but we will be tracking that story throughout the course of the day. Joining us now is John Kosa, Portfolio Manager, Asbury Research. Very good morning to you, John. Happy holidays as we're sort of sandwiched in the middle of it. What are you seeing out there as far as your gauges, as far as the health of the market right now as we look into
Now, here's your megaphone.
Well, it's kind of an interesting situation.
Right out of that snake.
You just look at the market from a day-to-day tactical standpoint. Very short term. Our Asbury 6 is all.
This one here's kind of had some balls,
when we
but
look at the Asbury 6 as kind of a daily
I
EKG.
want to jump in there.
of the
I'm going to
market.
grab
We look
one.
at it from 6 different dimensions, if you will. We're looking at relative performance, asset flows, volatility, trading volume, market breadth, and the rate of change in the S&P 500. Kind of looking at the
Grab
market
one.
from
I'm
6
going to
different
get.
angles. They're all positive. The issues that I'm having, or the market's having,
Right
is
here.
on a relative performance basis, we're starting to lose our leadership. You're starting to see some relative weakness coming from technology, coming from small caps been all over the map, actually.
This
But
one could
you're
break out to
seeing strength coming
6,800.
out of the Dow. You're seeing weakness come out of technology. And normally when that happens, if it keeps up, it's usually the precursor to some kind of a market decline. So again, near term, day to day, we're clicking on 6 cylinders according to the A6, but there are some
Up in this area.
There are some warning signals out there.
Yeah, I mean, this particular chart sort of suggests that we could be in for a bit of a Santa Claus rally. I mean, you've got positive as of, as you say, the most recent gauge that you're seeing, all in the green here. But to your point, we're seeing that change in leadership. We are very much seeing that rotation out of some of the high-flying AI names into other parts of the market. And so what are you seeing very much more sort of a sectoral trend right now as we head into the end of the year?
Well, I think we have to keep in mind that the
Here we
market's been
go.
going sideways. The market being the S&P 500, it's been going sideways for a couple of months. Here we're looking at sectors. You've seen a lot of very rapid
6825s.
sector rotation this year, which is atypical. It doesn't usually. The sector rotation is a little bit more stable. It hasn't been this year. Right now, our CEF model, which is sector ETF asset flows, is what CEF stands for. It measures the velocity of money moving around the 11 sectors of the S&P 500, according to the sector spiders, in 3 different time frames. And industrials, technology, and healthcare right now are the top 3. Industrials has been the 3rd best for the year, and technology has been the 1st best for the year, year to date. Both outright and versus the S&P 500. So that's where the money is going right now. But again, with all the uncertainty that's out there, tariffs, are they in? Are they out? Are we going to have an independent Fed next year? Interest rates have been quietly rising here. The yield of the 30-year is up as high as it's been from back in September. So again, if you're looking at the market kind of under the hood, so to speak, there are some indications. You could see value's been outperforming growth now for the past several weeks. But until the Asbury 6 turns to red and indicates to us that the day-to-day tactical part of the market is starting to weaken. I don't think it's actionable yet.
Yeah, look, I think we can take perhaps some comfort. That's at least what I'm hearing out there in the fact that this is a rotation into other parts of the market. As you say, industrials, healthcare catching a bit right now. I mean, even some of the small caps. I mean, you know, particularly if you look at some of those stocks in the business of things like quantum computing, which have gone from small caps to mid caps in a very short period of time. Yeah, you mentioned growth v value, obviously cyclicals v defensive as well. What levels are you watching into year end? What's key to look out for right now?
Yeah, I think the levels are particularly important right now as we're looking at the S&P 500 because it's very obvious. There's basically 3 levels to watch. The first one is 67.70 and
68.25s.
We've been down there earlier this week. It held. That's a minor level. The 2 big levels that are really important is 69.20. Here we go. You can see 69.20 up at the top of the screen up to the right, and 7,000 is a big psychological level. So everybody likes those big fat numbers, especially when we're at all-time highs. That's about 2% higher than we are right now. 65.69 to 65.51 are the lows from the middle of September and middle of October, and where the market stopped on a dime, where the S&P 500 stopped on a dime on November 20th and 21st and rocketed right back up to the top of the range. So really simple. There's no ambiguity about where the levels are. It's just a matter of which way we break out of this place that we've been in for a couple of months. And again, I think these relative performance relationships are going to be a huge part of that. If the Dow keeps outperforming the S&P, if large cap technology keeps underperforming the S&P, if value keeps outperforming the market, value keeps outperforming growth, that tells me that internally the market is starting to lose its appetite for risk, and ultimately that's going to mean we probably are going to have some kind of a correction early part of the first quarter, if all that stays the same.
Okay, something to watch. John, always appreciate your time. Thank you so much for your insights today. And if I don't see you or speak to you again, have a happy holiday. Thanks for all your help this year. John Costa, Portfolio Manager at Free Research. Coming up, we'll get a closer look at the big picture with the team from Charles Schwab. Morning Trade Line. We'll be right back.
Nvidia. Say it.
I'm Diane King Hall, on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
How's it going? First day, so sometimes you know. Next. Try it again. You could have done better. Please. Same goes for where you invest. Level up and invest.
Uh-oh. Uh-oh. What happened? Ladies and gentlemen, he did it again. How in there? How does he do it?
And access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Welcome back to Morning Trade Live. It's time now the big picture, so let's welcome in the team from Charles Schwab. We've got Joe Mazzola, head trading derivatives strategist at Charles Schwab, and Kathy Jones, chief fixed income strategist at Schwab Center for Financial Research. Joe, let's just start with you. Obviously, we're back to seeing
540.
rotation in this market out of some of the technology names, which did actually stage a late-day recovery yesterday, but we're back to that sort of prevailing narrative that we had been seeing over the last course of a couple of weeks as that steam comes out of some of these high-flying tech names. What do you make of it?
Well, I think it puts a lot more of onus on Micron to deliver tonight. I mean, if you look at kind of what the market's done post-Oracle and Broadcom last week, it's been a lot of choppy trading. And so what we've seen specifically in the technology sector is that there's been, as you mentioned, Sam, kind of that rotation. Who's benefited? It's been the cyclical names, it's been financials, it's been industrials, it's been discretionary. That's where we're starting to see a lot of that investor flow. And I think Kat, you probably talked to rates a little bit, but I mean just the steepening of the yield curve. What what is interesting is that when you look at the breadth, there's been some constructive work underneath the surface. And what I think is really kind of fascinating is that you can continue to have a market that, let's be honest, it's chopping. It's it is consolidating a bit. It's not setting new highs, but it's holding up in the face of some weakness in technology. So I think that's
yes, I saw.
And Kathy, as Joe mentioned there, obviously we've had a lot of guests coming on saying that they do see opportunities in financials because of that steepening yield curve. What are you seeing out there right now?
Randy.
Relatively quiet, but as Joe mentioned, the steepening of the yield curve is the dominant trend, and we think that will continue. It's been the dominant trend for quite some time. So we have a likelihood of a couple of Fed rate cuts. I think the market is currently pricing in 2 more into 2026. We'll see how that plays out. But at the long end,
Okay, you're at the bottom again.
Higher and higher supply due to rising deficits. You have rising global yields in many developed market countries. Japan's marching on its way to 2% for the first time in decades. Some uncertainty about the trend in inflation, whether it will turn lower.
$3.60.
The steeper yield curve, and we think that that continues. Now it's a pretty quiet market. Now we're kind of in the holiday period, so I don't expect a lot of fireworks here. And a lot of focus will probably be on who's going to be running the Fed come mid-2026.
I will be.
Oh, absolutely. And obviously, there's been a lot of conversations.
Absolutely.
We're now seeing reports out of the Wall Street Journal that potentially Waller is being considered too as far as an interview. So it's not just for Kevin's. John, let's just get back to you. I mean, what sort of levels are you looking at? What are the technicals suggesting to you? Because everybody's sort of wanting to know whether we're going to or not going to get this sort of Santa rally come next week.
Yeah, we really haven't had it, have we? Basically, if you look at the S&P 500 overall, it's down a little over 1% month to day, where the equal weight, right? This is the rotation that we're talking about. The equal weight's actually up, so you got a little spread there. I think what's been interesting to me is just the change in kind of the market dynamics intraday, right? The futures have been. We've had a couple days where we've had some strong futures movements overnight. Just haven't had the follow through during the day, and then you'll get some of this midday grind, and then a rally into the close like we saw yesterday. But still down. When I look at kind of the overall technicals, a couple things that I'm paying attention to right now. You've got an RSI that's showing some weakening. You have trend strength based on the ADX. It's really just showing it's kind of vacillating. There's not much trend strength, and once again kind of feeding into that consolidating theme. And then I would say the last thing is that when you're looking at kind of where we're sitting right now at the 50-day moving average, the market's just really trying to figure out what it wants to do. And
It wants to break out.
from a bull and a bear case at this point in terms of direction. But kind of going back to the bond yields, I think as long as we continue to see that bond yield volatility abate, right, kind of stay within a fairly shallow range, which we've seen recently, I think that provides a pretty good backdrop for equities, and I think you might start to see some of that rotation back into tech if that doesn't occur.
And Kathy, obviously today we are sort of sandwiched between
Boom, baby.
prints as far as economic updates here. We got the jobs data yesterday, which looked a big mix. Retail
They did it my way.
depending on where you're looking. And then obviously we've got some inflation out tomorrow. What are you looking out for?
Megaphone.
What have you made of the data so far?
Well, it's pretty clear that the labor market is softening. It's
Yeah.
actually kind of stalled and has been stalled for quite some time. It doesn't mean it's deteriorating rapidly, but it is deteriorating slowly, and that's certainly a consideration for the Fed. I think that keeps 1 or 2 more rate cuts in play for the Fed. And we also saw a little bit of easing in wage growth, so that also
$4.90.
rate cuts in play. But it's a mixed bag.
You know what I'm saying?
Really having solid data. We'll see what the
$4.90.
tell us. But again, the Bureau of Labor Statistics is just really getting back up to speed, and the problem is that inflation has remained sticky near that 3% area. If it starts to trend down in a steady fashion, month after month, then I think the market will be pleased with that, and we'll see a little bit of a
How's he
decline in
doing?
yields. But as long as it remains sticky near 3%, I think it's very hard for long-term yields to come down or to consider that the Fed might cut rapidly.
We had Waller this morning talking about how he's not so worried about inflation, but very much more about the softer jobs market. So he's also assessing, just how much of this has been sort of taken away by AI. They're still trying to get to the bottom of that. But guys, thank you so much for helping me out today. Really appreciate your insights. So John
How he does it.
trading derivative strategist at Charles Schwab, and Kathy Jones, chief fixed income strategist at Schwab Center for Financial Research. Coming up, it's time for the morning trade, and we'll take a closer look at Lennar. After this earnings report. Morning Trade Line will be right back.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the CBOE, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head
Boom,
over to
boom.
schwab.com/coaching and start learning today.
It's going to tell us if we're bullish or bearish. Right here.
This is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right where it counts.
We're back on Morning Trade Line. Let's focus on home builders now. Lennar is lower this morning after reporting earnings, and here is some of what the other home builder stocks are doing today off the back of that. So as you can see, the most pronounced losses being felt by Lennar as it gets punished off the back of this earnings report. We'll get to that and the specifics in a second. KB Home is down fractionally, and so is Pulte Group, but Toll Brothers actually is a little bright spot here, sitting up at 1.5%, remembering it reported earnings last week as well. So we're seeing a mixed picture across the space, but Lennar very much is the focus of the morning trade. So let's get to Marley.
So we're back down here. Should I do it or should I have lunch?
It's not a great look for the sector, but I suppose no surprises that
That's the question.
difficult time, but there are some more sort of company-specific issues and challenges here, Marley. Talk us through the report.
We didn't hold that 200 like I wanted.
More than 4% following this earnings miss. It was a bit of a mixed report, though, Sam. The company said the housing market remained challenged during the quarter, despite seeing interest rates move slightly lower during the same quarter. The home builder cited things like affordability concerns, weak consumer confidence, and the government shutdown as reasons for that mixed quarter. Now, their profits decreased to $1.93 per share. That was down from $4.06 a year earlier. Revenue did come in slightly better than expected, though. Like I said, it was a mixed quarter at $9.4 billion, but it did decline from $9.9 billion in the year-ago quarter. This is a part of an effort that they did to maintain their sales momentum. They offered incentives. We've had lots of conversations about these builders offering incentives like mortgage rate buy downs. Lennar doing the same thing. This did lead to a 4% uptick in home deliveries, but it did drop the average sales price of their home to $386,000 for the quarter. That was down from $430,000. Lennar also reduced its starts and its sales pace as a part of a recent strategy shift to try to help boost sales. Their CEO is saying that affordability and consumer confidence have remained challenging as interest rates moderated, but we have focused on adapting to a new normal as the housing market finds its footing. Now, another drawdown here, another reason we're seeing a decline, particularly for Lennar, this Lennar specific, is that their forecast for quarterly home sales for this quarter also missed estimates. The company now projects between 18 and 19,000 signed contracts for its fiscal first quarter. Analysts had expected more than 20,000 for that number. The company also guiding for yet another decrease in sales price between 365 and 375,000 and gross margins of 15 to 16%. So those issues specific to Lennar, that's why we're seeing the biggest move to the downside for them today. But it's no secret to anyone that the housing market has been struggling to find its footing, that it's stagnating, and that a lot of would-be buyers are stepping back and sellers are pulling their homes off the markets.
Yeah, I mean, we know, of course, about the challenges in the home market right now. I suppose some of these numbers speak to that. Thanks so much for getting us across the report. As you say, Lennar down 4.4% right now. So let's trade it now with Scotty Bauer, CEO of Prosper Trading Academy. How are you approaching your example trade for this name, Scott?
I actually think this report is much worse than what Marley was just talking about. And given the backdrop, given the landscape of rates, that the fact that housing prices are not coming down, I think home builders in general are in a world of hurt right now, and I did not like what I saw out of Lennar. So I'm actually buying just straight puts on this right now. And I'm going out just a few weeks, about 3 weeks, first week of January 2nd, I'm buying 110 straight puts. I'm looking to pay about $1.50 for those. I think we're going to see this stock continue to drift down over the next several weeks. And you know what? If we do, maybe I'll sell some other puts against it, or I'll hedge the position or roll it out. But I think this is just maybe.
Oh, nice.
I don't want to say the beginning, but I think this is the start of a protracted downswing in many of the home builders.
Yeah, and you wonder how it's just going to get better for these guys because, obviously offering these incentives to try to get people off the sidelines is chipping away at margins. But then you've got the other story of what's going on in this so-called bull commodity market where you've got copper prices going up, you've got aluminum, or aluminum as you guys like to call it, silver, all these things going up as well. You wonder how much of these input prices are going to start chipping away at profits too. So something to keep an eye on, but just want to get your overall thoughts on the market action.
It's interesting.
Obviously, we're seeing a bit of a mixed picture. We're back to this sort of prevailing story we were talking about at the start of the week, with respect to this rotation out of tech into other parts of the market. What do you make of it?
You know, it's a tough read, honestly. I was down on the CBOE trading floor all day yesterday. Even when S&Ps were down at their low of the day, we saw just a slight uptick in the VIX, not a lot of concern. I think there's too much complacency right now, but a lot of that.
Yeah, there is.
The time of the year, and B, catch up on all these data points we're getting. The market didn't really move on the jobs numbers yesterday. We're going to get the inflation numbers, which I think are going to be more market moving than what we saw yesterday. I would say that there's a lot of caution, but a lot of cautious optimism out there right now.
Yeah, cautious optimism. I heard that one. Very much seems to be the case right now. Scott, always appreciated
Interesting.
today. Double trade for Lennar and your perspective on the market. Scott Bauer, CEO of Prosper Trading Academy. Coming up, we'll take a closer look at the global central banks set to announce their rate decisions later this week and what's on tap for China in 2026. Morning Trade Line is back after this.
Morning movers, be the first to find out what's shaping early market action. Check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and
This support right here's got to hold.
8 a.m. Eastern, only on Schwab Network.
Is anybody in this trade?
Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are.
JM needs to hold right here.
Live from Chicago, this is is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Morning Trade Live. I'm Sam Barnes, coming to you live from the floor of the New York Stock Exchange. Joining us now, very pleased to say, is Andrew Cayley, Director of International Trading at Charles Schwab. Thanks so much for joining me today, Andrew. I just want to start with China, because of course this is a region where you and I have spent a lot of time. We saw a rally, to say the least, for one of its IPOs last night, a Chinese chip company that's trying to sort of fill the void left by NVIDIA, 700% in its debut. We've seen the Shanghai Composite outperforming the S&P 500 this year. So things are going pretty well on the AI front. However, we've got some pretty dismal numbers out this week as far as how the economy is holding up. I mean, the internals look very weak, and now you've got these headlines about how China bunker is circling the drain. What is going on? Talk to me about this bifurcation you're seeing between what is happening in the stock market and what is happening in the economy, and how investors should be paying attention to that.
Hey, good morning, Sam. Good to be here with you. You're right. It's kind of like a story we've seen all around the world. You could call it the K-shaped economy, where some areas are doing outstandingly well, some areas are not. China's no different. The property sector, this story actually isn't terribly new. It's been under pressure for many years now. And the challenge in China is that most of the Chinese people, homeowners, their wealth is tied up in their property that they own. And so when they see these property developers either defaulting or threatening default, that puts a lot of pressure on the valuations of their homes. So it's not terribly surprising to see a pullback in that consumer spending. So, the economy is struggling on that front. However, the tariffs have been the story for 2025 in China, and we haven't seen...
These are at 190 now, 185.
This year. Any kind of exports that were destined for the U.S. that might have gotten rerouted, they've diversified in their export business.
Spy, I got a couple more bucks.
Overall in 2025. So it's been, actually a pretty good year for overall Chinese stocks. And indeed, the Hang Seng is up almost 30% in 2025 alone, making it one of the best performing markets in the year. So, it's just something that...
SPX is real close.
Because there are figures, internal economic figures in China that are pointing to potential need for more stimulus, as the current stimulus measures do have a cap. So it'll be interesting to see if the government will accept a 3.5% GDP growth when their target is around 6%, or step in to support the economy a little bit more with more stimulus.
Yeah, I mean, they're holding up for now, as you say, running at a more than $1 trillion trade surplus, and yet people are talking about letting the yuan appreciate. That's the head-scratcher here, I suppose, but you and I can talk about that at another time. Let's switch gears to what's happening over in Europe right now. We got some inflation numbers out of the UK last night. I mean, at least it's confirming what the BOE is going to come do next, particularly off the back of its GDP numbers and also its unemployment rate earlier this week. How are you looking at where other central banks are up to? So do you believe that the BOE is now finished after what we see coming this week?
It's a good question. Listen, I think we have a much clearer picture after the inflation print this morning. The challenge the BOE was facing was if that inflation number was a little stubbornly elevated, because they do have a similar dual mandate than the Fed, of course, is to keep inflation in line, but also support employment with the lowest unemployment rate, or sorry, the highest unemployment rate since the start of 2021, plus a weak wage growth. The BOE needs to balance their rate policy with that.
6.8, 6.7, 6.818.
We'll see a rate cut tomorrow. I think, like you said, the challenge here now is with the prediction for 2026. What does that rate environment look like? Does
6.7, 6.818.
have the ammo he needs to
Here we go.
support the economy in 2026?
Jimmy says here.
What we're looking at with our client's doing is we haven't seen increased pound-denominated equity exposure yet. If the market is anticipating significant or even future rate cuts,
Jimmy says here,
more in 2026, I would expect to see more buying uptick shortly. We haven't seen that yet. We'll keep an eye on it in January and February.
And just quickly,
the 6800s.
I mean, there seems to be some expectations that Dr.
No.
sit on their hands, but there's also been some, at least, pricing in. I mean, it's not consensus, but it seems to be sort of gaining some traction, speculation that they could even be talking about hikes on the cards next year. What's your outlook there?
Yeah, indeed. I mean, well, so it's a different situation, starting point for the ECB with a target rate at 2% versus BOEs at 4%. They don't have much room to go any lower. So you're right, there is talk about, if you look at some of the forward swaps, prediction markets pricing in around...
We want this to hold at $5, please.
In 2026, which is not terribly concerning for markets. I mean, it's kind of a German-led market in the Eurozone there, but they performed pretty well 2025, and it's looking like there is ammo or a need, indeed, for a rate hike to keep things stabilized in the Eurozone.
Oh.
Andrew, always appreciate your
Damn.
perspective in your lens. Thank you so much for joining us today, getting us across some of those key stories internationally. Andrew Cayley, Director of International Trading at Schwab. Let's widen our scope now and take a look at global markets. As we mentioned, the London FTSE on track for its best day in 8 months thanks to interest rate sensitive financial and property stocks. The rally following cooling inflation data in November. British consumer prices rising 3.2%.
$5.
That's the lowest since March. The numbers are helping reinforce those expectations as we just discussed. The BOE will cut rates at its last meeting of the year tomorrow as growth stalls and unemployment picks up. The pound and British yields falling across the board. Another stunning chip company debut over in China overnight. Shares of MetaX integrated circuits are soaring nearly 700% in Shanghai. The company raising almost $600 million in its IPO. Shares were priced at 104 yuan and closed at 829. MetaX makes GPUs for AI applications and is seen as one of the local replacements to fill the void left by NVIDIA. Earlier this month, remember, shares in Morthrin skyrocketed more than 400% on its debut as well. Now, lithium prices are also jumping after China revoked mining licenses at one of its major producing hubs. The licenses had already expired some more than 10 years ago and didn't cover operating mines. Analysts do say that the cancellations shouldn't have a big impact on supply, but still the news has caused some concern in the market, sending prices higher. And of course, as we've mentioned, we're seeing lithium stocks higher in the US today as well. Take a look at those names. Coming up, it's time for Inside Out. We'll take a closer look at
This is real tight.
earnings and bring you into Apple Trade when Morning Trade Live returns.
Hey, investors, you know the market moves. And Schwab is here to help you.
6,800
So,
at
whether you're
$5.
buying, selling, holding, or planning, whether you're ETFing or 401k, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be short to near-term catalysts.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab
580 here.
is right for you.
590.
Are you a long-term investor? Our investing webcast series
So as you run into the 9, that's the next idea.
including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
$6.10.
in-depth, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
We're back on Morning Trade Live. Micron will be in focus this afternoon when it reports earnings after the close. Analysts are expecting adjusted EPS of
Micron tonight.
on revenue of $12.72 billion. Shares are up more than 160% so far in 2025 as memory stocks have rallied. Not as much as the others. It's actually underperformed compared to some of the competitive names. So let's go inside out on Micron ahead of earnings. So joining us now is Matthew Bryson, Senior Vice President, Equity Research, Wedbush Securities. Very good morning to you, Matt. What are your expectations for Micron this afternoon? I mean, does this move the needle?
It very well could. So I think it's very clear that memory pricing has been better than they expected when they set out expectations. I think that my numbers and the street have moved to the high end of what the market guidance was. If there's a question, it's more, are they more conservative and maybe some of that upside to show up later in their guide? Or do they guide what pricing really is? Because my sense is pricing in Q4 for DRAM is up 30 some odd plus percent. And so that should put numbers well above where anyone has them.
Yes, I see that you've got a price target of $300 and outperform rating on the shares that you've got a note out talking about how good can it get for this company. You know, I was having an interesting conversation with Kevin Green, our colleague here, earlier in the show, talking about whether they have enough capacity to meet demand. I mean, how much of that do you think is going to be a big focus of the call?
I think it certainly will be a focus. I don't think right now, with how demand looks, that Micron or the memory complex have enough capacity in either DRAM or NAND. And historically, that always creates pricing increases and really good results for the DRAM makers, and they tend to surprise the upside.
Right. And I mean, you know, to your point, the sort of title of your note here, how good can it get? I mean, how good can it get? Because obviously we've seen this, you know, stunning rally for a number of these names. But how long can it last, I suppose, is the big question.
Yeah, so I think there's two things to think about. One is that in terms of where street numbers are, they're kind of close to the last peak in 2018. If you think about gross margins, just back in 2018, Micron was the worst vendor in terms of how.
Ooh, drama.
Now they're kind of at the top of the pack, and if you looked at where the top of the pack was, it was about 1,000 basis points better than what Micron was back in 2018. So I think things can get above where buy-side expectations are. That gets to your second question, which is, you know, how long can this last? Can it get us there? And I think as long as demand remains solid, that we continue to see prices move higher because there just isn't more supply. The memory makers haven't invested in fabs, so they just don't have space. They have to go out and build new buildings, and that's a 2-year process.
And so what does that mean for, you know, the story moving into 2026? Because this has obviously been one of some fairly solid demand, which is tightness of supplies, has driven up those prices as well. But, you know, you've got a lot of conversation now around, you know, memory inflation, which no doubt will be good for some of these names. But then, you know, some of the analysts turning a little bit more sort of cautious on some of the hardware names as a result of that as well. Do you continue to see that bifurcation happening?
I think it continues to happen. So what we're seeing is the data center sucking all the oxygen out of the room. As long as data center remains strong, we're going to see a memory shortage. And yes, that does create some problems for, say, PC vendors, for handset vendors, because they lose out as the cloud, the data center builders take all the memory. But I mean, that's a good place for memory vendors. It's just not great to be a PC maker.
Yeah, no, it seems like it, particularly when you take a look at some of the analysts' notes out regarding, the Dells, etc. of the world. This could be a problem for them moving down the road. But Matthew, always appreciate your insight. Thanks for the setup and helping us unpack Micron ahead of these earnings. Matthew Bryson, Senior Vice President, Equity Research at Washboardjim Securities. Let's trade now with Tom White, host of Fast Market, and an example trade for us this morning for Micron.
Yeah, Sam, implied volatility levels pretty elevated going into this report, even though we've seen that over 170% gain so far this year. It's pulled back about 13% from those all-time highs that we had earlier in the month. So expectations really high on this one. So I looked a little bit more conservative in this high-price stock, where I can still take a directional bias. In this case, I'm going to do a neutral to bullish type of example trade, but I'm taking advantage of that higher implied volatility while giving myself better probabilities of success. So looking at that D19, the monthly options have expired in just 2 days. I'm going to sell an out of the money put vertical for that neutral to bullish stance, sell the 220 strike put, and then against it, we're going to buy the 210 strike put. So a short $10 wide, neutral to bullish, put vertical. It's almost like don't be a hero type of trade, right? I can still be bullish on this name, but it's run up so far so fast. Why not be a little bit more conservative about it? If I collect about a $3 credit on it, it's probably trading closer to $3.50 right now because the stock has pulled back. The stock was up over 2% earlier in the session, but the pullback at the overall market. But if I collect the $3 credit, that's what I can make, right? $300 per spread with $700 in risk. But that's all the way below 210. The option market pricing in about a plus or minus $20 move in the shares either way. That's over 8%. In either direction, so implied volatility relatively elevated at this point. If I collect that $3 credit, it takes my break even down to 217 to the downside. That's nearly 5% below the current share price. So there's that cushion that I'm giving myself on this high probability trade. Stock goes higher, stock consolidates right here, or even goes lower but remains above 217. You can be profitable on this short-term neutral to bullish put vertical.
Yeah, it's not the only thing that's pulled back. Just looking across a number of key names, it looks like a lot of the market has rolled over now, Tom. Thanks for highlighting that and your example trade for Micron ahead of these earnings. And let's just get a quick snapshot of what is going on in these markets right now. Because as I said, we have taken
rolled over, he said. She said.
Some of the technology names right now. We're down 1.3% on the NASDAQ. We've got NVIDIA lower by about 3% as we stand. And we've got the Russell 2000, which is also dipped below the line too. So we are seeing red arrows across the board after a bit of a quiet start to the day. S&P 500 down 0.7% right now. Thanks for joining us here at Morning Trade Line.
Tesla, yesterday's low after hours.
In the Apple App Store, we have Trading 360 coming up next with Marley Caden.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way you're going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen,
anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Good morning. We're 90 minutes into the trading day. Welcome to Trading 360. I'm Marley Caden, coming to you live from our Chicago headquarters. Here's what we have coming up in today's show for you in our 360 Spotlight. We'll take a look at tech in 2025, and we'll look ahead at trends that you might want to monitor in 2026. Then Micron reports its earnings after the closing bell today. We'll give you a preview of what to expect, as well as an example trade in our Disruptor segment. Then in our 360 round, we'll highlight home builders as Lennar is down more than 4% this morning, and talk about the state of the housing market. Before we get to that and more top stories, though, let's take a look at how the markets are faring so far this morning. We are in the red, pretty significantly in the red here. The S&P trading down about 0.7%, 67.50, 345 right now. The Nasdaq down 1.25%, 24.8, 26.87, dragged down by Nvidia. I'm seeing down close to 3.5% right now. The Dow trading down 0.2% at 48.25.63 right now, and the Russell 2000 down almost 0.3% at 25.12.32. Checking in on the 10-year, mostly unchanged, but at 4.15 right now. The dollar slightly higher at 97.91. Gold also rising up about 0.75% at 43.63.60. Crude oil on the rise as well, up almost 1.5%, but still 55.92 a barrel. And Bitcoin under some pressure again today, down close to 0.75% at 87,165. I do want to get to one of our top headlines today. Bringing our first guest, Alex Coffey, co-host of Next Gen Investing, joining us this morning to talk about Warner Brothers Discovery. We've gotten an update here in the latest in this hostile bid takeover option for Paramount Skydance, and the board is making a unanimous recommendation.
Yeah, so a lot's going on here, and ultimately it's going to come down to what shareholders want. So the board is recommending against Paramount in favor of the deal that was approved with Netflix from a board standpoint. But ultimately, as analysts point out, this is going to come down to what shareholders vote on, and that's still probably months away, and then you got regulatory hurdles as well. But what we found out today, Warner Brothers Discovery's board is advising its shareholders to reject a hostile takeover bid by Paramount Skydance in favor of its original agreement with Netflix. Since this has happened, Paramount has come out reiterating their $30 offer per share with a statement from Paramount Chief Executive Officer David Ellison. Our proposal clearly offers WBD shareholders superior value and certainty, a clear path to close, and does not leave them with a heavily indebted subscale linear business. Again, it's going to come down to what shareholders want, but as the board points out, there are some questions around the financing. There are some concerns around paying the breakup fee if they were to now break that agreement with Netflix. Of course, if you are a shareholder, the total deal value does show a difference between the Paramount and Netflix, but Netflix is just buying sort of the streaming and IP. It's not touching the linear cable, so there's potential value that could still be unlocked there. Best way to say this is it's going to come down to the vote. It's going to come down to regulators. But as part of the financing from Paramount, there are some sovereign wealth funds out of the Middle East involved, and we know with the China scrutiny re TikTok, you could also see similar concerns come out of Washington with some of that Middle Eastern financing as well, with potential ties to a deal. So there's just a lot of question marks. There's no clear answer, but at least in the minds of WBD's board, it's the Netflix deal.
Yeah, and it's interesting that they came out unanimously and said that they wanted them to reject it. They all agreed. It's important to bring up that apples to oranges comparison that you brought up. The offers are not comparable because one is for the entire business, one is for a portion. But interesting, the other headlines, the New York Times reporting that they believe the Ellisons misled them throughout the process, and they're saying things like there are significant risks and costs for the company with the Paramount Skydance deal. Despite that, we're seeing P Sky up about 8.5% today.
Yeah, and it's this idea of a backstop from the Ellison family, of which that might be what they felt was being let on in sort of the public, but the reality of the deal doesn't really have those kind of backstops in place. And so this is a back and forth. I don't think this is the final headline. Even in the back and forth, some analysts suggesting maybe do an auction. Maybe both of them will end up raising their bids as a result, which would be a win for shareholders in the end too. So fluid situation. Concerns around the financing, but then also potentially a premium value. So it comes down to what shareholders are going to want in the end.
Certainly, and a great breakdown there, Alex. Thank you for that. Guests we've talked to on this show have said it could be 12 to 18 months before we actually get any sort of answer on who the winning bidder will be, and if it's even either of the players we're talking about right now. But thanks to Alex Coffey, our senior equities contributor here on the network. I do want to welcome in our next guest, though, to talk more broadly about the market action we're seeing as we head into the end of the year. Joining us this morning is Ed Siddell, the CEO and Chief Investment Advisor at EGSI Financial. Ed, great to have you with us. Pretty significant sea of red across the board today. We did get some delayed eco data yesterday. I'd love to get your thoughts on the action we've seen so far and the data we received yesterday.
Yeah, absolutely. I think we're going to continue to see volatility throughout the rest of the year. We're really not expecting a big pullback until after the first of the year, and we are expecting a pullback probably even entering, correction territory. But as far as the economic numbers are concerned, the jobs numbers, we like those. As far as the unemployment numbers being as high as they've been over the last 4 years, we're really not that concerned with it. Believe it or not, we're very optimistic as it relates to the economy, because you really have to read between the lines as it relates to the unemployment numbers. When you look at that, the participation rate has actually increased, and so that's adding to those numbers. But really, 4.6% is still really good as it relates to unemployment. The other thing that we really have to look at is the jobs that are being added are in the private sector. They're really not government jobs. And so this adds to the supply side economy and pure capitalism. So that's exciting as it relates to the economy and markets going forward. And I know as it relates to consumer sentiment, the surveys are showing that consumer sentiment is down, but if you look at the impact on Black Friday and Cyber Monday, people, they vote with their wallets and they also react with their wallets. And so those were record high spend days for retail. So even though the retail numbers are delayed, really what that's saying is people are more positive about the economy than really what they're saying and responding. So our outlook is very good for 2026.
Retail commentary. We got the delayed October retail data, which of course doesn't include any of the Cyber Week spending data, which we've gotten from other sources thus far. It was mostly flat for October, but you say that the spending data should be trusted more than sentiment right now. Walk me through that thesis. And I know we had strong sales through Cyber Week, but also some of the analysts we're speaking to about that saying that they are expecting a softer holiday year this year.
Well, I think I would disagree. If you really look at the spend on Black Friday and Cyber Monday, again, these were record-breaking days based on the data that we have so far. And if people are really concerned about the economy, they're not going to spend. I think what people are looking at is the impact based on the new tax bill going forward. They're going to have larger net checks starting in January. So even though the tax bill was effective January 1st of 2025, we all have to remember the software, the IRS and everything, it was still adding tips in. And so for taxes on tips and on overtime. So the refunds are going to be much larger than they normally are, number one. Number two,
let's hope so.
The net checks, the cash flow is going to be much greater starting in January going forward. And that's really going to add to consumer confidence. We also have to add in the cost of fuel and gas actually coming down significantly, and that adds to cash flow. So all of these things going forward, I think that's going to lend to a good year in 2026.
And I'd love to get your thoughts too on the spending and who's doing it. Is it the higher income consumer who's doing more of the spending here, or do you think it's more broad-based than some of the data points?
I think it's actually more broad-based. For us, our family, we went out to an area on Black Friday. We don't go shopping, but we went out for dinner and a movie, and we could not find a parking place anywhere. It was packed. And it was across all sectors of, from the market and people. So I think it's more broad-based than what people are expecting. And obviously, the higher income, they're going to continue to spend. But really what we're seeing is those that are blue collar and maybe even lower income, they're also spending as well because they're going to have a level of comfort as it relates to cash flow moving forward.
Maybe some point early in the year. What do you think triggers that pullback?
I think that there's going to be some more profit taking. There's going to be some concern as it relates to some of the AI stocks and how they're refinancing it. When you talk about R&D, people look at R&D with these companies as people spending their own money. But if you're borrowing money and you have debt to fund that R&D, that's really going to trigger some slowdowns. Some people are going to take some profits to make sure that they don't get caught. So we're going to see a little pullback, some profit taking. And really, I think that's going to trigger the broader markets all the way across the line and all of the indices. Now, we're already starting to see some liquidity issues as it relates to Bitcoin, because at the high it was 126, and now I think this morning I saw that at 88 or 89,000. And the reason is there's still some liquidity issues. We also think going forward, the liquidity is going to affect gold and silver. So we expect to pull back on gold and silver as well in the first half of the year. And again, for us, this is exciting because really those are buying opportunities going forward.
And so, despite the pullback that you're expecting, you're still calling for double-digit market gains by the end of 2026. What has to go right for that to happen?
The implementation of the tax cuts, the spending. And here's the other thing, too, as rates continue to lower, they're going to announce a new Fed. They're going to input them in May. So we're going to see more rate cuts going forward. You've got a lot of cash sitting on the sidelines, and as rates go down, you're not going to get the same kind of returns in the money markets that you were before. So people are going to invest more in the stock market, and it's supply and demand, and that's going to create a little bit of a run in the market going forward. And again, we also have to look at as earnings come out. The earnings are strong. The balance sheets of these companies, again, in the broader markets, are really, really good. And as rates go down, the other thing that we're going to see is for the small caps, that's exciting news because you have all these small companies that have not been able to afford to expand. They couldn't afford the debt service. And now at lower rates, they can finance that debt service and hire more people and create more jobs going forward. So really, it's kind of a bigger picture.
So last question here. If someone wants to have a well-balanced portfolio heading into 2026 with the pullback you're projecting in the markets and in metals, what does that look like in this environment?
Everyone's different. It's really going to be based on everyone's risk appetite and where they are in life and what it is that they really want to achieve. But when you think about risk and having a diversified portfolio, obviously you don't want everything in the tech sector. You don't want everything in one sector. You really want to have the broader market to include international stocks. And I'm a big believer in precious metals. And as a matter of fact, we're redesigning our portfolios right now to take advantage of the pullback when precious metals come down, because we think that there's still a big run up in precious metals going forward.
All right, Ed, we appreciate you being with us for that insight. As always, thanks again to Ed Siddell, CEO and Chief Investment Advisor at ETSI Financial. And we've got more for you today on Trading 360. Next, we've got the big three. 3 stocks, 3 charts, and 3 trades. Rick Ducat will take us through the technicals. Jason Brown will be with us to take us through the trades for Eaton, Quanta Services, and Southern Copper. That's next on Trading 360 on Schwab Network.
More drama?
the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute by minute breakdown of the biggest headlines, earnings, global movers, just the trades that matter. As the bell hits and the markets react in real time, opening bell, live at the NYSE, right when it counts.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to you.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out there.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks, 3 charts, and 3 trades to take you through. Rick Ducat, as always, will take us through the charts. And here to take us through the trades today is Jason Brown, founder of TheBrownReport.com and the author of 5-Year Millionaire. Jason, great to have you with us. Rick, great to have you with us as always. We'll start things off how we always do, Jason. A big picture market thought as we're really struggling to try to find any sort of upward momentum this week.
Yeah, Marley, good to see you. And the market has been struggling to break through for a while here, and really it's because tech has been holding us up. And as you start to see tech break down today, Google's down, Nvidia's down, Broadcom's down. The market is down because the only thing that was holding it up was tech. So I'm not cautiously bullish. I'm starting to turn slightly bearish here and think maybe a bigger pullback is going to be on the horizon.
Oh no, I never hear you say bearish. You're my go-to bull. You always have a bullish trades. Okay, well, a potential for bearishness here in the tech sector. We've got some tech names here, sort of loosely related to tech trading. Your big three today. Your first one here is Eaton Corporation. Walk us through this pick.
Yeah, so I'm calling these trades the picks and shovel trade. And when I think about what's going on with data centers, you got a couple of issues that's happening. And number one, you had Chandler, I think Chandler, Arizona, who rejected having a data center there. I'm here in Michigan. I know there's some lobbying to possibly not have a data center coming here. So you're starting to meet resistance at the state and local level with bringing AI data centers. And the big issue is not that we don't want the business. The issue is the power with the grids and how is that cost going to be passed along, what's going to happen to energy, etc. And so when I'm thinking about this being a picks and shovels trade, we start to think as we move for AI to scale, I should say, we have to have the grids to scale. And so when you look at Eaton Corporation, they're the electrical backbone of America. So they're huge in power management. They provide breakers, transformers, switches, and they're a direct beneficiary of the grids and data centers being built and upgraded here. So Eaton, you want to go straight to the trade? You want me to let Rick take a look at the technicals first?
Let's have Rick walk us through the chart here on this one, because Rick and I were talking on camera in the break about how Eaton and its particular sector is one of the most beaten down today. Right now, Eaton trading down about 4.2%. So Rick, walk us through the technicals on this specific stock, and also some of the sector movement we've seen in this area.
Yes, not a great day for this subsector of the industrial group here, this power
ETN
kind of category here. So 312 stands out to me first, our dark green line here. That's about where we had our worst close after a gap down. That was about where we struggled to retake that level. We bottomed out there twice more. We had a gap up there as well. Now that's about where we hit our lows today. So around 312 stands out as a potential supportive area during this decline. So if we also look to the upside here, 350, our red line, that was where we formed a gap to the upside. So 350, 353 or so, that was where we found a supportive zone here then. So this zone of support then became resistance. That was about where we had a high. So a noteworthy point to the upside to consider as well. If you look at our broader pattern, a downward sloping channel in blue has given way to a steeper downward sloping channel in white here. But now we can see that we have broken through the blue channel. We have crossed below that lower boundary here, which is just a duplicate parallel line from the high conventional trend line going across the low. So an interesting situation here because we've broken through one measure.
Got a gap.
And now we find ourselves at another one. So
got a gap.
Now we wonder, will it hold, or is this something bigger to consider here?
Rick missed it.
Momentum, we can see that actually we're showing a little bit of bullish divergence here. Price is making a worse close, but the RSI is trending upwards somewhat here. So perhaps things aren't as bad as they seem here as we approach the supportive level. We did drop below our moving averages, though. The faster ones are starting to cross below the slower ones. Not necessarily the greatest sign, but we also have a confluence near 341 as two of them are lining up together to consider for potential resistance. Volume profile shows volume concentrations here near about 330 and here near about 290 or so. Those are the noteworthy areas to watch to the upside and the downside. Also, we're kind of at a pocket right here. You can see this level 312 sticks out once again. So an interesting potential setup here for this name.
Yeah, and Jason, as Rick just highlighted, we are seeing a potentially bullish setup in terms of what the RSI is indicating. If you were looking to trade this name, is it a bullish trade?
Oh, good question.
Traded bullish, but I want to be clear. This
Tricky.
is a wait and see bullish trade. I didn't like that it closed below the 200-day moving average, but I was okay with it because it was around support. But now that we got a 13-point sell-off today, it becomes even more moving to that wait and see category. So I want to see it start to get back above the 200-day moving average. And if it can do that, then I'm willing to consider this trade that I'm going to lay out. So I'm looking at the September 18th, 2026 340 strike. It's going to cost you about $37. Your break even is about $377. You can see the stock at a high of about 400. So we got some potentially move up to the upside. 275 days out. I was initially looking at the $319 level as the I'm wrong level, but we are below that right here, right now. So again, that was if I entered it before the market opened today. Now,
what day is this?
See that this thing can recover or turn around before I would enter that trade.
September 18th.
We are below that level at 316.78 right now, down about 4% for Eaton Corporation. This next one, another picks and shovels play here, a little bit more construction focused this time, though, with Quanta Services.
This guy's crazy, motherfucker, man.
Again, down the day, but when you look at building out the grids and AI infrastructure, these guys provide solutions for people in the renewable energy space. They're one of the main companies that build out power grids. And so, again, in order for AI to scale, we have to have the infrastructure there. We can't, it's like the chicken or the egg. Which one comes first? And we have to have the infrastructure. When I look at this technically, the stock is in a long-term uptrend and it had a recent pullback to the 50-day moving average. As I look at my charts now, obviously it broke the 50-day moving average today, which is, starting to move me into a wait and see. I'd love for Rick to, I know he'll take us a look at the technicals, but as I'm looking at them myself, a lot of these trades are moving over to the wait and see category. But that's the market. It's open, it's happening in real time, and we got to adjust.
All right, Rick, so as we look at the technicals for Quanta Services, is it also indicating what Jason just highlighted there for us, that we've fallen below one of our important moving averages and potentially entering a more wait-and-see pattern here?
Yeah, you could say that for sure because we're kind of drifting sideways here. You could say that we have established a range. We had our old intraday high point here. That's about where we topped out. Once again, near 469.43 was specifically that price here. We never did manage a close above that level either, despite making intraday highs just shy of 474. So then we could also look to the downside. 415 is where price bottomed out several times here. We also made intraday lows right around 404.50 or so. So that general level, about a 10-point range or so here, sticks out as a potential supportive zone. We are indeed in a broader uptrend, though. I took a bit more of a granular short-term look. Our blue channel, which was trending upward, has been broken. Now we have a very narrow, very steep, short-term white channel pointing down. So when we look at our moving averages, what I have here is 21 and 63-day exponential moving averages in yellow and orange respectively here. We are on pace to close below that 63-day EMA so far.
It's a tough one.
Still young, though. But one thing I really wanted to highlight is this is an example of the type of bearish divergence in RSI that really kind of stands out. You can see lower closes on the RSI, while price was making marginally higher closes, just kind of grinding out higher closes at a resistance level that it failed to overtake. So that would be the type of RSI that's more noteworthy than perhaps if it was spaced farther apart or some such here. But we are below the 50 midline though and still trending downward here. So once again, a bit more of a bearish lean. The notable volume areas that stand out, we have crossed below one right here near about 440, this level here that coincides with our moving averages. So that now becomes even more emphasis as a resistance area. To the downside, not really too much notable volume until here. Our point of control near about 380, that's the heaviest trading area of all. That's about one standard deviation to the downside too, according to our standard deviation channel.
Yeah, we are trading significantly above that area right now at 424.79, despite the pullback we're seeing of a little bit more than 3% today for Quanta Services. Now, a different setup here with that bearish divergence in terms of the RSI for you, Jason. So how might you structure a trade here?
So what I like about this is, in most of my trades, is I'm not day trading or super short-term trading. So I don't want to play in each day's candlestick, but I did take note that we broke below the 50-day moving average. When I zoom out and look at the long term, we're still in a healthy uptrend. And again, the grids, the infrastructure has to be built out regardless. So I'm looking at the September 18th, 2026 strike price. I'm sorry, 2026. Expiration 400 strike price. You're looking at 85 before the market opens, so you may be able to get it for a little bit less than that. Again, I was just trying to hold my horses though. You got Micron reporting out
September 18th.
Shaky for any AI or infrastructure stock, so there's no rush to do it today. But long term, I think this goes higher. You got to break even at 485, 275 days, which is more than enough time. And again, the infrastructure has to be built out. We can't avoid it.
All right, now we'll move to your last one here. They are moving to the upside today. They are higher on the day, despite the sea of red that remains on the big board, as I just checked to confirm. We're talking about Southern Copper here. We have seen copper make some pretty good moves to the upside just as a metal on its own. This is a mining company. Walk us through your pick here.
Yes, so copper is critical for the data centers, it's critical for EV, power lines, transformers, is one of the precious metals that we can't really get around. And they're in the development, production, exploration. You need it with copper, this is your company. And then technically speaking, it's in the long-term uptrend. It had a recent pullback to 10-day moving average. I know Rick will walk us through that, but I like the uptrend. I like the necessity of the utility of copper. And then again, if we're going to build out the infrastructure, we're going to need copper. And then this is one of the companies that can bring it to us.
All right, so as we look at Southern Copper here, you can see we've got some gaps in the charts here, but I think as the conversation started about how important copper is to this infrastructure build-out, we are starting to see that sharper move to the upside here. What do the technicals tell us, Rick?
Before I even get into that, one unusual thing I notice about this is how many stock splits they have. Notice these little purple icons at the bottom. They very regularly do small stock splits, so it seems like they're trying to make their shares more attractive to investors. It seems like that's something that's really on the mind of the people who are running this company. But to look at the chart more specifically here, we had a rally that topped out here, a very sharp push to the upside here. Around 142 is where we had our best closing price. Then during our decline, we had hit our low close here near about 120. From there, we have had another sharp rally, barely a pause here as we broke through those old highs. Now, we're having this period of sideways to downward consolidation, the bull flag, bull pennant type of pattern that many traders look out for. However, we are not really holding on above that old low close or high close before here near 142, so that could be a pretty important litmus test here to see if this rally is going to hold. Our 21-day exponential moving average right here, 138.22, is where a shorter-term moving average could provide potential support. We also have our recent relative lows that line up with this very small gap right here near about 136. RSI broke down shortly after entering the overbought area here. We are still trending downward, but we are above the 50 midline, so we haven't really broken down completely yet in terms of momentum. Finally, when we look at our volume profile, volume is the heaviest right about here. We can see this level near 130 or so really stands out. That's the area of interest. But to the upside, plus one standard deviation channel, right here is potential resistance just shy of 145.
All right, as we look to trade this one with Southern Copper, Jason, knowing that we're in the early innings of this AI infrastructure build, I'm guessing this is a longer-term play for you.
This is definitely a longer-term play. And here's the thing when you're a trader, there's always two things you want to pay attention to. Number one, am I buying at the top? Well, we got to pull back so we know we're not buying at the top. And number two, how much time do I have for something that is kind of inevitable or has to happen anyway? And when you look at the time on this option, I'm looking at January 15, 2027. That's where we're going all the way out, not next year, but the year after that. 120 strike price, but get this, you're only paying $34 to get that much time. You got to break even to 154, so your time frame is 394 days. The way I would play this, though, is I would take a small position now because we got so much time, and then if it pulled back, I would look at adding if it pulled back to the 50-day moving average. Otherwise, I would sit back on my hands and just let the stock play out.
All right, and Southern Copper right now trading up about 0.75% at 141.36, having a pretty good year though, up about 60% so far in 2025. Jason, I want to thank you for being with us here today for the Big Three. That's Jason Brown from thebrownreport.com and the author of The 5-Year Millionaire, and of course Richard Cat, our lead market technician, for always taking us through the technicals. Coming up next, we are going to spotlight the year in tech and what we can expect for tech in 2026. Stay with us.
SCCO.
Sometimes you could have done better.
Well,
same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of the platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Kane, live on our Chicago headquarters. It's time to spotlight the tech sector, look back at the past year in tech. Joining us now to help us do that is Daniel Newman, the CEO of Futurum. Daniel, thank you for taking the time to be with us today. Since we're talking tech, I guess I have to ask everyone's favorite or least favorite question, depending on how you look at it. Do you think we're in an AI bubble?
Yeah, that's a great way to start the conversation. Good to speak with you, and what a year it has been. I am probably one of the most adamant that we are not in a bubble. I think we are in a multi-decade technological supercycle. But one of the things that's interesting is when you're in a supercycle that's like this is a once-in-a-generation type of technology shift, you will have some things that will...
More drama. sense. That's why.
That we may see fade away in 2026. Where is the real money actually being spent in the AI trade right now?
Yeah, I mean, right now, this is the infrastructure build-out. We are investing. You've heard CEOs like Mark Zuckerberg say, look, I'd rather be over-invested than under-invested. So the early cycle are these data centers. And that's where that kind of 1999, 2000 comparison to the internet bubble come into play, where we were laying fiber for the internet, but it wasn't being consumed. But that's the big difference here, is every single chip that is being deployed, every megawatt of energy that is available is being consumed. Now, where do the bears start to have a story? Well, the bears start to have a story when they say, well, how much revenue is all this CapEx expense generating? And this is where 2026, I think, is going to be a real year of proof. Right now, the entire AI trade is basically hanging on how much revenue is OpenAI creating or Anthropic creating. Basically, our LLMs driving revenue. And the real AI monetization opportunity is in enterprise. It's in how these models become agentic use cases, the trillions of, they call them tokens, the outputs that these are creating, to basically automate and create autonomous workflows inside of our businesses that drive this $20+ trillion in economic growth that we're expecting by the end of the decade. So that's the big problem, really. We're basically correlating that AI is LLM revenue, and that's not even close to the opportunity.
Okay, I have a lot to break down in there. The first one I want to address is you saying that every available AI chip still finds a buyer. What does that tell you about supply constraints versus demand durability there?
Yeah, right now, the supply constraints are very real, and it's in every part of the silicon supply chain. So for the last couple of years, it's been an obsession about compute. So we heard a lot about NVIDIA, and then it was a question of, well, is AMD going to step in, or are these custom XPUs like the Google TPU or the Amazon
NVIDIA just had a new low.
Off because we just don't have enough in NVIDIA. And then the bottom line is that is what we're seeing right now. So when people kind of do this zero-sum thing, and you heard the story break a few weeks ago that, hey, Google TPUs are growing in use, and then people kind of went real cold on NVIDIA. The problem is that's just not it. It's just not accurate. You know, we modeled this market out, and we think about 25% of the AI chips will be custom. The rest of them will likely be merchant, which would be the AMDs and largely the NVIDIAs. But to your point, all that is being built right now is being utilized. This is why Google Gemini, as good as it is, it's struggling because they just simply don't have enough compute. This is the case with OpenAI when you hear Sam Altman say, my GPUs are melting. So right now it is a capacity, it's a constraint, it's on the supply side. Where it could become risk and where the bubble really could exist is if all of a sudden we had it, the demand for utilization goes down and the use cases don't take off.
All right, and I want to talk about one other thing here. Yesterday I had an interesting conversation about AI heading into 2026, and both of my guests highlighted that they think there's too much focus on these chatbots, things like ChatGPT, Gemini, that they are not in fact the future of AI. And I'd love to get your thoughts on that stance.
Yeah, I was teasing that with you just a few minutes ago where I said this kind of over-rotation to the LLMs. I think that's what they meant when they said the chatbots. That basically the OpenAI and its chatbots, or the Anthropic and its chatbot revenue is reflective of all things AI. In reality, we look at the market and we say chatbots are going to be an enabler of all these powerful AI use cases. It could be a chatbot. It could be a different kind of model. But what's going to happen are businesses are going to start to apply these models to finance. They're going to apply these models to healthcare. They're going to apply them to solve manufacturing problems. And then you put together, you take a language and a specific industry use case model, and then you look at all the data. And this is one of the most interesting things for investors to know is the models have been trained on what is about 5% of the world's data. And the other 95% of the data sits behind firewalls. This is the proprietary data that enterprises hold, that businesses hold, that they use to differentiate themselves. This data has barely touched AI. I think we're about 1% into this enterprise AI race. And this is where all the companies that are making massive investments, this is the hyperscalers, this is some of the SaaS companies, the Salesforce, the ServiceNows that are trying to make this agentic pivot, IBMs, are really going to be able to start to maximize the revenue is when they help the enterprises start to consume AI in high-value, profitable business cases. right now I use the term for LLMs, I say they're the parlor trick. If you remember Netflix, we were in the moment where Netflix started shipping DVDs rather than the actual streaming platform that came later. This year has been like the shipping DVDs moment for AI, but some people are conflating that with us being much further along.
I have a feeling this time next year, Daniel, we're going to revisit that comment there and see exactly where we are in the AI trade. And I'm going to make note, make sure we talk about it. But we appreciate you being with us for your insight today about the tech trade and AI as we head into 2026. That's Daniel Newman, the CEO at Future Room. And coming up next, we've got the Disruptors. We'll be taking a look at Micron Technology ahead of its earnings later today.
The Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest.
So nice.
On demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Caden here in our Chicago headquarters. Let's head out to the New York Stock Exchange for a check on the markets. Welcome in Nicole Petalides, host of Opening Bell and the Watch List. Good morning to you, Nicole. We are 2 hours into the trading day. We've got a sea of red still out there. What stuck out to you most so far this morning?
Look, the VIX has been climbing, right? We had been below 16. It just shows that now the market has turned into the red. It started off in the green. We went back and forth a bit, and as you noted, a bit of red here on Wall Street. Tech, communication services, industrials are among the laggards, and so you do have down arrows. But it should be noted that the S&P 500 is about 1% off its all-time highs, and there's still a lot of folks who are pretty positive out there, and a lot of the analysts who have higher price targets for 2026. As far as some of the big stories today, you have Amazon's potential investment into OpenAI to the tune of about $10 billion. And what it could mean could be bad news for NVIDIA or Broadcom, so we'll continue to follow that story. Also, who gets Warner Brothers? Well, now it's been reported that they are telling the Warner Brothers shareholders to reject the Paramount deal and move forward with the Netflix deal. Even Jared Kushner, who was part of the Paramount backing, that hostile takeover, has now pulled out. So that development is an important one. Oil and energy, another important story here is oil has moved higher on the heels of the president and the administration's blockade of sanctioned oil tankers. Venezuela, considering it terrorism, and so with that, that has moved oil higher today. And I'll leave you with gold, which is about $40 off of its all-time highs. Right now, it's at $27. So a couple of new moves, right? If you have $27 twice, you're already at a new high. So keep an eye on gold because you know palladium, gold, silver, copper have done incredibly well this year.
Yeah, we just saw silver go above $65 for the first time ever this morning, too. So a new all-time high there. But we are seeing that sea of red, and I do want to talk about one particular company that is not, that's in the green this morning, Airbnb. They got upgraded at RBC Capital. Shares are up more than 2% this morning. Can you tell us what was behind that move?
You know, there's been a lot of good news on Airbnb overall, right? And so it's been on an uptrend too over the last, let's say, month to date, it's up over 15%. And so the call here from RBC here is they have an outperform rating and moved the target to 170, up from 145. But that comes on the heels of several analysts that have been positive. Jefferies has a 165 and a buy. D.A. Davidson has 155. We've seen a lot of outperforms and positive comments on the steady and accelerated growth that we're seeing from Airbnb. In fact, in the last quarter, they talked about the gross bookings being up about 14%. Also, the number of nights and experiences was up 8.8%. There's been longer lead times for reservations in advance. And first-time users, they've been investing a lot into strategic initiatives. They even have AI assistants that have helped. In fact, so customer support requests are down by 15% because the AI assistants have been helping. Another feature they've invested in is Reserve Now and Pay Later. So the big picture here is that the RBC note is that they think there's a driver for outsized profit going forward. They see increasingly attractive brand monetization, and that the consumer AI landscape is improving with the strategic investments that the company has been making. The high was 163, it's at 135 right now, but as I noted, it's been on an uptrend lately. Year to date, it's positive about 2% higher. So that's the big picture on Airbnb. And I'll leave you with the Jets ETF for all the airlines is at a new 52-week high. You have the cruise lines leading the S&P 500 today, names like Norwegian and Royal Caribbean. So it shows people are spending on travel and experiences. Marlene?
Nicole, we appreciate that breakdown and also highlighting some of the consumer-related stocks here with some of our top gainers on the S&P right now. That's Nicole Penelides. And now it's time for the disruptors. We've got George Tillis, our senior market correspondent, with us with today's company. We're talking about Micron Technology. They are set to report their earnings after the closing bell today. We did get some analyst action here. Expectations pretty high for Micron as we head into their earnings report. George, walk us through some of the latest here and what's expected from Micron after the bell.
Sure, yeah, I think you got to consider the expectations and maybe some of the moments that competitors like Broadcom and the application-specific integrated circuit space actually had where they reported earnings and the stock has fallen since then. But Micron also, Marley, as you noticed, probably the stock has fallen over the last 5 days in sympathy with the rest of the semiconductor stack, including Broadcom. NVIDIA, also Oracle, still not performing very well, so you have to take that into consideration. But there are also some positive catalysts associated with the earnings profile, top-line sales profile. This is essentially what Wells Fargo is looking at. Their call essentially is really looking at the industry group, and of course you look at Micron as one of the major DRAM and NAND flash memory suppliers globally alongside SK Hynix and Samsung out of Korea. So they essentially are well locked in with the marketplace against those two other major global suppliers. But you look at Wells Fargo, they're actually looking at the industry space increasing sales in 2026, looking at a 100% increase to $330 billion from this year's $165 billion increase. So this is again a situation where we're seeing the rate of change in terms of sales for the industry going from 73% this year compared to last year to 100% next year. So the expectations are quite high considering the demand for high bandwidth memory, which is really secular in nature because of the new technology shift for AI infrastructure needs. But at the same time, the cyclical components, including PC end markets and mobile markets, are still in high demand for Micron's technologies. And also, since they're going to be reporting earnings, you have to consider the expectations, which are quite high. $3.96 they're estimated to earn. That's a 121% increase compared to last year at $1.79, as well as sales robust higher, 47% at $12.86 billion compared to last year's $8.71 billion.
Yeah, and it's a very interesting setup, too, for this company coming in, especially as you highlighted off of Broadcom and Oracle and seeing those downward moves. Micron dragged down in sympathy. Even with, in the last 5 days, their move 14% lower to the downside, they're still in the top 5 performers in the S&P 500 this year. They're up about 170% so far year to date. So as you're looking to trade them as an example trade ahead of an earnings report like this, how would you structure a trade here, George?
Yeah, so every time I structure a trade model, I try to define alignment. And one of the things you'll notice is, the stock is down, as you alluded to, since the highs going back just 5 days ago. But nonetheless, the context of the market is relatively weak, but the trend for Micron is still positive. It seems to be holding the 50-day moving average. So what I'm going to do in this case, I'm going to structure a neutral trade with a little bit of a bullish tilt. The market maker move expected post earnings about $19. And so what I'm going to do is go out to December weekly contracts next week. So we have 9 days to expiration. That'll include a holiday, which allows us to earn a little bit more time decay for free. But basically, we're going to structure a condor, iron condor, with next week's implied move within mind. And that's about $26 plus or minus. So I'm going to basically give it a little room to the upside just in case it does break higher and the market recovers till next week. So I'm going to sell an iron condor credit combo. I'm going to sell the 255, 265 call spread above the current price, and then below the current price, selling the 205, 195 put spread. So altogether, this will earn you, if you place this trade, about $3 in credit or $3 in contract. So in essence, the sweet spot is between the short strikes, 255 high, 205 low. And that 205 low also corresponds to essentially a shelf of support that goes back to November. So again, that's an area that it could test if it does break the 50-day moving average. But you have to consider risk, as always, $7, and that'll be inclusive in total risk or total loss if the stock hits above 265 high or 195 low.
All right, we will have Micron's earnings on market on close today. Sam Bottas and I will be there to cover those live, but right now trading down about 2.4% ahead of that report. George Tillis, thanks so much for breaking that down for us for our Disruptor segment. Coming up next, we've got our 360 round. We'll take a look at home builders and the state of the housing market. Stay with us.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make-or-break level for this stock. And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on the Schwab Network.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me. And my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren planning for their college educations. Someday it'll be their turn.
Sports.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our 360 round. For that, let's bring in our panel to discuss home builders. Joining us, Jordan Shapiro, Senior Managing Director and Head of Financial Services at the Backrack Group, and Daryl Fairweather, Redfin's Chief Economist. Great to have you both with us today. You know, as we take a look at the housing market, we got the earnings from Lennar today. We're seeing Lennar down almost 5% on the heels of that report. Daryl, my first question will go to you here. Do you think the housing market is facing a slowdown here, or is this a structural reset as we head into 2026?
The housing market has been in a slowdown since
second half of 2022. And if anything, I think that there is a bit of a recovery happening. We're expecting more home sales next year, although it's only an increase of 3%. So we're still kind of in this deep freeze that we've been in ever since interest rates went up, but now that rates have come down just a touch, we're seeing some improvements.
And Jordan, coming over to you in the notes you sent over, you're highlighting that demand remains high, but we are seeing new home starts are lagging pretty badly. What do you attribute that disconnect to?
I think there's enough uncertainty in the economy right now that many home builders are unwilling to commit to significant new home starts, given uncertainty around tariffs, uncertainty around interest rates, and certainly around the labor economy and wage growth as a whole. As an executive search professional, I look at the housing market through a lens of labor economy, and what concerns me is the lack of new housing starts in areas where we are still creating jobs, and we do saw a high level of employment and a high level of income. For example, historically, one housing start per 2 new jobs added represents a healthy amount of new home creation across any economic condition. Today, we're seeing 1 new home start per 12 jobs added in the New York metro area, 1 per 7 in the Philadelphia metro area, which continues to add jobs. And in South Florida, where we're seeing a historic amount of relocation out of some of these other areas, we're still only 1 new start per 12 jobs. So there are concerns around affordability in the housing market, but I do think that the numbers support demand still being there for new housing starts.
Well,
we got a flag.
2026, the Great Housing Reset. In that reset, what changes the most for buyers and builders?
This will really be the first year where affordability starts to improve for home buyers. For so long, the narrative was that affordability was getting worse and worse and worse. And this is the first time we're starting to see improvement. We thought improvement will be sustained over the next few years. So how that matters for buyers is that if you were looking for a home last year and you start looking for a home in spring of 2026, you will notice that your budget can take you farther in terms of the homes that are out there. For builders, that means that there should be a little bit more demand for them, and they still need to be competitive with existing homes. They still may need to offer those incentives to buyers because even though affordability is improving, it is still a big challenge.
And Jordan, I want to come back to what you were talking about some of the labor and the permit to jobs data, because those numbers are pretty striking. What happens in metro areas like New York, and you highlighted South Florida, if they stay undersupplied, and also in job-rich cities, how much limit does that have on prices, and how much they can actually come down in 2026?
We've certainly seen an expansion, a ridiculous expansion in the cost of housing, particularly in metro areas like New York and South Florida. And the transition that we're starting to see, representing an age of millennials who now have 10 to 15 years of work experience, they're starting to build up savings, they're looking to be first-time home buyers. What I think the housing data shows us is the mix of single-family homes to multifamily units is shifting in a way that is abnormal when you look historically. We're not talking the last 5 years, we're talking going back 10 or 20 years. Typically, multifamily housing starts would make up about a third of new construction. Today, it's making up 2/3 of that construction. So I think that is a recognition that the millennial generation is looking to be first-time home buyers. They're looking to transition from renters to purchasers. And the market is responding to provide them with units that maybe are lower cost, that remain affordable even in the relatively high interest rate environment that we're working in today. Now, as those interest rates come down, housing prices will obviously become more affordable, but the average home price did continue to tick up. I think it reached about $540,000 at the end of 2025, and that includes all home sales. So there's a challenging equilibrium here between supply and demand, and I think it remains that home builders are still cautious to engage in new large-scale projects, given that broader economic uncertainty. If the demand is there today, one might argue the demand will remain there in 1, 2, or 3 years if we keep wage growth high and we keep the unemployment rate historically low, which is where it has been.
I want to appreciate you both being with us to talk through the housing market and some trends that we might see coming into 2026. We are, of course, saying that it remains challenged during the current quarter. During the report today, that's Jordan Shapiro, Senior Managing Director and Head of Financial Services at the Backrack Group, and Daryl Fairweather, Redfin's Chief Economist. Thank you both again for being with us. I also want to thank all of you for joining us today on Trading 360. I'm Marley Keating, and you can download the free Schwab Network app available in the Apple App Store and tune in 24/7 on SchwabNetwork.com. I'll be back with Market on Close at 3 p.m. Eastern District 2 Central with Sam Bottas, but stay with us. Fast Market with Diane King Hall is coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on the guidance, but not the same rate of change on ETFs.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey Bob. Hey Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, I had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Stock Exchange. It's tug of war between the bears and bulls on Wall Street today. The Bears now winning at this hour. Let me give you a check of your scorecard as we hit the lunch hour. That's IPO opening right now, Anderson, happening. Here's before I get into the roadmap for today's show, here's a check of your major averages. The S&P 500 off by 0.75%. Information technology is the biggest laggard. It is weighing things down, followed by weakness in industrials and communication services. Over the Dow, that's off by just a little bit more than 0.1%. NASDAQ 100 lower by more than 1.25%. Russell 2000 off by 0.4%. Here is the roadmap for today's show. We'll look at example option strategies for Micron. It's got earnings due after the bell. Plus, The team from Lightfolio will be along with Newsom's data on CarMax and Western Digital. It's also on our radar today after some analyst action around that one. Now that we've got the roadmap for today's trading action, it is time to bring in my co-hosts and trading veterans. You've got Tom White in our Chicago studio and Kevin Haynes joining us live from the Seabus. You know, we've got covered from exchange to exchange and beyond. All right, we open higher, stock backpedaling. We've got this renewed pressure happening in the tech sector. The Max 7 heavyweights, Alphabet, Google, NVIDIA, they are both feeling the heat. Tom, what's your take when you look across the market action today?
Yeah, a little bit of divergence here. I think one of the key takeaways, because we were higher, you know, in the pre-market when we opened up, started getting weak on the back of that Oracle news that we had. But at the same time, it's not like a full flow day out of everything in the markets. The S&P 500 equal weight index is relatively flat today. You've got 6 of the 11 S&P 500 sectors that are actually positive, but what's weighing on it is the bigger components within the S&P 500, and that's tech. I think that's one of the keys here at this point is we're not seeing broad-based sell-off here in the market because people are maybe getting out of some of their tech names, taking some profits into the end of the year, but pushing back into financials and other areas within the market. And that's probably the nicest thing to say about today's pullback, but with 4 consecutive down days for the S&P 500 and the Dow, the sentiment hasn't picked up, and everybody's kind of scratching their head going, well, hey, where's Santa? Because he hasn't shown up yet. Typically, we start seeing that towards the latter stages of December, but we haven't gotten that yet. And I think it's just a messy trade right now, and it might continue because it seems like the divergence between maybe the winners and losers are taking hold here. But all it would take is maybe a pickup in some of these tech names where somebody comes out and says, okay, these have been beaten up enough. Maybe I'll start buying into those. That would help with sentiment at least. But, there's no volatility in the bond market right now, and I think that's a saving grace for the equity market at this point.
Great take there. That is the question, where's Santa? And is this going to be a December to remember? But for different reasons than we expect. Kevin, what's your take?
I think you guys are way too early on Santa. And we're not even in December expiration in the monthly options yet. Hold on that Santa Claus rally. The reality is, you look at these markets right now, the S&P 500, 6 sectors are higher and 5 are lower. The problem? The sectors that are lower are the 3 behemoths: information technology, communication services, and consumer discretionary. If you lose those 3, it's very hard for this S&P to go up. Tom made a great point. Look at the S&P equal weight. This is a rotation out of those heavily owned, big rallied sectors into the others. And so I don't think this is necessarily unhealthy. It's just kind of teardrops versus tidal waves in terms of the sectors that are moving. And right now the tidal waves are on the downside. Listen, I think this is still a market. Think about this. They're taking some serious percentage points out of some of these big names. NVIDIA, the relative strength on NVIDIA is in the 30s now. It's close to being oversold. Who would have ever thought we'd say that in our lifetime, that NVIDIA is oversold? So I just, Tesla traded $495 this morning, and now it's down 13 bucks. Listen, I think these markets are getting a little whippy here at the end of December as we get close to expiration. I think the holiday markets really start, in my world, holiday markets start after December expiration. So yeah, right now it looks like a big rotation out of Magnificent 7, information technology, communication services, consumer discretionary, into the others, guys.
So there's still time for Santa. Be careful before
Well, heck.
All right, let's talk Amazon. It's in the headlines today with these reports that it's in talks with OpenAI about a potential $10 billion investment in ChatGPT maker. Amazon is actually still a little bit higher, even with the broad-based weakness that we're seeing in the market, off of the highs that it saw earlier in the session. But Tom, what's your take?
More partnerships that OpenAI is trying to create at this point. I think one of the caveats within maybe a potential deal between the two is the advent of Amazon and their Trainium chips. They just came out with 2 new ones, and if OpenAI starts to use those, that's maybe why you're seeing some pressure here on NVIDIA, which is down over 3.5% at this point. But it makes sense in the grand scale of things that OpenAI is trying to make partnerships with everybody. $10 billion investment, not much for Amazon if you think about it. But I think this might be that underlying tone of, hey, if they start using some of our specialty chips in the Trainium line, that's going to be a benefit as Amazon continues to build out their silicon chips and potential for more clients to use that. And that'll be a bonus for them. As a lot of these hyperscalers, you got to remember, Amazon being one of them, they're trying to create their own chips so they don't have to rely on NVIDIA, and they can continue to create these partnerships in OpenAI. You're hoping, if you're a believer in OpenAI, that some of these partnerships continue to expand and come to fruition. I think that's going to be the bigger question.
That's a good point, right? Expand and come to fruition. Kevin, what's your take when you think about Amazon in this piece of the puzzle?
Yeah, I think Amazon continues to work deals. Think about this.
We've got the 63 right here.
Off the recent highs already. $10 billion for Amazon to invest in OpenAI. That's tip money for Amazon. With the amount of revenue that they put in every day. So this is not a big investment. I think the better story on Amazon is that it's firming up after a pretty remarkable sell-off in the last couple of weeks, where it hit $258. Now it's $223. I mean, it is low compared to where it was. So I just think that this is one number of the Magnificent Seven that's starting to firm up. These deals, we seem to get one every day. Isn't it? I mean, it's hard to keep up. We need like a AI digital deal scoreboard where we can keep track of all these things, because every day it's one or one different one. So yeah, I think this is good news for Amazon, but the bigger news for Amazon is how far it's already sold off its recent highs. With they're in every single major business going on right now in this economy. So yeah, Amazon extremely. It looks, it appears, it's sold off a long way from its recent highs.
Yeah, some say it's a value play within the Mag 7 now, and some say, they don't know if it will catch up with the rest of the group. All right, let's talk about Game of Thrones for Warner Brothers Discovery. So WBD standing by its man with Netflix. The board unanimously recommending that investors reject the Paramount bid, so they're like, no deal. Tom, what's your take when you look across this?
Yeah, this is this ongoing saga within telecom at this point. And streaming, I think this is going to take some time. It's going to probably create a bid that's going to be higher than the $30 cash offer that Paramount Skydance has at this point. And it's weird because the board of Warner Brothers Discovery says this is a superior bid. Well, is it superior? Well, because the cash in there, and then you get Netflix stock. Paramount came back out and said immediately that our bid's superior. It's all cash. I think one of the caveats, if you listen to some of the commentary from the board from Warner Brothers Discovery, is that they didn't have the backing of Larry Ellison, and that's the key for them. That hey, maybe this thing won't close if we don't have that financial backing on this $30 a share cash offer. I just think this is going to be a further extended, drawn-out battle here. I don't think it's going to end anytime soon at this point. It's going to be up to shareholders at this point, and expect it to kind of continue into 2026, unfortunately, for us in the news and financial news industry, because it just keeps on getting more minutia involved in it. But at the same time, if you take a look at what's going on, is will both of these partners that are trying to buy the assets have to raise their bids? That's key. And then also, there's something in the notes from the board that there's might be a partner C in here that's going to take the cable assets. Because remember, Paramount Skydance wants all of it. Netflix just basically wants the streaming and the assets that they have and the names that they have. So yeah, watch this to continue, and we'll be here to report on it.
Yeah, they are. And I mean, look, Paramount Skydance have been trying to make its case about its offer being superior, but at the same time, if there's, no Ellison money, I mean, Ellison's got to worry about Oracle. We'll talk about that in a moment. Kevin, what's your take when you look across this? It feels like, not just a Game of Thrones, it's like a chessboard. It's like what piece will be here and who will be there. What's your take?
Yeah, two words that come to mind, not over. Is what
not over.
This is just another chapter. Netflix
Well,
is probably
SPX, it's about 1, 2, 3, 4, 5 times.
Why?
6.
David Ellison
But
buying,
no.
not Larry Ellison buying. If it was Larry Ellison, it might be a
Getting
different
soon.
deal. But right now, Netflix, and by the way, it's not like everyone says, oh, Netflix is a cash deal. Yeah, but they're borrowing $59 billion
God.
to make it a cash deal. So I don't know if it's exactly a cash deal, but it's not a stock deal, for sure. But they're borrowing the money to do that. Diane,
Not a very good idea.
headache to read these stories because it's now back and forth. If I recognize these things from my past, they're not over yet. I think Paramount will come back again, and the only thing that's good for is I think the price is going higher, Diane.
Okay, all right, let's talk about where price is taking a hit today. That shares of Oracle down right now about 4.5%. This comes after that report in the Financial Times that suggests Blue Owl Capital is backing away from that funding table for Oracle's big data center in Michigan. So why does this matter? This is part of that Stargate big deal. It was supposed to be a catalyst here. Tom, what's your take?
Well, Oracle came out next and basically stated that they're on schedule as far as the equity involvement here on this deal. That's you're seeing that weakness in Oracle, of course, and this comes on the back of their Q2 earnings, which were a little bit better than expected. But if you look at free cash flows, went down, capex spend went up. Those are things that investors don't like to hear, and that's why the stock's down nearly 50% from those all-time highs in September. And then on the back of that, you've got some, Congress people coming out with a bill to kind of look into the data infrastructure build-out of some of these, these data centers, and that's going to be maybe a concern here moving forward. But not surprising that we're seeing a little bit of a pullback. Oracle bashing back against that report. Blackstone might get involved here at this point as a partner with Oracle. But yeah, just adding more volatility here to what we've already seen over the last couple of months here in Oracle.
Oracle might have said what they said on Twitter X, but the market doesn't seem to be paying attention to that. Kevin, what's your take?
I think this story, this AI data center story is getting murky, and here's why. Energy. This is, they're not going to be able to, people are going to, if there's any worrisome event on the horizon for this, is having enough energy, and you're going to start getting, I can just sense it in my veins, Diane. It's going to be a not in my backyard kind of thing coming up with these data centers. Everyone loves the idea. Everyone loves the business and what they're doing. No one's going to want them in their backyards or in their towns. Because why? At the end of the day, the only thing that's going to give enough power is nuclear. And everyone still thinks that the term nuclear is such a bad word. And I think there's problems getting, it's a great idea, it's moving along, but once they get to the energy stage, things are going to get real dicey here.
And the thing was that the idea with this is it's also going to create jobs. So we'll see. This is probably another story that we'll continue to watch, and we'll turn the page on this one into 2026. But for now, we'll put a pin in it. We've got bull versus bear coming up. The guys get their example trades put together for Micron. Keep in mind that stock has more than doubled on a year-over-year basis. It's been one of the best performers in the S&P 500 year to date. We will have more fast market after this break.
Well. I'm one of them born days again. Oracle hit my support level that I had drew in here yesterday. So, it did do that. been going sideways. Sooner or later, this has got to squeeze.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to here on Schwab Network. Micron is on Jay to report its quarterly results after the close of trading. Jay, the company is expected to show solid growth as big spending on AI data centers boosts the need for high bandwidth memory. Here's where consensus expectations stand. The Street is expecting Micron to report earnings of $3.91 per share on revenue of more than $12.7 billion. But the question is, will that be enough for Wall Street to keep the party going?
Yes.
Welcome back in our co-hosts Tom White and Kevin Haynes. It is bull versus bear time. So before we get to the example trades, I want to get a chat going on Micron. It's been one of the best performers in the S&P 500 this year. It's pulling back today, and I think that makes for an interesting setup going into its results because, you know, when you think about how NVIDIA performed after its results, some of the other tech names who had strong numbers, but it didn't seem to matter. Kevin, what's your take when you think about this one?
You're exactly right, Diane. That's, you know, when traders look at things, they look for comps, right? They look for how the other stocks have done after their earnings. NVIDIA, Broadcom, all the ones in their group. Now, they're not, you know, it's more Western Digital Hynix kind of story for competitors, but this whole AI sector has been weak. Micron's been weak, right? It's already about almost $40 off its recent highs. But if this pressure continues, remember what we talked about Broadcom. How good do they have to be? The stock is up in the last 6 months 84%. And so the bar is incredibly high for them to get over. They're in the right business, they're in AI, they're in data centers, but they're selling those stocks right now. So this is going to be a tricky earnings event for sure, Diane.
Tricky earnings event. Tom, I'm curious to know your thoughts on it, especially given like what Kevin said, and just, you know, how it may be.
Looks like we broke the 63 here on the SPX for the first time.
It's down about $13 from its intraday highs here today, so it's had that pullback right at that 50-day moving average. But now they're the number 2 player in high bandwidth memory. They've gotten rid of, they said they're going to get rid of some of their other legacy chip industries to focus more on high bandwidth memory. They're the number 2 player in there, behind Samsung and SK Hynix. They were behind them, now they're in between them. So they're gaining market share. That's a high margin part of their business. And then you look at the legacy parts of their business. I don't think we focus on that enough. Is that DRAM pricing and NAND pricing has exploded. They don't have enough as far as capacity to kind of fill the orders at this point. They're sold out on high bandwidth memory for this year and next year. So it'll be interesting to see what the company says going into this one, because the bar is still high, even though we pulled back about 15% from those all-time highs that we saw just over a week ago.
Okay, all right, let's get into the example trades and the approach each of you is going to take. Kevin, let's start out with your approach.
So Dan, Tom, we're going to do this a little different today. We're going to make this kind of a lesson on trading. We're going to line up.
Oh, we are.
Right now, Micron's trading about $225. The expected one-day move, about $19. Let's round that and figure 20. So the basis of our trade is the $245 stock. We're going to sell it all vertical. But the learning part of this is, what's the difference between selling one $2.50 wide call vertical or one $5 call vertical? And if you sold two of the $2.50 call verticals, you'd basically have the same amount of risk. Right? One $2.50 versus two $2.50 versus one $5. Now, if I sell the 245, 247.5 call vertical, it's trading about 65 cents. Think about that, 65 cents.
I'm thinking about it.
$5 call vertical, 245, 250, it's trading $1.15. But if I were to sell two of the $2.50 strikes at 65 cents, that's $1.30. So we talk about this a lot. Bringing those strikes in sometimes and selling more is a more efficient use of capital than one $5 where the credit starts to drop off. So what I want the viewers to understand is $2.50 bring in $1.30. One $5 brings in $1.15. The lower is the better trade. So Tom, what I'm trying to get across here is you always got to be checking for the better way to do things. And this one is pretty clear. You collect more money doing two of the smaller call verticals.
Yep. Let's break this one down, because we're going to do this individually, Kevin, because I think this is a good lesson for looking at different trades that are basically the same. These are both neutral to bearish on these out-of-the-money short call verticals. But let's break down the first one. They're all in December 19th monthly options. So you've only got a couple days till expiration. Earnings type of examples here. Sell the 245 call by the 247.5 strike call. Neutral bearish $2.50 wide short call vertical. You're going to collect roughly, you got 65 cent credit on here. That's where it was trading earlier. If you collect that credit, that's what you can make. $65 per spread, about $185 in risk. And it takes your break even up to 245.65. There's your break even. That's where you need the stock to remain below, just outside that one standard deviation move. Now, the other example Kevin brought, still neutral to bearish. Still using selling that 245 strike call in the December 19th monthly options, but then instead of buying the 247.5 strike call, buy the 250 strike call. So short $5 wide neutral to bearish call vertical. You're collecting roughly, we got $1.15 credit on there, where it was trading earlier. That's what you can make, $115. Right? With about $385 in risk on that one. So a lot more risk on it. But as Kevin mentioned, your break even on that one, collect 115, 246.15 to the upside. So your break even's a little bit higher on that one. But as Kevin mentioned, when taking context into these, if you do more contracts, there's no commissions, but there's some fees on there, that you might be able to collect more credit if you do two of the $2.50 wide short call verticals as opposed to one of the or the $5 wide short call vertical. So there's the differentiator. You want to look at how much risk you have, how much you can potentially make on those trades, where your break-evens are also. But I think the biggest context here is that they're both neutral to bearish and they're risk-defined. So you know exactly what your downside is going into either of those short call verticals. Now, let's flip the script. I went a little bit more aggressive than Kevin's on this one. If you think this stock's going to rebound after that 15% pullback, we're sitting right at that 50-day moving average, which over the last year, it hasn't gone and stayed down below that level very much at this point. So I looked at something that takes advantage of vol dispersion. So
he likes it.
Bullish call that's really short term. Going out to the December 26th weekly options expire in 9 days. Buy the 225 strike call, that's at the money. And then in the near term, December 19th, weekly or monthly options that expire in just 2 days, sell the 245 strike call. So a bullish $20 white call, diagonal, paying roughly, I've got a $10 debit on there. This thing's trading about $8.70 because the stock has continued to move lower. But the key is, the debit you pay on it is going to be your risk. So if you pay $10 on it, your risk is going to be $1,000. If you pay $8.70 for it, it's going to be $870. So keep that in mind. But I think the key is, Kevin, that it's still less than half the width of this bullish call diagonal, and the top side of this, the 245 call that you're selling in the near-term options, lines up about with that one standard deviation move, Kev.
Yeah, exactly right. Lining up the strikes, buying at the money 1 week out, selling in line with the expected move in this expiration, taking advantage of the implied vol that's about 149 in the front expiration time. You're collecting theta. It's a bullish play, make no mistake. You're collecting a fair amount of theta, though. You've got about 21 deltas out of this trade time, looking for a move in line with the standard deviation. And if you get it right, Tom, looks like about almost a triple. This one just shy of a triple in terms of.
Woo! As we mentioned, that dispersion, I mean, you're buying a lower implied volatility on aggregate, about 88%, selling about 148% in that near-term options. That vol dispersion lowers the entry point price, but anything on this one above about 229, 230 is going to be potential profitability. You can see here from the risk profile that the apex, where you want to go, is about that one standard deviation at or near the 245, but anything above about 230 is going to be potential profitability. You have some assignment risk on that short option there. So there's the bull-bear breakdown here, Diane, and Micron.
Yeah, not just a choose your own adventure today, it's taking us to school. All right, we've got hashtags coming out. The team from Lightfolio will be along with new sentiment data on CarMax. That stock has been cut in half from the same time a year ago. Sarah here, Schwab Network, Fast Market. We'll be back after this break.
William, you would be the smart one.
Hi, I'm Alex.
I'm Jean.
And I'm his mom. Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Barnes, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex.
Well, I was right about the breakout coming.
Get 24/7 live help and access support by phone, email.
Now it's pulled back and retested.
Help you develop a deeper understanding of technical analysis,
Technical analysis.
and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market Schwab Network. I'm Diane King Hall. Kevin over at CBO joining me shortly. Time now for our cash tag segment. Today we're getting our next guest. That's Megan Brantley, Vice President of Research at Lightfolio. We are taking a look at CarMax today ahead of its earnings. And Kevin and I have talked with you guys about Carvana recently. And CarMax, though, has had a very different year than Carvana. Those shares, I mean, when you look at it over a year-over-year basis, it's just, I mean, it's a shadow of itself, down by half. So what's the top takeaway you want to leave us with from your latest data and look across CarMax, Megan?
Yeah, so whenever we look at this, this has been one we've been following, I'd say for the last couple of quarters now, where we're kind of beating the table and saying, CarMax is bleeding market share to Carvana. And our specialty is understanding the consumer here. So what is driving the consumers? Where are they increasingly looking to make a purchase and things of that nature? We like to try to get a good gauge on sentiment and on forward-looking demand. And even though the bar is remarkably low, as you just mentioned, I think the stock is down around 50% year to date, we still see CarMax hemorrhaging some market share to Carvana. Whenever you look at this comparison, it's pretty stark. We have Carvana actually accelerating. So this, forward-looking demand up about 34% year over year, CarMax down about 10% year over year. And we're not necessarily seeing any moderation in this. We've been tracking some negative metrics in CarMax for some time, and you start to expect that to level out because the bar continues to get lower and lower. But when you look at a comparison of, that digital traffic, which really is a nice gauge for that forward-looking demand, it is tracking nearly in lockstep with the stock price. And so for us, this tells us this is a really predictive indicator to watch. And I will say the bright spot, if anything, is that right now the two look to be about in tandem. So for us, while our data still looks very rough for CarMax in terms of forward-looking growth, it looks like the market may have some of this priced in, but we are officially neutral for this earnings event. There's also a lot of uncertainty surrounding the same. You have potential lawsuits, you've got a leadership change. Right now, CarMax has an interim CEO, so certainly something to watch, but also an announcement here, any type of positive news here could move the market. So for us, on a consumer standpoint, we continue to see CarMax kind of following the same path that it's been following for the last couple of quarters, but we will acknowledge the bar is very low, and at least there is a glimmer of hope that potentially new leadership could start to turn things around.
Megan, Brooks and Dunn has a song called The Long Goodbye. And it's basically the story of a deteriorating relationship. And this seems like we're witnessing a long goodbye here. And the real story is simply Carvana with online and asset kind of light. They have a very lighter footprint than CarMax does with the brick and mortar and sales. And they're just doing it better. This is the, Megan, what can they do? What can CarMax do to turn this around? I mean, this is, at some point, the ref's going to call this fight over because Carvana just keeps pounding away on CarMax when it comes to market share, and they just keep doing it. They can pay higher, they can sell more because they have less overhead than CarMax does. Megan, if you were the CarMax CEO, and right now they're about to, they ousted their CEO, they guided third quarter to more weakness, what can turn this around? I don't see it, Megan.
Yeah, that's really tough. As you mentioned, this is just a much broader footprint, and because of that, the dual model of lots, and they do still have some digital exposure. It's just a bit clunkier than Carvana, as you mentioned, and that's something that is really driving that consumer sentiment. That gap that we're watching is consumers report a better experience with Carvana. They report, having a better selection of cars that they actually want to purchase. It's a faster experience. It's an easier experience, especially for a younger consumer now that is more digitally native. It's kind of the preferred experience experience versus perhaps, going to step onto a car lot. And so I think that there are definitely some ways that CarMax could potentially, steal a page from Carvana's playbook, if you will, and improving that experience at large. But we just have not seen any type of a major shift in sentiment. A lot of times whenever we see a stock that's been sold off like CarMax has, we're looking for these signs of life. We're looking for these signs of positivity or potential sparks. Like in the Lululemon we talked about earlier, where we were like, hey, this is one that really we could start to see things turn around. And we just aren't seeing that with CarMax on the sentiment level, on the forward-looking demand level, on the competitive versus peer level. Now, I will say that if you look at retail units moved as a whole, I think CarMax is still moving more vehicles than Carvana. So we're talking about this long goodbye, but CarMax is still has more higher retail sales. I think that they moved just under 200,000 retail units last quarter to Carvana's 156,000, something like that. But that gap is closing. That market share, continues to just shrink and be shipped away by Carvana. So for us, this is one that we're just staying away from because we're not seeing signs of life or signs of big change from the consumer. And on the operational front, it just looks like a lot of headwinds building and continuing to build ahead. And so I think until there's an answer, until there's any sign of turnaround, this is just one that we're going to stay away from.
Yeah, I mean, listen, I'm trying to find, reasons for hope in this one because, to Kevin's point about the long goodbye, expectations are obviously lower here. The stock
Pretty dead.
hasn't seen in basically about 10 years. I mean, go back to 2015, maybe longer, for CarMax. And when you look at a long-term chart, you see that peak it had in 2021 during the pandemic and in December 2021. And it's just been, there have been some moments where it has some sparks, but it's been almost just steady ride lower here for CarMax. Is this really a shift in, how consumers operate? Does CarMax need to, wind down its footprint on the ground, or is it some of the issue also the credit issues with some of its consumers and, servicing the loans that they get there? What's your thought, Megan?
I think that that's a good point. Last quarter we heard them say that the higher credit consumers were pulling back on purchases, and I know that CarMax really struggled with some of the loans that had originated in 2022, 2023 versus 2024 and 2025. And so, there could be some operational wins there as they kind of tackle that credit issue and lending issue, how they operate that side of their business. But all in all, this just feels like not only on the consumer front are things kind of piling against them, but even the operational front. If you listen to the things that they talked about last quarter, they talked about, there was pull forward demand, they brought inventory too quickly, it depreciated, it cut into margins, unit sales fell, and all of these things stacked on top of each other. It just seems like they can't keep putting, one right foot in front of the other. And so for us, this is one that, even though the stock is pretty low, there's no reason that it can't go lower. However, we do think the bar is incredibly low, and there's always a potential spark of hope whenever you have a leadership change. Right now there's an interim CEO. If any announcement is made to a long-term CEO or any type of positive traction, the market might like that. But I think that is the best bet to the upside right now. At least in our data, we aren't seeing any signs of consumer traction in the near term.
Great analysis and great perspective there. Thank you, Megan. That's Megan Bradley, Vice President of Research at Likefolio. Now, for the trading perspective on all things CarMax, Kevin, they gave us a lot of information. Let's bring Tom back into this conversation about CarMax. She talked about expectations being lower going into this because they talked about that pull forward effect. There's a lot of blame on their last earnings call and expectations lowered for this. Tom, what's your thought before you get into the example trade?
Yeah, it seems like this data has been repetitive over the last couple of years here on Likefolio. Not surprising that it hasn't really turned around. I think one of the key things is we're going to hear probably some type of clarity on the CEO change. CEO Bill Nash was stepping down, maybe forcefully at this point. Who knows? But December 1st, they still don't have anybody in place, but they're also doing a reconfiguration of what they do. They're spending about $150 million on a turnaround plan over the next year or two, so maybe hopefully fight back a little bit better against Carvana. But Kevin, looking at this one, option market's pricing in basically plus or minus 10% move in the shares. They said the bar is low. Carvana's starting to eat their lunch pretty good. How do you want to look at this one from an example trade?
Yeah, the paper trade, the paper money trade that I looked at here, Tom, is something on the bearish side, and it's just basically the opposite of what you did in Micron, which is the put diagonal. Buying the, they don't have weeklies, so you gotta go out to the January expiration, buy the 40 put, and then go to the December 19th expiration and sell the 35 put in just a little bit past that expected move for the 1 day, but the move for the rest is, it's about $4 for both of them, actually, rounding a little bit. So the debit on this is 205, it's trading about 210 now, so it's moved down a little bit, Tom, but I think this is one of those where one thing Megan said that caught my attention was the expectations are so low that if they were to announce a new CEO or some type of change in direction, but they already guided for a weak third quarter. So the news out there, they're bracing for bad news. So, Tom, this is one of those, I think I traded from the bear side or I don't trade it at all, Tom.
Let's break down this example trade. As Kevin mentioned, no weekly options in here, so he's using the monthlies. Out to the January 16th monthly options that expire in 30 days. Buy the at-the-money 40 strike put, and then against it sell in the near term to December 19th. Monthly options that expire in just 2 days, sell the 35 strike put. Bearish, $5 wide put diagonal to the downside. You're paying roughly 205 debit. There's your risk, $205 per spread. Anything below about the 39 level is going to be potential profitability on this. But you want to kind of go that one standard deviation move to the downside here for max profitability, but because you're paying less than half the width of this $5 wide bearish put diagonal, anything below about 39 is going to be profitability on this one. Got 30 days in it, so you've got some duration on this one. So even if you don't get the move to the downside immediately, you've got another month in this position. And as Kevin mentioned, if you're more bullish on this one where maybe the bar is low and it's going to rally, you could flip this and do the January 40 call. You can buy that one and then sell the 45 call in the December options that expire in 2 days. And that costs you about $2.60, so less than half the width. If you're more bullish, a call diagonal to the upside would work out. But I think the key is with either of those, whether you're bearish like Kevin's example or a bullish call diagonal, you're buying about a 65% implied volatility on aggregate in the January options where you're buying the 40 put and selling about 167% on aggregate in that December 19th weekly or monthly options that expire in just a couple of days. So that vol dispersion lowers the entry point price on Kevin's bearish put diagonal example here, Diane.
All right, guys, good stuff. Thank you. We've got a breakdown coming up. We are taking a look at analyst action around Western Digital. The stock is softer today, but it has been a huge outperformer this year. We'll be right back.
Yep, drop more. It's a guessing game.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge
more drama.
of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to
Long shot.
schwab.com/coaching and start learning today.
SPX. 67.80s at $2. George.
The buyers of server technology storage as well as computing storage needs that Western Digital sells, they're going to be eating essentially a high price aspects of their needs. So in other words,
we're now 260.
Well, profits are going to be switching from the end markets to Western Digital, which is a mid-tier supplier in the complex.
Okay, so when you look at this for Morgan Stanley's take on this, is this also about getting selective here in the space?
Yes, absolutely. And that's the thing about this right now. It's very tricky in the AI tech complex because we are seeing there's winners and losers. Apple, this is also something that, they talk about. Morgan Stanley, they're very bullish on Apple. I talk about them as well as being the company, the big mega cap names that are essentially spendthrift when it comes to AI spending. The ones that are expected to generate the most are performing the worst, and that is Oracle, for instance, going back to September. So within the context of this market, those that have pricing power and demand, and that's really the core structure of computing, storage, and memory, micro, Western Digital, Seagate. Right now, based on the estimates and guidance and some of the favorability and even the price action, they're holding up rather well. But you have to consider that Western Digital, Micron, alike are very cyclical. And that's why I think a lot of these names, including those two names I mentioned, are still trading at very low earnings multiples for next year. That tells me that either the price will rise significantly or maybe it'll fall to come realign with traditional cyclical expansion and contraction that we do see in these groups. So you have to keep that in mind. These groups do move quickly higher, but they also start to retrace back quite quickly as well.
Okay, great perspective there, especially on the speed of moves that you should watch out for with this one. Thank you, George. That's George Sillis, our senior.
Good job, George.
Appreciate the breakdown there on Western Digital. So let's get Tom Kevin back in here for the example trade purposes. So Tom, this time you've got the example trade in WDC, as George mentioned. A strong outperformer this year, huge. Got more bullish conviction around it, but what's the approach you want to take?
Yeah, similar to the chart Micron and anybody else that's involved in memory at this point. Their hard disk drives that are going into these data center build-outs are the reason that they've seen sales just explode. And then the analyst community, you look at the, on a daily basis, it seems like an analyst is coming out and hiking his price targets, and not by like $10 or $20. They're hiking from, the 170s up to 250s, something like that. So with orders booked, just like Micron in this AI build-out, it's probably one of those in this cyclical type of industry, one of these booms, and that's why you see the stock up over 270% so far this year. The option market prices in about a plus or minus $7 move either way in the shares on this one going into the report. So I looked at something that's passive, but you can still take a directional bias with a passive type trade. So I went out to the December 26th weekly options. 9 days to expiration. This isn't a pure earnings play. You've given yourself an extra week in this, maybe to gather a little bit more credit that you collect on this out of the money put vertical, or gives yourself some decent probabilities and time in case you don't get the move that you need on this one. So going out to that December
265.
expiration, sell the 160 put, and then against it, buy the 155 strike put. This stock will most likely move, and historically it has, along with what Micron comes out with after earnings. That's kind of why I wanted to discuss this stock, because correlation's pretty high as far as the moves on this, or they have been at least recently. So sell that $5 wide short put vertical. You're collecting roughly about $1.30 credit on that one. That's what you can make, $130 per spread with $370 in risk on that, but that's all the way below 155. So Kevin, on this, higher probability of success. You don't have any event risk besides the Micron earnings, but that could cause some volatility here.
Yeah, but this will surely move in line with Micron's earnings because they're basically a peer or a competitor, so that's why it has an expected move. Right now, the odds, the probabilities of this 160 put finishing out of the money, 66%, so about 2/3 out to December 26th. So it's risk defined, it's collecting theta, and it's high probability, Tom. That's usually what we look for in a short put vertical. The bar is going to be high, again, where all these stocks are sitting. So if it'll probably follow the movements of a Micron, but we'll see. Usually those sectors move in tandem, but we'll see what happens.
Yeah, Kevin, as you said that, the option market's pricing in a plus or minus 4% move either way. So it's got a market maker move on it, and it doesn't have an earnings event. So plus or minus $7 or about 4%, just due to the fact that Micron has earnings on this one. And going out to the December 26 weekly options is selling that 160 put. You got about a 66% probability of finishing out of the money. I mentioned you got $370 at risk. But this is one of those strategies that 3 out of 4 scenarios can be profitable. If the stock goes higher, stock stays where it is, or goes lower, you're wrong. But remains, if you collect $1.30 credit, remains above that break-even of 158.70 basically over the next 9 days here, Diane. So a short, neutral to bullish, put vertical as an example trade.
Okay, great perspective there on this one. with regard to Western Digital and the perspective that you gave about the potential impact from Omicron. Also, we're getting some breaking news right now on Amazon. Amazon is saying, according to CNBC, its AI chief is leaving. Not seeing impact to shares right now in terms of any detriment. Shares higher by 0.4%. That's going to do it for us today on Fast Market. I'm Diane King alongside Tom White and Kevin Hayes. Download the Schwab Network app. It's in the App Store. Tune in 24/7 on SchwabNetwork.com. Stick around. We've got Next Gen Investing coming up.
We're about to break the 63. Dow Jones down 120 points.
Schwab Bank Investor Checking. The checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on the guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, I had a stroke?
Almost daily, I started to realize when I pick up from my dad, he's been with Schwab for a long time.
Jim, my financial consultant, I programmed that 20 years ago.
Jim's really been there to answer.
I've been here for you.
It makes a huge difference when you have someone.
That's correct.
Live insights.
I'm just going sideways. Something's got to happen
Schwab
here.
Network connects the headlines to the why in real time. Watch free 24/7 at
Even the QQQ. Be right back. Get water.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey, and we are starting these shows today. We have really been looking at markets for the last several sessions now, Alex.
some weakness, and today it's a bit more, I would say, mixed across the board. Yesterday we were looking at pretty consistently, the overall index is down about 1%. Today it's not as equal felt. You can see the Russell is actually only down about 0.5%. The Dow is only down about 0.25%, but some more substantial pressure today that we're seeing in the Nasdaq, that's now contracting by about 1.4%.
Yeah, when you look at this, I think that the only way you can make sense of today is to look at the context of the week, but really, this is a month-long story now, I think, Jenny, in the sense that at least the shorter-term story has overnight the futures try to bounce back. We open, a little bit higher, and then basically immediately, but throughout the day, things deteriorate. Now, they haven't completely fallen apart, and it still seems to be kind of a back and forth battle amongst these big tech stocks, but I've been saying this for a month now. It seems like, from the price action, that every rally we're seeing in the NVIDIAs, the Oracles, the Broadcoms, you know the names, the AI trade winners, is being met with some sort of big money selling rotating out of these names. Now, I don't know how to quantify that, other than I'm just watching it happen. They open higher, and then they end lower. And it seemingly happens every single day. But they continue to open higher because there are still plenty of investors, whether that's retail, institutional, it doesn't really matter, that are also interested in buying some of these names after the sell-off that we've seen. And I think it's safe to call them a sell-off. I mean, NVIDIA traded over $210 a share. Oracle traded, what, 300 and something a share? It's $180. Like, the stock's lost like half its value in a quarter.
I mean, so to speak to that, NVIDIA, we pulled back almost 19% from those highs that we were pretty much at the end of October. So it hasn't been that long that we have seen those highs, but we haven't been able to recapture that upside. And I completely agree with you in the sense of that. I was listening to someone today that was saying basically they don't buy into the rotation trade, they don't buy into that tech. And I think that we can safely say yes, it's really driving force of this market as we go into the broader outlook of 26. But for right now, I mean, like, if you're looking at trading short-term volatility, I mean, it's been a different environment where I've been so used to it actually starting the day lower, always ending the day higher, and resiliency is way better.
Yeah, so this is tough. This is where, like, putting a simple explanation over something doesn't necessarily work in something as complex as a financial market. There's clearly rotation happening, but that doesn't mean that it's a trade, if that makes sense. So I think it's pretty clear when you still have, even now in real time with the market down 70 basis points, almost 55% of the stock's higher, that there's some sort of rotation happening because there's money coming out of some of these big mega cap tech hyperscalers. But there are names like Netflix, there are names like JP Morgan or Costco or Boeing that I'm seeing that are higher on the session that really aren't AI hyperscalers. So it doesn't necessarily mean that tech has to struggle for this rotation to continue, but there's clearly, and this would make sense, right? If you've been involved in NVIDIA for the entire year or for a couple years now, and you're starting to see the stock pull back a little bit, it's close to the end of the year, you're thinking about positioning, you're doing rebalancing, like sometimes it's just prudent. And then on the other side, if you've been watching, because maybe you made the decision to rotate out of NVIDIA a year ago, you've been watching the stock do well, and you see opportunity now that the stock's pulled back 19, 20%, or Oracle has lost almost half its value. So what is cheap to somebody can still be expensive to somebody else. That's why we have markets.
That's a very good way to put it, and I mean, to speak to that, it's not even just, NVIDIA, that tends to be where we start, but like Broadcom right now is facing towards worst three-day stretch since 2020, so it's being definitely felt in the real boom, I would say, the booming force of AI, which has been, I mean, NVIDIA, Broadcom, but even outside of that, some of these memory disk makers, which have seen nothing but analyst praise as we approach a year, they've also seen
the final thought on this, and it ties into this, the reason we talk about NVIDIA is with NVIDIA down $5.40 here in real time, that's equivalent to 15 negative points in the S&P 500. If I were to look at, we're basically down 45 points, that's 1/3 of today's move. Okay, no other name is anywhere near that, but you mentioned the other one that's close-ish, and that's Broadcom, with its near $18 pullback today, it's about 10 S&P points. So comfortably, I can say those two names are accounting for half of the market's markets decline actually a little bit more than half the markets decline in real time. So yeah, that's why we talk about these names, and that's why we talk about this AI trade so frequently. Not just because it's next gen, not because it's a fun movement. It's because it matters mathematically a lot.
It does, and you can't argue with the sold numbers, frankly. I mean, there's a reason, again, we discussed in video so heavily that we
68,
so much,
780s at $2.
Some of that tech discussion throughout the next hour will be focused on a lot of these analyst calls and some movement we're seeing in these individual equities. Starting things off with a lot of these analyst calls as well as earnings mover, and we'll dive into some charts of names that we're seeing some upside today, at least as far as the sell side is concerned, those being Reddit as well as Shopify. And then we'll discuss Tesla, which actually closed at its first record high since December of 2024. Initially, it was looking like we could see another high today, but now it's pulled back pretty substantially on session. So a volatile name, December always feels very volatile for Tesla, always giving us that news catalyst to really parse through. And then we'll be discussing General Mills earnings as well as some broader trends to watch for here in AI, as we are seeing more and more of the workforce comprised of Gen Z, Gen Alpha, and then we'll close things out with Keurig Dr. Pepper with a downgrade out of Jefferies today.
And what did they say? History doesn't repeat itself, but sometimes it rhymes. And in Tesla, it does seem like it's very comparable, very different, but at the same time, very comparable to the end of last year. New all-time highs and almost immediately, kind of swinging lower. So fascinating stuff. Looking forward to that conversation with Marley for FOMO to discuss Tesla. Let's get into Lennar. We talked about this one in terms of charts yesterday. We looked at example trades. We talked about kind of the reason being around this earnings. Now, I would say they have been coming into this earnings report kind of acknowledging a challenging market environment. I don't know that they left the street feeling very positive about how they're dealing with that challenging environment, given some of the numbers.
Yeah, I would say pretty mixed bag as far as their quarterly earnings were concerned. Housing and high housing costs are still definitely a central problem for consumers. And their co-CEO did mention that builders are not able to fix this all on their own, as we did see, again, some very mixed numbers. So all in all, just earnings per share did miss at $2.03 versus expectations of $2.41. And then we did see, again, fourth quarter earnings were fairly mixed. The first quarter guidance, I think, is more of what's driving a lot of the pressure today, that missed expectations after the close yesterday. So we did see for the full year, they did report earnings of roughly $7.98 per share. That was slightly, better than what the street had expected. They do expect new orders to range between around 18,000 to 19,000 in the first quarter and around 17,000 to 18,000 deliveries. Those were both lower than the new orders we saw, as well as deliveries that had been expected. Also anticipated margin on home sales between around 15 and 16% was also a miss as far as the street was concerned. But we are seeing overall weakness, frankly, in a lot of the U.S. home construction, like the U.S. construction fund. You're seeing, pull back pretty substantially. To me, this narrative though wasn't anything new or even that exciting. I'm not saying it's not exciting, because I think it gives great trends on some cooling markets being that in housing. It feels very reminiscent of everything we heard from these CEOs last quarter, where it's not really a new narrative. I think that lack of enthusiasm, lack of really upside catalysts going forward is why we're seeing this pressure today.
Yeah, I like how RBC analyst Michael Dahl put it. When our fourth quarter orders and initial first quarter guidance fell well short of already lowered expectations, Barclays added that the weak first quarter guidance also highlighted that even if the deliveries rise, it would come at the expense of margins. So it's also highlighted by the fact that you mentioned that 203 adjusted EPS that they reported for the fourth quarter. That number was 406 last year, so it's been cut in half. So yeah, tough comps, tough everything it seems for Lennar right now, and they acknowledge that as well in some of the commentary from the co-CEO, saying that the affordability and consumer confidence remain challenging even as interest rates are moderating. So in some ways, they're running out of excuses here, Jenny.
They are running out of excuses, but I will say to shift gears into actually a surprise winner of this year, especially as far as Black Friday data was concerned and overall just traffic. We have seen, Gap
has seen a 12.5% climb in just foot traffic from 2024, and visits across all 4 of its brands also seeing some nice upside, up 6.4%. So this is all per Placer AI, but they did call this name one of the surprise winners of some recent shopping trends we've seen here. And shares are also higher today. Most in the back from some upgrades, though. We see Baird upgrade shares to outperform from neutral. Price target was raised to 33 from 27. Citing though the overall turnaround of the company as well as just cyclical tailwinds. They said that with expectations now for a better spending backdrop as well as greater exposure to fashion names with higher earnings to torque the overall just warranted upside. They do believe that the turnaround remains in the early to mid stages with momentum specifically at Gap and Old Navy. Telsey Advisory also did upgrade shares to outperform from market performance with a price target that was also hiked to $32 a share from 26. Looking into 2026, they said tariffs are not expected to cause a further operational income decline on an annual basis. What they said, meaningful benefits from mitigation efforts beginning in second quarter, and what they said is throughout the rest of the year. So lots of bullish activities. This game now has a pretty strong overall conviction from the sell side.
Yeah, no doubt. Not a ton to add. I mean, I think you covered that one pretty thoroughly. And in the case of Gap, this is just another example of these resurgent brands of yesteryear finding their way in 2025, perhaps into 2026. But let's talk Airbnb. You know, when this one first became public, I don't know how many years ago it was at this point.
I remember.
Several years. You know, I really thought this would be a name that we talked about a lot more than
Me too.
we actually talking about it. It doesn't seem like it gets a whole lot of run.
It doesn't. So, I mean, we've kind of been more quiet in Airbnb, which has not necessarily been a bad thing. I know we've seen some volatility in these scores and exposed names, but today, at least with the 2% move to the upside, RBC Capital upgrading shares to outperform sector perform. Also raising
We did have a move today.
145, and they do see an increasingly attractive brand monetization story, saying that first-party data is likely worth a premium in the evolving consumer AI landscape.
Look at that.
So they're overall bullish on their entry into hotels as well as these incremental room nights as a driver and a potential entry point now into outsized profits from these promoted listings. So the recent analyst activity has actually been pretty strong on this name, but right now, overall recommendation is about at a hold.
So I know that you kind of, you lived in this hotel world in your real life growing up, given some of your family ties to in their careers. Is this another example we talk about all the time where things just swing on the pendulum just so far, and sometimes we overcorrect in the sense that, not to say Airbnb was a fad, but kind of that it was, and then now just traditional hotel model, at least for corporate travel, has returned with a vengeance, and maybe some of these lofty goals,
Stretch, Alex.
and VRBO, and I'm sure there's others. They were going to replace this whole industry and turn it upside down. Reality is, there's still taxi cabs on the road, even though Uber has upended the industry.
And that's the thing, I do think that this was always it still is a formidable threat, but it's also a different business model, goes after more leisure travel, and I think that we've seen a resiliency from a lot of this corporate spend and international travel returning, and that's what's boded so well for hotels, where Airbnb is struggling to grow in a space that is fairly saturated.
So my question is then, is it less that it's disrupted hotels, which it objectively has, and more has now disrupted maybe, and I know Expedia has ties to this, but the Priceline, the Expedia, the Booking.com, the travel agent world?
I think that's what it's trying to do now, because it does see a niche in experiences and offering more of that well-rounded type of travel experience. However, I mean, the OTAs are also in their own world. They to me are almost like advertisers at this point. They do pay pretty heavily to be at the top of various search engines. I mean, they pay. There's such big deals that are being made with some of these massive conglomerates, like your Booking, your Expedia.
It's going to be ChatGPT or Gemini before long too. I mean, Alphabet and Google is already a formidable threat on that front. So yeah, I think it's unique in the sense, but it's also not so unique in many other ways. And it just seems to me, and I'm glad you kind of agree, it sounds like to me, that it was just one of those victims of the hype cycle once again.
I know, and the pandemic travel boom where people were able to stay at Airbnbs for long term. I mean, it was a wonderful opportunity and ability to travel in ways you never have, but now seeing things normalize, and frankly, Airbnb from a price perspective not looking as encouraging. Although, hey, we're up almost 2% today, so that's That's really something. But our last name today, Constellation Brands, and the name was met with lots of weakness, lots of analyst coverage. It does not look as favorable. We're only down though 1.1% today. But Jefferies did the downgrade to hold from buy. Price target that was reduced to 154 from 170. Now in July, they did believe the sell-off in shares went too far with easier comps leading to better visibility. But Hispanic consumer fears are more prolonged than they had previously thought. They did this way on the top line results regardless of the strength of the various brands, and they continue to further contend that the current fundamentals lack any support for an inflection. So we've also seen downgrades from other firms like Piper Sandler. Consensus price target is 182, so that would obviously imply some upside from here, but analyst sentiment remains fairly mixed as we recap this year, and you're just looking at a lot of these names with not only just consumer staple exposure, but I mean anything right now with alcohol or this, more so, I would say like beverage exposure specifically has been a bit underperforming. I mean, a lot of these staples, when we look back in the year, just not the growth story. I mean, the complete absence of growth is really what we've seen from a lot of these names.
Well, we just not that long ago had Martin Lodovex, the MD and president of IWSR on, and as someone who works in that space, they're having a hard time, really painting a positive picture. And that was my takeaway from that conversation. I'm not sure if yours was, but it was data saying Americans are drinking less. And you can say it's not a lot less, but less is less. And in a world where we're fascinated and obsessed with growth, less is less.
Less is less, and I think that we've seen so much of this blamed on like the younger generations, but there's also, I think, something really interesting about like the evolving trends, the entry into more cannabis-based beverages, and just the overall evolution of a more sober, curious environment I think we've seen in real time. So that's been definitely interesting to watch. Not though great if you're looking at Constellation, which is down now 36% nearly on the year, and about 40% from its high that we are about a year away from at this point. So we'll leave it there for the top of our show today. Coming up next, we'll dive into two names that are seeing some analyst favorability today, those being Reddit as well as Shopify. And both names actually faring the session quite well. Reddit's up about 3.8%, and Shopify giving back some of its earlier strength, still about 0.5%.
To what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your number one broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl?
Schwab, a modern approach to wealth management.
Whether you're a bull or bear, you want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time for Chartmaster. We are discussing two names of upside today in both e-commerce types of environments. I guess online would be the better way to put it. By joining us is our Chartmaster 50 Cat. We're talking Reddit as well as Shopify. So Reddit's actually, I mean, the leading force today is we're up about 3.9%, almost 4% on the session here. So walk us through the latest and greatest from Reddit. I will say, this is my favorite of all social media, the most useful place if you ever have the craziest question, someone else on Reddit has already asked it.
Yeah, it's interesting because it's real people who are kind of answering the questions rather than just broad general stuff. Especially Excel VBA, you guys are always great, thank you. So anyway, trending downward. Starting at these highs near 282, connecting these subsequent highs here, that's about where we're coming back toward today with this rally that we saw. We topped out recently just above 240 though, so we still haven't quite cleared where this red line is just quite yet here, so that would be another threshold to watch out for. When we look toward the downside, we can see our green line, 177.77, nice row of 7s there. That was our low point that we saw after our gap to the upside. We bottomed out around that area 2 more times, but for the most part held from a few intraday lows beyond that point here, but mostly that level near 177, 178 stands out as a downside supportive level. Below that even, you could also look toward here. This was another noteworthy point, the start of our gap to the upside near about 150. For now though, we can see that the shorter term lows right about here near 215 or so, that could be another mark to watch out for. When we include our moving averages that we follow here, we can see that price has pushed above our 2 shorter term EMAs, 21-day and orange 63-day exponential moving averages here. The faster 21-day remains above the slower 63-day. They're still slightly diverging apart. When they start to move toward each other, that's one of the early warning signs of potential trend change. So be on the lookout for that if we do not manage to take out some of these hurdles that we described earlier. RSI, our measure of momentum, shows that our downward sloping red trend line has been broken. Our upward sloping green trend line is still in play. We also still remained above the 50 midline here during our decline, at which we held on in terms of closing prices, at least to our 21-day EMA. So that was a bit more of a positive sign for the bullish crowd as well. Finally, when we look at our volume profile study, this area stands out right here between 200 to 220 or so, a bit of a larger range, but that's where the significant volume activity is. You can also see that our teal linear regression line lines up quite closely with the 63-day EMA, so that's our fair value line, our line of best fit, as it's sometimes referred to here, lining up with our medium-term moving average. So notable supported area near about 211 by that measure as well. To the upside, volume starts to drop off very significantly once we get above those recent highs near 240. A minor amount of activity again once we hit 260.
Yeah, and again, it is making a pretty decent pop today, and so I know it hasn't been necessarily an easy and a straightforward year for Reddit shares, but also just at least seeing some positivity today. So all that to be said, as we do think through now trading Reddit for example purposes, Alex, leaning into perhaps some more of this upside we're seeing today.
Yeah, I think from the moving averages that Rick talked about, sloping upward, shorter above medium term in terms of length indicates positive trend. If you believe that's going to continue, neutral bullish strategy using that 1 month exponential moving average as a potential support line around 220. It's the 222.17.5 short put vertical. Now with this, I should say, and this is just one way of thinking about it, of course, just an example, but we're getting to those last few weeks of the year. Many traders, many fund managers probably are thinking about, locking things up for the year in many ways. It's been a strong year for market bulls, and this is the way to potentially be involved to the end of the year. It expires on January 2nd. But all things considered, it's a risk-defying trade. It's relatively compact in the sense that it's a $2.50 wide spread collecting 75 cents. So it's a way to be involved, be kind of in the market, be trading, but also not necessarily potentially risking a tremendous amount in the last few weeks of the year. Nothing more demoralized and then give it back a year when you got a couple weeks left in the thing. So all things said, 75 cents means $75 max profit, $219.25 is the break even with the max loss of $175. Stay above 220 through January 2nd. This one has a chance.
Okay, now to look at another name that is also exposed to consumers as well as just the online world, that being Shopify, and was a bit higher earlier today. We're in real time just sort of racing that strike, but all that to be said, this is still been a really nice performance this year.
Yes, one of these charts that kind of seems to have two phases, oftentimes punctuated by earnings. That's what happened in this case here. We had a very sharp rise on earnings here. We never really looked back in terms of filling the gap. We did hit some lows here, near about 136.68 was where we saw our worst close. For the most part, we held on above that level. That's about where we touched down once again during our most recent descent. You could also say it kind of looks like a head and shoulders type pattern here. We've got our first shoulder, our head area right here, our second shoulder right about where we topped out that first time here before we formed our head. Then the neckline area could be around that same area that we were just discussing here near 140, 135, the general supportive zone. So just something to consider. Typically regarded as more of a bearish type of pattern here, but really it could go either way. These things are not guaranteed to be sure. Rising wedge type shape here between our two blue lines. It looks like we're breaking through to the downside. Again, this is a more bearish type of pattern here. So just for more food for thought that the setup from a conventional viewpoint would be perhaps you'd be more interested in a downside situation here. So we can also see now that after we touched on our orange 63-day EMA and crossed through our yellow 21-day, we did get a bounce. We're remaining above those two moving averages here. They are still very modestly trending toward the upside and diverging apart from each other. RSI interrupted though. Our green trend line has been broken. We do remain above that 50 midline here, but a bit of a question mark now that we can see that our short-term pattern and the RSI both are seeing downside breaks. Finally, volume profile shows that the heavy concentration of trading activity comes in right here. This was our green line here. That was a relative low point, right about 149, 150 or so. That's the area of interest to the downside in terms of volume, much like our last chart too, a small surge of activity to the upside. In this case, around 175 or so, near those old highs. That would be an upside area to watch as well.
Yeah, we did also see a pretty positive note out of Wells Fargo today, which did raise its price target on Shopify to $198 a share. So obviously implies, some decent upside from here, well over $30. So definitely some mixed analyst prediction, but overwhelmingly positive as we go into the back half of this, or the end of this year, excuse me. But appreciate it, Rick, for that technical setup here. And now as we do think through trading Shopify, for example purposes, it also has been a nice performer this year, but hoping for maybe more of the same to close out relatively less volatile.
Yeah, it might sound like deja vu. I thought the charts are quite similar. The stocks are both sort of in this internet disruptive age in terms of what they're bringing to the table fundamentally in their respective businesses. And the example trade's almost identical. It's a short put vertical, expires January 2nd, it's $2.50 wide, and it's collecting 75 cents. So with that, max profit again would be 75. Because it's the 160, 157 and a half in this case, your break even would be 159 and a quarter, and that same 175 risk. Again, just one example, one way to think about it. But with that, stay above 160 through January 2nd, and the trader who deploys this type of strategy will have a chance to make that credit, in this case, that $75 max profit.
Yeah, and Shopify, again, I know it's been fairly resilient and again, a difficult environment to gauge the consumers of the forward-looking expectations, but only there for Chartmaster today. Coming up next, it's time to dive into all of the volatility we've seen as of late in Tesla, as shares did close at a record high yesterday for the first time in over a year, but now pulling back on the session by about 3%.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPedalides and connect with me, Nicole Pedalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live
is Trading 360. I'm Marley Hayden. We track macro forces,
Real
trends, and
piddly sticks.
shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market
Sideways action on AMD.
11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me. And my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. It's now time for FOMO and daydreaming. This is Marley Hayden, host of the Schwab Network, and we've briefly discussed Tesla on this segment specifically. But I will say that the FOMO feeling is being erased in real time, because now we're down about 3% early.
Yeah, the FOMO feeling is being erased in real time today. We are down a little more than 3% for Tesla after they hit a new all-time high. So they were having a great day. They hit an all-time high yesterday, another one earlier today. Now we've since reversed and lost all of those gains that we saw from Tesla. Some of it on this headline, some of it in the broader tech pullback that we're seeing. California is now threatening to ban sales of Tesla vehicles for 30 days after the DMV decided that the Autopilot, which is being used for its driver assist features,
No way.
advertising in the state. The California Department of Motor Vehicles could have halted the sales in the state immediately. They decided not to do that. They are putting that on a 90-day pause. So that action's on hold for 3 months in order to continue negotiations with Tesla about no longer using the term autopilot. It said in the statement that Tesla cars do not live up to the promise suggested by the term autopilot because they are not capable of operating as fully autonomous vehicles. Now, this was decided in the court of law. The DMV first brought action against Tesla back in 2023 on the use of that autopilot term. The two parties have since been unable to reach an agreement about its use, and Tesla will not stop using it. So now the courts have intervened and ruled that that term is not being properly used. It's misleading as a misleading advertisement. So if Tesla wants to avoid the halt of those sales, it will likely need either a court action to block the DMV's action, or it will need to stop using that term, autopilot. This DMV said Tesla can take some simple steps to pause this decision and permanently resolve the issue, but Tesla criticized the action, saying on X, quote, "This was a consumer protection order about the use of autopilot in a case where not one single customer came forward to say that there is a problem. Sales in California will continue uninterrupted." So we have seen Tesla make some changes already to some of the formal names that it uses since 2023, when this first started. They changed the formal name of its more extensive full self-driving features to full self-driving, and then in parentheses, supervised. They made that adjustment, though Elon Musk and fans of the car simply refer to it as FSD, but there is a change to it. It does say supervised after it. The autopilot mode that's in question here includes things like driver assistance features that are found in a lot of cars, like automatic braking, reducing the speed when a slower-moving vehicle gets in front of you, and blind spot alerts. Full self-driving, even the supervised version, is supposed to be able to essentially drive the car for you, even if the driver is supposed to be on alert and ready to take over, which Tesla does include as a part of its commentary about what full self-driving is. Now, important to note, California is a key market for Tesla sales, and it's home to one of its two factories. In fact, the DMV could have taken more action here. They could have postponed those sales from taking place, and also dropped an immediate recommendation to have the judge stop Tesla from temporarily making cars in the state. They did not take that course of action. They are trying to work this out with Tesla, giving them that 90-day hold. But Tesla shares hit another record high today before falling. So far this year, they are still up about 17.5%.
Yeah, kind of seems like this is an ongoing bad breakup between two parties here. I mean, of course, famously, Tesla moves its headquarters in like late 2021 to Texas, and suddenly all these problems pop up. But when you think about Tesla, this is just another day in the stock, and we were joking before, Marley. You know, last year this time it surges, makes a new high, the next day it makes an intraday high, and then it turns around and closes sharply lower on the day. History doesn't repeat itself, as they say, but it famously sometimes rhymes. It's rhyming quite a bit, it seems like.
Yeah, it is. I do want to comment. There has been some sell-side commentary to these headlines. Goldman Sachs came out, said in a note that they do not expect any sort of disruption to its business in California following this note that they may potentially have their sales suspended for 30 days if they don't give up this autopilot. They said that Tesla has time to comply, and given that Tesla has changed or used alternative names when marketing its autopilot features in the past, they maintain their neutral rating and a $400 price target on Tesla shares. But Tesla shares still trading well above that $400 price tag right now at $473.71, even with this more than 3% move to the downside.
That is what's so wild with Tesla. It does feel like, I mean, it has been this way for years at this point, but it always trades. It feels like above the average conviction on the sell side, which is just abnormal, especially in a high growth cycle. But it goes to show the very polarizing convictions we still see that do tend to face Tesla when it comes to the outlook. And a lot of different opinions from analysts. As we know, there's the very much bulls and very much bears. So that's the nature of trading. And to Alex's point, this is just another day for Tesla. So when you think through then trading this day, the difficult task here, I mean, volume is actually relatively historically low given the fact that we were at those highs, but now in time we pulled back about 4.5%.
Yeah, and just a couple days ago, I think on the same segment, we looked at an example trade that was looking for Tesla to maybe get to $500 a share in that area by the end of the year, and it looked like we were on track for that. Maybe we still are, but because the stock has pulled back a little bit, it can open up the strategy playbook just a little bit if you're bullish on this stock and want to deploy a more neutral bullish strategy. And so I looked at the 450, 445, January 16th short put verticals, very similar to what we looked at in Shopify as well as in Reddit in the previous segment. Say you were able to collect about $1.70 on this example trade, your max profit would be $170 on $330 in max risk. Break even would be $448.30, and again, a risk-defined strategy, guys. Into the end of the year, this one actually carrying over into the middle parts of next month, but leaning into some of the intraday weakness today, and still taking a little bit more cushion if it continues over the next several weeks.
Yeah, and of course, I think we were hoping to see some more positive momentum today, but frankly, the news cycle wasn't very positive. They've been able to shake off any sort of turbulence over the last several sessions quite well today, catching up with shares a bit. But appreciate it, Marley Caden, host of the Schwab Network, for all of that insight. Now, coming up next, we'll discuss AI in the broader workforce, as we're seeing more and more evolving trends, especially driven by these Gen Z and now Gen Alpha consumers.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
Carl's Way.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are. Morning Movers brings
I haven't seen nothing yet on my watch list.
From volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network. Welcome back to Next Gen
investing, it's now time to discuss an earnings mover today. An earnings mover, that's the upside, which was a well-needed catalyst for General Mills, which is still facing overall pricing pressures, but actually saying that prices are at a right place, the right place where they need to be. So that's at least encouraging.
More drama.
Breakdown on these recent earnings is Dan King Hall, the host of Morning Movers. So Dan, I will say that headline numbers didn't exactly look great, but hey, a 2% move for earnings down still 24% on the year is definitely encouraging.
Yeah, they absolutely needed this one. I love that we're talking breakfast staples at lunchtime here. General Mills seeing shares move higher off the back of beating expectations in its most recent quarter. They did beat on both the top and bottom line. Adjusted EPS came in at $1.10 per share. That was better than expected. Revenue coming in at $4.86 billion. You can see right there what the street was looking for, $4.78. So they beat expectations. Revenue did decline year over year, but again, it was better than what Wall Street was expecting. What was interesting to me about the strength, because I thought this was a story initially when I just saw the numbers at first blush, the headline numbers, that this was people returning to the cereal aisles. The greatest strength was actually in its pet category, which saw growth of 11%. While North American was weak. International sales did grow. That grew 6%. In terms of guidance for 2026, the packaged food giant projected EPS to come in a range of $3.58 to $3.79 versus expectations of $3.65. So there's some, some strength there in terms of where they see versus where the street sees. Organic net sales, they're maintaining their expectation there. They're expecting that to come in a range of -1% to +1%. What is interesting about what the CEO said on the company's earnings call is they continue to see consumer weakness for those, particularly for those making under $100,000 per year. They had to lower prices to get consumers back, to get inflation-weary consumers back. They lowered prices across 2/3 of their portfolio. So that certainly seems to stoke some demand. They said that consumers are still being stretched, even consumers in the high end of the range. But they said they're faring better because of the current stock market. So they said that the pricing has worked. What they do see is product moving more when there is more discount, especially for consumers who are earning less than $100,000 a year, guys.
And I think we're all great points, especially in regards to some of the pricing structure and just like the average income of consumers that we're seeing really change some shopping habits. And I can definitely speak to that. I was going on a whole spiel yesterday about how the price of cereal in Chicago is now like $7 a box. I mean, it just feels ridiculous, and it just makes me mad because I'm a cereal enthusiast. So it's always a good time to talk about cereal day, even if it's a definitely fast little lunch hour in New York. But we appreciate that great summation of General Mills, an upside mover on the back of earnings. But now to shift gears into a very much favorite topic on next-gen investing, that's all things AI. I'd like to welcome in Ishraq Khan, founder and CEO of Pedesi. So I will say, first and foremost, congratulations on all of your success. I mean, you launched Pedesi at 19, you scaled it to 150,000 users. Really, what gap, though, are you seeing in software development that helped convince you that this was the right problem that, of course, needed to be solved?
Yeah, definitely. Thank you guys for having me. One of the key early problems my friends and I realized when we were just in school was we would be spending so much of our free time in class trying to fix coding mistakes. And this is a major issue that a lot of companies face even now, where there's bugs and issues in code bases from enterprise companies to small businesses. And that's really, I think, the problem we're trying to solve, and a lot of companies are trying to solve within the coding spaces. How do you eliminate bugs and issues from code bases all at once using AI, and how do you boost productivity in the coding segment and coding segmentation with AI itself?
Yeah, and so it's clear that you are a forward thinker here, Ishraq. You saw a pain point in business as a young man while you're still in school. You worked with a group of trusted people. You build a solution for that, and now it's about scaling it out and getting users and delivering on that promise. My question for you is, our viewers are primarily self-directed retail investors. As clearly someone who thinks about this and where things are going and how these technological changes are shaping, what are some things that investors could take away in how you're viewing where we're going that maybe could be actionable? So what kind of augmentation do you see, I guess, AI having for everyday companies and places where that investment opportunity might exist?
Look, I think the majority of companies, if you're at any scale, whether you're small or even larger company or even enterprise Fortune 500s, everyone's really trying to implement AI at any level, and it's really what they're trying to do is say, okay, where can we apply AI in the best way possible? And so currently, a lot of companies are just trying to put AI into everything, whether it's not even needed. And so I think the companies who are doing it well and the companies who are going to be on top doing it really well efficiently is the ones who are solving problems that are requiring a lot of workforce in itself. So things that might take up 10, 20, 30 people, where now companies are saying, hey, we can actually replace 20, 30 people within the company, within the organization, and have that just be a one-person job. And I think that's what we're starting to see happen in a lot of those large companies, especially given layoffs in sort of those large tech companies where they're realizing, hey, we can replace a lot of these developers or replace a lot of workforce or sales jobs now with internal tools that we've built out.
Okay, so looking ahead into seeing into the future, which is very difficult, but what does coding really look like when autonomous systems continue to evolve software with this minimal human input?
Yeah, no, I think the future of coding will definitely change, right? From how you're learning to code now at school or wherever to how you're able to code in general in the future itself. And I think we're moving on to this autonomous coding level where in the future you'll be able to essentially talk to essentially maybe even your Alexa and say, hey, I want to build this tool or build this software, and you'll have it in your computer in seconds rather than going through various different processes and steps and actually typing anything at all.
Okay, so Ishrak, I'm sure you have plenty of friends who didn't have the forward thinking that you did, maybe didn't have the ambition, they didn't build a software company at a young age. They went to school, maybe they wanted to go be an accountant or be one of those salespeople that you're talking about. I'm going to go back to something you said 2 answers ago. You know, one job or one person now being able to do a job they maybe took 30 before. Is there nervousness amongst your peers in terms of finding a way in this ever-changing landscape of the labor market? And with that, I think back in time, I'm sure a lot of these conversations were happening 25 years ago in .com, and we're all still, you know, not all, but a lot of us still got jobs. They just maybe look a little bit different. What are your thoughts on that?
Yeah, I think obviously there is a factor and a percentage where AI is replacing a lot of human work and a lot of human overworked people and tasks. But I think AI isn't going to replace employees 100%, right? It may shrink a small percentage, but there is this larger percentage that AI can't replace, things like strategic developments or creativity and various things. So AI can only really focus on a mechanical layer, and I think there's a completely different layer that only humans can really develop in, and I think those jobs will be higher in demand. Even in general, when we're seeing software development jobs right now, there's not much demand for software developer jobs, but rather AI-centric jobs where, hey, I need a developer who's really good at prompting and prompt engineering rather than actually developing software themselves.
Okay, so if you could give advice, say to yourself 5 years ago, what would you say is, what you could change, what would you do the same, especially what you know now about the build into autonomy, the build into AI? I mean, it's obviously difficult to look back, but what would you perhaps do differently?
Yeah, I think the biggest thing I would do differently is actually learn more about AI and actually immerse myself more into the technology. And I think right now we're seeing that happen where a lot of people who are just new to software engineering or new to anything, they're doing more research, really diving in and understanding what AI actually fundamentally is. And I think the more you understand it, the better you are at using AI. And a lot of people who are even using ChatGPT or whatever AI tool currently that they're using it on a daily average basis from the average person having zero knowledge about how to use it or how to prompt it. And I think the biggest jobs in the future and even daily jobs or tasks will be, I'm really good at prompting ChatGPT or prompting AI to perform these actions better than other people, whether it's for my own task internally or whether that's your job in the future itself.
So becoming good with the tools as opposed to maybe good at doing what the tools are seeking to do. But that ties to my last question here before we let you go. Ishrak, if you're talking to somebody who's maybe going into school and thinking about where they want to bring their career, what would you suggest the next generation focuses on to best prepare themselves going forward?
Yeah, honestly, I think every education standpoint, whatever path you're choosing, still matters, right? If you want a computer science degree, you can still get that degree. If you want a marketing degree, you can still get that degree. But I think from internally, what we realized, as well as talking to other folks at various different company stages, what we realized it's really easy to build software tools, and it's really easy to build different things that you wanted to do before without the need of understanding how to code or understanding what a lot of these things are. And even when I'm talking to my friends, they're like, oh, I had graduated with this degree, but I work a completely different job. I think the education standpoint is a bit different now, but what I would say is what we've seen is a lot of companies who are really good at this sort of getting employees on a coding level, they don't have good marketers or good people who are actually really good at sales. And I think we're really behind on this AI advancement when it comes to sales and when it comes to marketing. And I think that's what we'll see the next generation of people being, is people who are really good at marketing, really good storytellers, really good people who can understand how to sell whatever they're selling versus, oh, we built this tool, or oh, we're really good at building it. Because building is easy, but actually selling it to people with an understanding is really hard. And I don't think AI is anywhere close to actually selling someone a pen to whatever degree it is now.
And I think that's such a good point. And frankly, it's a perspective I've not heard before, that the sales aspect of things are lacking. I totally agree, and I think it's just a great perspective on what we're seeing really redefined what's possible for frankly young innovators as well as just the broader tech landscape. So it's an exciting time to live through.
Yeah.
And we so appreciate this time, of course, all of your insights into a world that we discuss so very often on this show. I track the founder and CEO of Codeezy. And so we will see now, we'll leave it there, we'll discuss what's next for Cure and Dr. Pepper, a complete shift here as we look at under 30 and dive into another staple that has seen some underperformance this year and sugars are down about 1.4% today.
Opportunities don't stop when the market ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Nicole Bettolini, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. It's not time for under 30. Today we are discussing Cure and Dr. Pepper with some weakness on the session. We're down about 1.5%, and adding to it's now about 12% pullback on the year. But joining us now for some more insights is George Tillis, Senior Markets Correspondent for the network. And so, George, various analyst coverage, of course, we've been diving into throughout the last several days, but Jefferies the downgrade today, so walk us through it.
Yeah, I mean, if you look at Keurig, this one I think we've talked about before on the program. Essentially it's the second largest beverage supplier domestically behind Coca-Cola. Brands like Snapple, Canada Dry, Dr. Pepper, of course, as well as other other coffees like K-Cup. So this is the K-Cup company. But one of the things that's been going on in the backdrop is recent acquisition. This goes back to August of this year, where KDP actually made a play for Peet's Coffee. This is about an $18 billion deal. Stock actually fell and has actually been down since then. And so what's happening now is there's a couple of things to be expected. First off, if you look at Jefferies, they've actually downgraded the stock to a hold for buy. I can see their point clearly here at the $32 price target. The acquisition itself is going to be manifesting into two separate companies. That'll be essentially the beverage company as well as the coffee company. So that's something to keep in mind going forward. But the challenge is, irrespective of the fact that Jefferies does see that they'll hit their revenue guidance and targets, there's really a manifestation of the debt load and the financing conditions behind the deal that they made, which was about $18.4 billion, as well as some volatility in coffee prices. So that could, of course, impute some challenging calculations towards what they can expect for the coffee division to manifest in their earnings. So But if you look at the price target, 32, and just look at the stock price as of late, it's been in a trading range with about the $32 area, somewhere in the middle. In the last 3 years, the range has been between 36 on the high side and 26 on the low side. So the stock is bouncing off that 26 level in the past few weeks, and Jeffrey's basically looking at this as a hold right now because the expectations are for the first half of 2026 for this deal to manifest. There's just some structural challenges with the financing alongside KKR and Apollo, which are now providing some debt financing for the company.
George, do you think this trend of sort of separation as opposed to consolidation, you see it with GE, we've heard other companies sort of whisper about it, Keurig thinking about it, this is something we'll continue to see?
There's always going to be, acquisitions, dispositions, spin-offs, acquisition, and of course splits. In this case, that's the nature of structured finance and capital structure. So we saw this, as you mentioned, with General Electric. Obviously, that was a success across the board without a doubt, just looking at all the performance of the broken up pieces. Here in this case, it wasn't necessarily that they're just spinning off two businesses that already exist. Keurig also had a coffee business. I'm sorry, KDP also had Keurig. But now they're adding in Peet's. So they're adding in a coffee business to essentially split all the coffee business out. It's a little bit different in this case than General Electric. But nonetheless, there's a potential for value unlock. But what's happening here in this case is they're having to absorb an acquisition before they make the spin-off. And that becomes a little bit more challenging, maybe in this market environment with debt issues, interest rates, and so forth. And so that's why I think Jeffrey's a little bit more cautious here. They're not saying to sell it, they're not saying to buy it, they're basically saying hold it, if you hold it, and this is why the stock is in that 3-year trading range. The dividend is pretty substantive here. About 50% or close to 50% of the earnings get paid out in dividends. And so that's how a dividend-paying stock trades. It trades in a trading range, not a lot of growth, and then of course you harvest the dividends as a shareholder. Typically, if you want capital appreciation, you buy on the bottom of the trading range and sell on the top of it.
Okay, we had a good point about dividends I didn't even think about. And this note obviously also included Constellation Brands, which we discussed earlier in the show. So some choppiness in these tables. Really, it just feels like we're ending the year somewhat where we began in a bit of a lackluster tone. But I appreciate it, George, tell us for that breakdown. And Alex, that will do it, of course, for us for Next Gen Investing. We're ending our show pretty much actually. I know we're a bit lower than where we started here, but the markets are just looking also lackluster.
Crashing in slow motion.
I know, that's exactly how it feels. Great way to put it. That'll do it for us on Next Gen Investing for this Wednesday. We have the watch list coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets
SPX.
The opening bell to the closing bell. We've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on the guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time, with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists.
streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing up houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Good afternoon. Welcome to the Watch List. I'm Nicole Pedalese. It's 2 p.m. Eastern Time. We're coming to you live from the floor of the New York Stock Exchange. So glad you are with us here on the corner of Wall and Broad. We are seeing stocks under some pressure today after starting out in the green. Big show for you today. We'll look at the resiliency of the economy as economic growth that we're seeing forecast into 2026, what we need to know, the latest GDP projections, the labor market, how all of this factors in. Is AI going to negatively impact workers? Conference Board has released a new survey that says otherwise, and Matt Rosenbaum will join us to break down the data. Our panel focusing on those retail sales numbers, also what lies ahead for the consumer in 2026. In the meantime, let's take a look here at the markets. We are seeing the S&P down 1% to 6,733. The Nasdaq is down 1.5%, led by Oracle, 24,717. The Dow is down 186 points, and the Russell losing more than 0.75%. Oil and gold are both higher. Oil's been higher on obviously the idea here about Venezuela tankers and the blockade there. And gold has been gaining about $33. Not too far off from all-time highs. Crude oil 55.89 and gold is at 43.65 per ounce. 10-year bond yields at 4.16, US dollar 98, and the Bitcoin trade still below 90,000 right now, sitting at 85,775. Kevin Hanks is with us. He's live at the CBOE to give us some of his thoughts on the big picture. Good afternoon to you, Kevin. Some of your thoughts, because I mentioned Oracle is weighing. Your thoughts?
Yeah, Oracle's down about 5% as we get to the 2 o'clock hour. Why is that? Well, Blue Owl Capital will not proceed with backing a planned $10 billion 1 gigawatt data center in Michigan, intended to serve OpenAI after negotiations stalled amid concerns over Oracle's rising debt and AI spending. So the decision marks a setback for Oracle, as Blue Owl has been the primary financier and owner of its largest U.S. data center projects. Oracle currently has $150 billion of data center leases in the 3 months ending November 30th, raising its total data center and cloud capacity commitments to $248 billion. So they're looking for someone else to step in. It looks like Blackstone is in discussions with them, but they need to replace their financing. And obviously, that's a setback for Oracle. Stock down about 5%, Nicole. And as you know, this stock was $345, now $179, Nicole.
Yeah, look, I mean, it's down 5%, and, there are concerns about the credit risks here. Blue Owl, we talked a little bit about them now not backing that $10 billion investment. It's very interesting, how they'll get this forward. But in the meantime, Oracle says they're on schedule. Sort of don't worry about it, but people are worried because the stock is down 5%. Let's talk also on the data front. We're going to get some CPI information.
It appears all things are going.
Well, it hit my support line, that's for sure.
CPI data at 8:30 Eastern Time tomorrow morning. The expectations for headline CPI up 0.3. Year-over-year headline CPI 3.1% is the consensus. Ex-food and energy, or the core, month-over-month up 0.2, and ex-food and energy year-over-year 3%. So we'll see. A lot of the inflation numbers have been coming in a bit lower than expected. We just got the wages data and the non-farm payrolls yesterday that came in much lower than expected. So after we get the wages data from non-farm payrolls, this will be the next look at inflation. We'll see how it goes. Right now, we'd like, obviously, some better numbers on overall inflation would set in stone or raise the probabilities of rate cuts coming up in the future.
All right, great to see you, Kevin Hanks. Thank you so much. Live at the CBOE. Let's get a look at the bigger picture. Stosh Graham is with us, Managing Director, CIO at Graham Capital Wealth Management. Thank you so much for being with us. Your thoughts on some of the economic factors that have been coming in and what it means?
In the short run, a lot of the coinciding indicators we're seeing, again, are indicating, as Kevin highlighted, a degree of moderation. You're not seeing extremes on some ends. I know the labor market has a lot of people concerned, but from our perspective, Nicole, of the vast leading economic indicators that we look at, whether it is broadly on the economy, whether it's on the labor market, we're seeing a degree of resiliency. And that has been the story of the United States over the last couple of years, especially compared to the rest of the world. And I think there's a couple variables at play, Nicole. First, monetarily, monetary policy has been easy. We have seen rate cuts. The Federal Reserve has been dovish. I know that's maybe gets politically. There's been
what a boring day.
Polarizing view, but overall, financial conditions have been open to creditworthy borrowers. If you need credit, it's open to you. And now, looking forward over the next couple of years, Nicole, we have fiscal stimulus. There's a fiscal impulse that's turning positive. One big, beautiful bill is a fiscal boon for the economy. It's going to front-run a lot of the fiscal stimulus, while the cuts are really multiple years down the line. So over the next year or two, 12 to 24 months, you're now going to see a fiscal impulse that's supportive of asset prices and the economy broadly in the United States.
Some of the prospects that the Fed put out, I mean, they did say they saw GDP higher, they saw unemployment coming down. What did you think of some of the numbers they were putting out for the next year or two?
It's fairly reasonable. Look, I think a lot of this will get revised, and we're about to see a material change in leadership, Nicole, in the coming months. I would say, again, for our particular focus, we're keeping an eye. Again, Kevin's highlighted in the previous segment some of the difficulties of getting data, whether, again, in this case, inflation, whether it's jobs. For us, there are alternative avenues to watch and monitor the labor market in a very near-term time perspective. Watching withheld employment taxes. You can get that from the U.S. Treasury. Right now, again, a degree of resiliency. You are seeing headlines of layoffs, but we're not seeing this big cascading batch of layoffs, which could really put the labor market under a lot of pressure. Yes, the unemployment rate's continuing to incrementally rise, but right now that's not enough to tip the economy over into any type of hard landing.
And what do you think about the CPI for tomorrow? I mean, what is it that might stand out to you? It was interesting because I saw abroad that, for example, in Europe, the inflation was coming down. That gave the Bank of England the okay to go ahead and cut. What are you going to be watching for here at home for that CPI print?
Yeah, I mean, we're going to take a look at a few of the leading indicators or leading components of the Consumer Price Index or the Producer Price Index. We do spend a lot of time on PPI also. I think, again, in regards to inflation, we're all going to see sticky inflation. There's no doubt about it. We're not going to see 2%. We're not going to see this rise to, say, 5 or 6% year over year. You're not going to see that. Again, you're going to see a moderating, tailwinds in terms of inflation. You're going to see some disinflation when it comes to housing over the next 12 to 24 months. But again, as I mentioned a couple of minutes ago, the combination of easy monetary policy and now with the fiscal impulse, there is a chance for inflation to materialize, but it's unlikely considering the leading economic components that we're watching in regards to inflation. What's likely to happen, Nicole, is you're going to see mid to upper twos. It's going to stay there. Maybe a month or two you'll get 3%, but you're going to be stuck in this area, which again is consistently higher than the long-term goal that the Fed has, or target of 2%.
So the sector rotation and what you think might be working. I mean, I see you talking about a few of the sectors in your notes. What could work for the future, for 2026?
Well, for 2026 banking, we have a focus on small regional banks. We think, especially the small regional banks, as they're not necessarily the constituents you see in a lot of these larger indexes where a lot of passive capital goes. We are seeing a material dislocation between these small regional banks and, say, large cap banks. I think what you should expect, to tie in the previous topic, the Federal Reserve, you are going to see multiple rate cuts. That's going to help bring funding costs down for banks. Maybe not as much as people think, but it will bring it down, and that's going to allow the spread to rise, which should help bank profitability. Again, fundamentals of banks, they borrow on the short end and invest on the long end.
Right, understood. I mean, what do you think about tech overall? I mean, does that remain a leader?
So, information technology, communication services are two sectors we've recently allocated to
2:11 Eastern Time.
I'm concerned about AI. Again, Kevin highlighted the situation with Oracle Blue Owl, which is a situation where
Okay.
credit-worthy type of company.
All right, Stosh Graham, thank you. Managing Director, CIO, Graham Capital. Well, management, nice to see you, thank you. Coming up, Options Corner, Tom White is standing by. He'll highlight unusual object activity that we're seeing throughout this day. Recent news on NVIDIA, Netflix, Oracle, of course. He'll bring us some real trades. We'll be right back.
Do their little bounce.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the watch list. Time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. We welcome Tom White, host of Fast Market here on Schwab Network. It's great to see you, Tom. Maybe before we get to some of the trades you found, maybe just a quick market thought. What you're hearing, what you're seeing.
Yeah, a little bit of weakness here today, but it's led by, a big portion of the major indices, which is tech, right? Information technology, communication services, discretionary get hit a little bit. Earlier, when we were doing our Fast Market show, I kind of commented that S&P 500 equal weight was relatively flat today. So you're still seeing some rotation into sectors that might be considered a little bit more safe than what we saw in tech. Now, the day started off on a positive note, right, before that Oracle news came out, and that kind of put a damper on what was expected to be maybe a little bounce-back rally. But now we're going into the fourth day of losses for the S&P 500 and the Dow index at this point. So, I think there's still a lot of uncertainty out there, whether it's fiscal policy. But I think one of the key things, Nicole, that we should watch is saving grace is that we haven't seen any volatility in the bond market right now. They're relatively stable as far as yields go, which is a positive. But I think everybody's just waiting for the Santa Claus rally, Nicole. And from the looks of it, it doesn't look like it's going to take off anytime soon. But we still have a couple weeks left in the month.
And so many people still have the 7,000 target. The question is whether or not we get to that by the end of the year or not into the new year. So we have to see. Let's get to a name like NVIDIA. You found a bearish trade. Let's hear a little bit about the NVIDIA story.
Yeah, down over 3% today, under pressure. This is probably based on this rotation out of tech. I don't even think it's necessarily based on fundamentals, because if you look at their earnings and their growth rate, about 60% on EPS and revenue, they expect growth of over 40% as far as sales of the Blackwell and Rubin chips.
Slept
And
again.
in 2026, the prospects are good, but you throw that wrench into the mix where maybe the AI data infrastructure build-out starting to slow a little bit. There's some concerns about financing for it moving forward. That's got investors a little bit antsy at this point. Any downturn in the AI market might be some headwinds. And we got some good news recently, right? That, hey, the government's going to open up that they can sell their H200 chip over to China and other countries where it was previously banned. But it feels like there's no news out there that's going to trigger any upside. But that being said, we're kind of in no man's land as far as technicals goes. This 170 level is a really big area of support over the last several months. So we'll see if that holds and we get a little bit of a resurgence. We did see some bearish activity in here that kind of stuck out to me. This was out the January 9th weekly cycle. So about 23 days to expiration. A trader earlier this morning bought 10,000 of the 160 strike puts. Paid a debit, an average debit of only about $1.88 on these puts, so they didn't outlay a lot of capital, so this might be a hedge against a long stock position. But they paid a $1.88 debit for the 10,000 of these puts, so that takes a break even where they start to profits below 158.12 over the next 3.5 weeks. That's about 8% off of the current share price here in NVIDIA. So maybe some protection from a big shareholder, but it could be somebody speculating, just buying some cheap puts over the next 3.5 weeks with the expectation that maybe we'll go lower.
Yeah, well, we'll have to wait and see. I mean, there's also the other side where Dan Ives was saying it's NVIDIA's world and everybody else is just paying rent or something like that. Let's take a look, as you noted, well off the highs. 212 was the high. It's at 171 right now. Let's take a look at Netflix. I mean, obviously we have the big story with Warner Brothers and Paramount, and now the push to reject Paramount's hostile takeover and stick with Netflix. Tell me about the bullish trade you found.
Yeah, it's been a volatile trade, and typically we don't see that volatility in Netflix, but we pulled back about 28% from those all-time highs that we had in the summer. So it's been in a downtrend even without this news. The board at Warner Brothers Discovery saying that we should stick with Netflix's bid, even though there's stock involved there, not just cash. But this is created a quandary, I think, for Netflix shareholders and why you've seen that volatility. We're down 11% so far this month, even with this little bump up that we're seeing today. They expect, the planned takeover of Warner Brothers Discovery to create long-term growth engine. But remember, Nicole, this is still months away. We're going to be talking about this for months, this story, as far as the takeover, because who knows if this bid's going to get accepted by shareholders. We saw that vetting process. Then you look at the regulatory side of it. Does this even get through at this point? So the soap opera is going to continue, to say the least, in this one. But we did see some unusual option activity in here, and this is on the bullish side. On the January 16th monthly option, so 30 days to expiration, the trader bought over 3,000 of the 100 strike calls. Paid an average debit of about 240, so the break even for this trader when they start to profit is above 102.40 over the next month. That's about 7% above the current share price in here. So a lot of volatility in Netflix recently. I expect that to continue, but this trader thinks we're going to see some more gains over the next month.
All right, we'll have to wait and see. I mean, we also know Jared Kushner's team has pulled out, no longer backing the Paramount hostile bid, so I thought that was really telling too. Okay, now there's Oracle. I mean, obviously, we know Oracle is trying to say everything's on schedule, but the stock's down 4 or 5% today. There's a lot more to the story.
Yeah, this has been a volatile name since hitting those all-time highs in September. We're down nearly 50% from those levels in Oracle, and the hits keep on coming. There's a story that Blue Owl might not be financing their data center build-out in Michigan, even though the company basically came out and said, hey, they're on track as far as fiscally goes. Blackstone might get into the mix here and partner with Oracle. But this is just one of the data centers that Oracle's building out. Now they're taking on debt. And remember, on earnings last week, free cash flow starting to fall a little bit, CapEx spend starting to rise. Those are things investors don't like to hear. That's why you've seen all the volatility in this, but that Q2 earnings event showed modest revenue and cloud growth shortfalls along with sharply higher capex and free cash flow burn. And this is creating those concerns for investors at this point. And that's why you're seeing it selling off again today. But did see some bearish activity in here also, but this was a longer dated as far as unusual option activity goes. This was on the March monthly cycle, so about 93 days to expiration. Traded about 4,000 of the March 160 strike puts. Paid a pretty hefty option premium for this, pretty hefty debit of about $9.90 on average for these puts. So that takes the break even for this trader. They start to profit all the way below, just above $150 per share over the next 3 months. That's about 16% below the current share price. So in essence, this trader, I don't think it's a hedge against a long stock position. They're paying too much option premium, and they went out in duration all the way into the March cycle. But they're outlaying a bunch of capital here with the expectation that, hey, maybe over the next 3 months we're going to see even more pain for Oracle, and that wouldn't be a good thing for investors at this point.
The whole cyclical thing with all these companies investing in one another and all tech, now there's just more concern about debt on the rise and credit risks and stuff that we hadn't talked about for a few years, and now it's really back. Thank you so much. Good to see you. Tom White every day here with Options Corner, where you find real trades and shares them with us. That it's good to look at each day. Coming up, leaders and workers handling the implementation of AI. Our next guest from the conference board has some very interesting data to share on that topic. We'll be right back right here on the watch list.
Well, it's your last minute play, I think.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks?
This is a spot.
Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the watch list. I'm Nicole Petalese. We're live on the floor of the New York Stock Exchange. We have a few movers for you right now. Check out shares of Airbnb moving higher this afternoon. RBC upgrading the stock to outperform and raising the price target to 170 from 145. The stock is up 15% in December. General Mills higher after beating earnings estimates on top and bottom lines. Packaged food giant reported lower second quarter profit and sales after implementing price cuts to attract inflation-fatigued consumers. Now, General Mills CEO said the company is continuing to see consumer weakness, particularly on the low end of the income spectrum. All right, we're looking at what's going on with AI. The AI trade has dominated the markets, of course, in 2025. But how do workers feel about the implementation of AI in the workplace? Matt Rosenbaum is with us, principal researcher in the Human Capital Center of the Conference Board, joining us to share some of the data from the Conference Board's new AI survey. And there's so much excitement about AI, also some hurdles. What are some of the takeaways from the survey?
So first and foremost, I would say there's more optimism than people might expect given the level of attention and concern about job displacement. What we found is that workers right now are saying AI is improving their productivity and their job satisfaction. But if you look ahead, over the next 2 years, 85% of workers told us they expect AI to improve their jobs for the better. What was also interesting is despite that, 42% of workers told us they expect AI to lead to a decrease in employment at their organization over that same time period. And so it was an interesting contrast of, yes, there is this expectation that maybe AI leads to fewer jobs at some of the organizations people are working at, but they still expect AI to improve their job. And I think it's just a level of nuance and optimism that maybe doesn't get captured in some of the discussions about fear about job loss or job displacement.
So 85% of the workers believe AI will improve their job. That seems pretty exciting, but as you noted, 42% are worried that it will decrease the employment numbers. Any gauge on whether or not that's true? Will AI cut employment?
So we'll see what happens. It's hard to forecast the future, obviously, but certainly there is anecdotal evidence indicating that is already starting to happen, at least on the edges of organizations that I've talked to. Leaders have told me they're often either backfilling in relation to the work that needs to be done, and certainly there's a level of attention, keen attention at the top of organizations into how can we potentially reduce headcount. 40% of leaders that we surveyed said they also expect AI to lead to a decrease in employment over the next 2 years. So certainly that is what a significant percentage of folks are saying and expecting, but who knows what's actually going to happen. We'll see.
So this sort of integration time, it seems that while AI is here and people think it improves their work or productivity, at the same time, 54% of the leaders say the company lacks sufficient link between AI redesign and the business strategy. So you have this sort of great tool, but the question is how do you use it efficiently, right?
100%. I think one of the main challenges organizations are facing is individuals reporting productivity gains. 87% of workers that we talked to said that it's improved their productivity, but you're not necessarily seeing that in organization level outcomes yet, and there's a lot of pressure to show ROI for the millions of dollars that organizations are spending on AI. And I think one of the main challenges there is the need to change organizations to get the most out of AI and to have that tie back into business strategy. I think a lot of organizations are taking an experimental approach, which is well and good, but it can sometimes lead to a let's throw everything at the AI wall and see what sticks, which leads to a lot of wasted effort, a lot of wasted resources. You really need that clear alignment between what are we doing as an organization, what's our business strategy, and then how are we using AI to accomplish our goals and serve our customers. Otherwise, it's difficult to prioritize, it's difficult to determine where value is being created.
Also, people wanted to work with the company to integrate the AI. I mean, the skills gap is there too. Some people just don't even know how to use that because that hasn't been part of their learning process. People want to be more involved. Can they even do that, or is that wishful thinking?
I think people definitely can be involved. They're a central player. The reality is AI talent is both scarce and extremely expensive. So organizations aren't necessarily going to be able to look externally to find the people that they need. They really need to commit to their current workforces. How can we develop those folks in order to bolster the skills that we need to get our organization to the place we need to go? But that is going to take time. That is going to take some effort. And I think one thing that's important to note is it's not just a one-time thing. You don't just slap together a few training program and have everyone watch it and then you're good to go. It really does take concerted effort over time to make sure that people are staying on top of all the developments that are happening in AI and how to integrate that into their work. And how do we organize as a team, departmental, organization-wide level to ensure that workflows are in sync, that organizational structures are helping people rather than hindering people. So there's a lot that goes into it, but the core is still going to be people and the skills that they have. And people need to look internally at their organizations to try to find those skills and develop those skills rather than hoping to find that outside of the market.
Yeah, understood. I mean, the job picture has been weakening, and that's been part of the story and one of the reasons why the Fed decided to cut rates recently. So there are some concerns about the job picture, but also organizations, what do they need to do to be more ready to implement AI?
I think one of the main things is making
can't
sure
trust
that
this
that
market.
clear AI strategy. What are we going to say yes to when it comes to AI? And crucially, what are we going to say no to? What are the things we're willing to say as an organization? We're not going to pursue this for X, Y, or Z reason. And just ensuring that you have that clarity and that focus, because it is very easy to spend a lot of time, a lot of resources chasing a bunch of different potential options and not really getting anywhere versus focusing on what you do best as an organization and how AI can help with that. I think another thing that stands out to us from our research, our conversation with executives, is the need for collaboration at the top of the organization. As one executive I talked to put it, AI is a great way to get budget. It's a great excuse to accrue budget and potentially be the one seen as leading the charge, but you really need a team effort at the top of the organization to say, how are we going to make sure that we're pursuing the right things, that we're making sure that the right people are maintaining the data that we need, for instance, things like that, really getting into the weeds of how do we as an organization approach using AI and ensure that we have everything in place to maximize our chances of success with these transformations.
And what AI companies or related programs or integration are you seeing? If you name some names, what's being used in offices and organizations when you say about the implementation of AI? What names, maybe even the publicly traded names, seem to be leaders in the AI race?
So a lot of organizations are working with your major consulting firms, whether that be an Accenture or a Deloitte or whoever. Everyone's trying to get their hands on some of this work that is being done because there is so much effort needed to change. But you're also seeing a lot of the smaller players, particularly in workflow adjustments.
6750s.
Relatively niche players are presenting products that are really compelling, but I think the big winners from AI continue to be the large tech companies and the cloud players, and that is, I think, going to continue to be the case, especially as you just saw with the release of Gemini 3, Google's moving ahead, making the big inroads, and Anthropic's leading the way in terms of just the capacity of Claude, particularly on the software engineering side of things. And then OpenAI has the consumer market, for better or for worse right now. We'll see if Google and other players can start to chip into that, but that's where they're leading the way right now.
Matt Rosenbaum, thank you. Principal Researcher at the Human Capital Center, the Conference Board. Thank you, Matt. Coming up, we're going to be joined by Robert Schein. He'll discuss some of the big risks facing investors heading into 2026. You'll want to take some notes. We'll be right back.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at _Vardas and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs.
Well.
And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Nicole Fedelides. So glad you're with us. Robert Schein is here, Chief Investment Officer at Blanky Schein Wealth Management. And we have a lot to discuss in the market and retail and how folks are feeling. Let's just start with some of the big picture here on the market. Your thoughts, because you have a price target that's higher than where we are now.
much higher than where we are right now. There's a lot that could play out for next year. We believe that we're looking at strong corporate earnings. That's going to be fueled next year by additional rate cuts, probably in the back end of the next year. Because let's be honest, the data that we're getting, even tomorrow's CPI, is still clouded, right? We're getting data, but we're not getting clarity. So, but with that being said, you've got one big beautiful bill, a lot of consumer relief, if you will, on the tax side. So there's a lot of incentives that are going to make the market, we believe, in profits.
What do you think are some of the catalysts to get us to the 7,000 mark, which you think we may even hit between now and the end of the year?
I think Santa Claus rally will continue. Will be intact. I know it's not this week, but we'll see that shift. There's a sea change underneath, rotational market changing out of the AI, if you will, boom, from the Mag 7s to the market broadening out, which is a great thing. And that's what we need to see for next year.
You talked about some of the corporate earnings. You thought they were pretty strong. The expectations for next year, are they too high? I mean, because, that's the whole thing. They lowered expectations and they beat them versus, they start raising them. They do have some raised expectations for next year.
Yeah, we're on the high side for expectations, and that's simply because the last 2 years, Wall Street has been underestimating what happened in terms of a resurgence in earnings. And earnings growth, not only from the Mag 7, if you will, Nicole, but it's broadening out. We're seeing other sectors like financials and healthcare catch a bit. The only one that hasn't is energy. So maybe even with the other 9 sectors, if you will, catching a bid in terms of earnings growth, that could be the catalyst.
So a name like NVIDIA, you've owned for a long time. What's the strategy on NVIDIA right now?
So, like I said before, with our clients, the conversation has been this. The last 5 years, we're up over 1,000%, if you will, right? 1,300%. We've been trimming basically every December. It's not the easiest conversation with a client, especially when you're booking cap gains, but it's the right strategy moving forward. Because can NVIDIA protect 60% profit margins moving forward? And what does the AI CapEx spend look like moving forward? The concern on Wall Street has to be, and we saw it play out with Oracle, is how are they going to, is it going to be financed? Right? The Mag 7s can play out and play this game because they have cash to buy the chips from NVIDIA. But if we start to see financing lining up to buy the chips from NVIDIA, that could be, and then there's all these other players that are going to come in to go after the 60% profit margins.
And we have the excitement of the H200 chips going to be allowed to go to China, to certain companies. I mean, that brought a little optimism, but, the numbers that NVIDIA has put out during earnings season are sort of ex-China. Maybe there could be a bright spot. Now, we also think about small caps. Is that an area that you like?
I think small caps, again, with the ease in the interest rate environment, that always plays well to small caps. That was Wall Street's biggest play this year, starting in 2025, and it never really played out. So we could see that the theme from last year playing out into 2026. Small caps could see the bid that's been long awaited.
And then what about a name like Raytheon? Why does this fit in? And when we think about aerospace and defense?
We're very thematic when we think about investing for our clients, specifically on the defense side. So if you look at what the Wall Street and Washington are doing, follow the money. So there's a National Defense Act that's going through Congress right now. It could be $900 billion. We'll see how it plays out. RTX is one of those that will play out in terms of gathering a lot of those contracts. So we want to follow the money, and that's one of the reasons why we like it.
Still on the AI revolution? Because I know you have Palo Alto in there, but where do we stand on the AI revolution? Are we still in the early part of it?
So yeah, we're in the early stages of AI play out. We like Palo Alto. Another theme that we like, Nicole, which is the cybersecurity theme. So as we go through the shift with the data center plays, the cloud computing plays, Palo Alto is a staple that every corporation needs, that protection in cybersecurity. So one of the reasons, and they just raised guidance 30% quarter over quarter, in terms of profit margins. They're here to stay moving forward. So that's one of the reasons why we like the cybersecurity theme, and Palo Alto is right there with it.
So if you think 7,000 by the end of the year, I mean, when does 7,500 come, or 8,000?
That's anyone's guess, Nicole. That's a good one.
Are you a believer that the rally continues in 2026?
Earlier, yes, the rally's going to continue in 2026, but there could be some fits and starts, right?
Where are we going to have the end of the day rally?
With the Federal Reserve, based upon who we get as the new chairman. But we believe it's going to be a dovish Fed moving forward. I think the data-dependent strategy
kind of looks like it
is
wants
really
to
going to rely on
where we see this market playing out and how quickly we can see 7,500.
67.50s.
Is there a theme to these picks here at all? You know, when you're trying to pick stocks versus the ones you might avoid?
Yeah, we love it. It's definitely
Spice it up.
And so we like the themes that we said. So we love cybersecurity. We love the aerospace and defense names, if you will. But we're not, leaving AI by the wayside. We just say that, listen, 40% of Mag 7 is the S&P 500. Let's look for the market to broaden out. We need the market to broaden out next year to see 7,500, even 8,000.
And there were so many fans of the money market, now not so much.
So the money market, with the 10-year treasury is at 4.15 today, so it's still stubbornly high based upon where we see the trajectory for next year. And watch the 10-year treasury, so that could give the new Fed a run for their money. So the Fed vigilantes, the bond vigilantes, always give a new Fed chair, if you will, historically speaking, Nicole, a challenge. So that could be a story that we see in 2026. But let's be honest, the 8 trillion, 7.5 trillion in money markets. As interest rates drop, you're going to have to find a better place for your money.
Robert Schein, thank you so much, Chief Investment Officer of Blanky Schein Wealth Management. Robert Schein, thank you. Great to see you. All right, folks, still ahead. We're going to talk more about the retail sales numbers. We're right in the thick of the holiday shopping season. What is the consumer doing or not doing? We'll be right back.
Minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, investors, you know the market moves. And Schwab is here to help you move with it.
Sure does.
Whether you're buying, selling, holding, or planning. Whether you're ETFing or 401k'ing, saving, spending, or even retiring. You can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome back to the Watch List. We're taking a look at retail and the consumer. Brian Gildenberg is with us, Managing Director, Retail Cities, and Brian Jacobson, Chief Economist, Annex Wealth Management. Thank you both for being with us. So, Brian Gildenberg, tell me a little bit about the current retail situation. What are you watching most closely right now?
Thanks, Nicole, for having us on this Life of Brian's episode. Yeah, I think we're looking right now at overall the retail sales numbers that came out were, they seem negative, but in the context of things were pretty good. When you look at year-over-year trends and things like that, obviously automotive sales were a drag on the overall number, but if you're looking at year-over-year retail sales for 25, they're about 3.9% ahead of where they were. So retail sales look good. Consumer confidence is not great, depending on how you measure it, but that consumer confidence has remained where it is with retail sales remaining relatively strong. So really what we look for is change, and we're just not seeing very much. So that our anticipation is that the consumer will continue to behave more or less the way that they've been behaving all year through the holiday season.
Brian Jacobson, do you think that people are shopping, or at least the higher end folks are shopping? Is that the disconnect?
I think in the case, and I agree with everything that the other Brian, better Brian, also said, where I believe it is that the trends that we've been seeing, this K-shaped economy idea about how higher income individuals are really driving the spending, lower income individuals not so much. I do have to point out that the lower income individuals still are spending. You do still see that growth. There still are the wage gains there. It's just they're not as rapid or as strong as for the higher income individuals. You know, when we look at the American Express credit card data, that showed for Black Friday, I think it was 9% year-over-year increase in sales, whereas for MasterCard, it was 4%. And there's, I think, reflecting that difference in clientele between those who have the American Express card versus those who use the MasterCard. Nothing against the MasterCard. But I do think that what we need to see where that trend can change is that re-acceleration of growth, perhaps, as we go into 2026. We are likely going to be getting tax refund season, and I think that could really bolster the bottom end of the consumer spectrum much more than the top end of the consumer spectrum.
Yeah. Brian Gildenberg, you mentioned some names like Amazon, Walmart, Costco. Tell me about the names that you think are best positioned and why.
It's just sort of round up the usual suspects, Casablanca moment here. So the retailers that have been winning for most of the last couple of years seem to be well positioned to disproportionately win. If you look at some of Placer AI's store data traffic in terms of who's been winning at least the physical store game, a lot of it is the retailers that have that really strong value centricity. So yes, it's the upper income shopper that might be spending more, and that lower income shopper is increasingly looking to value-centric formats like the TJ Maxx's and the Home Goods of the world in order to continue to stretch their dollar as effectively as possible. And then mid and high income shoppers continue to use those formats, as well as formats like Walmart, that continue to meet their needs. So I would say that across the board, and again, my focus group of one research was my kids and I hitting the malls on Black Friday. And it did seem as though the other trend I thought was interesting was that a lot of the teen shops did a tremendous job of generating inbound store traffic through TikTok. And I think that's one of the areas that'll be worth watching, are the retailers that are connecting with their shoppers most effectively on social media, that are using great discounts and great content to bring shoppers in. Some of these stores like Hollister and Garage and Victoria's Secret were just overwhelmed with teenagers on Black Friday. So I thought that was an interesting observation as well.
It's interesting how something like Airbnb talked about people spending more on experiences and things like that. At the same time, Brian Jacobson, you noted how with food services and drinking establishments, there was some concern and maybe even people eating back at home once again.
And that's shown up in the October numbers for retail sales with that slight decline in the number for food services and drinking establishments. So basically, eating out at restaurants and bars. Slight decline in October. Maybe part of that was due to, like in Washington, D.C., with the government shutdown, people not eating out quite as much. But what we have been hearing from businesses, like Campbell's Soup, I think, is a really good example of this, where they were talking about how they believe they can benefit from the trend towards more eating at home as opposed to eating out. So perhaps you can turn that eating at home into an experience as well. It doesn't have to necessarily be driving, going someplace and eating out. You can have friends over. And I do think that is one of the trends.
Got the 67 50s.
Something that we saw during COVID. People learning the joy of cooking and eating at home. Inviting people over, maybe not during COVID, but maybe now.
Starting to get a little bit of movement on that candle.
That from an investing perspective, we're really keen on with some of our holdings as well, is who can maybe benefit.
These are my moving averages to get out of.
Engaging with the idea of not only value for price, but then
The
also
200s.
kind of the do-it-yourself when it comes to eating out.
While I'm seeing a mix of sells, equal weights, neutral ratings, I got to talk about Macy's, which has had this incredible, it's up almost 110% in 6 months. And Brian Gildenberg, you noted some of the details on department stores. I mean, this stock undeniably has been fantastic for shareholders. But now what? What's the important point pertaining to department stores?
I think there's a couple. One, I think there are a couple. Dillard's is the other one. Dillard's has done, I think, a more,
Make a business
to be honest, a more
decision.
consistent job of improving its execution across the board than Macy's has over the last 12 to 18 months. So if if Dillard's stock isn't up by the same amount, it's probably been performing better. I think Macy's does a marvelous job of managing narrative, and I think that their management team has done a really good job of focusing on their core 50 and really trying to think through that. I was in one of those core 50s on Black Friday. The store looked great. Relative
Three
to
white soldiers.
If you look across the chain still, 110%. I'm not, I don't trade equities for a living, but I don't know that the business is 110% better than it was. So, and I do think that post-holiday, that would be a valuation. I think it'll be interesting to see how they sustain that in 26. I don't know that the consumer tailwinds are there for that. So.
The final takeaway here is that there is anticipation we're going to have better year-over-year spending. It's between, let's say, 2 and 5% expectations. Brian Jacobson, do you think we'll have a better year than last year quickly?
I think that we will. When all is said and done, I think that we are going to see not just nominal increases in sales, but most importantly, the volume as well. So it's not just about the price with inflation, but it's also about real economic activity. I think that we'll see some improvement there.
Brian, do you think we'll see improvement year over year for this holiday shopping season?
I think you might see some portfolio rotation. To the other Brian's point, low-income shoppers might have a slightly better year. I think middle-income shoppers, particularly traditionally shoppers in what we might call white-collar jobs, are going to increasingly find the employment and labor market a little bit challenging, and obviously some of this depends on a lot
260
of Federal Reserve stuff that I don't think anyone can really see the future on. But in general, I do think that companies are going to be pressured to show that the investments they're making in AI are deriving savings. A lot of that's going to come through managing costs. A lot of those costs are going to be people that are in the middle of the income curve. So I think you might see the lower end of the population do better. I think the middle end might struggle a little bit. And I think high-end shoppers will probably be fine. So
we're seeing some of the retailers higher today: Costco and Walmart, Home Depot, Lowe's. I mean, we're seeing some up arrows on a day that's mostly down. So you are seeing a little strength in this group overall. It's great to see you both, Brian Gildenberg and Brian Jacobson. Thank you so much for being with us, and thank you, friends, for being with me every single day. I'm Nicole Pedalides, right here on Schwab Network, 9 a.m. and 2 p.m. Thanks for being with me. I'll see you tomorrow. Keep it right here. Market on Close is next.
There you go, right there.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world, I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Good afternoon. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our Chicago headquarters.
And I'm Sam Vardas, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. We'll be joined by the team from the NASDAQ to discuss a record year for ETF inflows and listings, plus what we should be on the lookout for in 2026. Later, we'll dive into the world of quantum computing and why the race is so important, plus why blockchains are vulnerable to quantum. And be sure to stick around after the bell today, as we'll get live earnings from Micron. As soon as they come out, we'll give you the reaction. But for now, Marley, take us through what you're watching today.
Well, Sam, the Hollywood saga that is the Warner Brothers Discovery sale continued today, this time with the company's board unanimously recommending that shareholders reject the hostile takeover offer from Paramount Skydance. The media giant says that Netflix's prior offer provides better value, adding that the Ellison family, quote, consistently misled shareholders about their bid's financing. We'll dive into the specifics on that shortly. Also, Oracle shares continued sliding today, this time on a report that Blue Owl will not be backing its $10 billion data center build-out for OpenAI. Blue Owl had been in talks about funding a 1 gigawatt facility in Michigan, but the Financial Times says that those plans fell through due to concerns about
I need a boogie woogie
and hefty AI spending commitments. Oracle has since confirmed that Blue Owl will not be a part of this particular OpenAI data center build-out.
It's now
And Lennar
1 minute
big
post
hit
power
after its
hour.
earnings report this morning when the company said that the housing market remains challenged during the quarter and posted a significant drop in earnings from the year-ago period. The homebuilder also guided for sales in the current quarter below the street's forecast and a decrease in the average home price as it continues to use incentives like mortgage buybacks to maintain sales momentum. Before we get to those top stories and more, let's take a look at where the markets stand as we head into the end of the trading day here. We are still in the red across the board here. The S&P down almost 1%, 0.9% at 6738.69. On the NASDAQ, we're trading more than 1.5% lower, 24,737. On the Dow, we've given up 145 points. We're down 0.3% at 47,968. And the Russell 2000 is trading more than 0.8 lower right now at 2498.12. The dollar mostly unchanged, slightly positive on the day, up to 98. Gold, though, is 0.8 higher at 4367.50. Crude oil trading 1.5% higher at $55.99 a barrel, and Bitcoin continuing to fall, still well below that psychologically important 90,000 level, down 1.8% at 86,170. I do want to check in with Sam, though, in New York and see what stories or themes caught her eye today. Sam?
Well, we are watching memory names ahead of Micron's earnings later today. A number of stocks have started the day higher, but then it took a turn when the broader tech sector sold off, and that resumed. We've seen SanDisk managing to tread water. In fact, I've just seen it's also below the line now, underwater today as well. It's all in the red across what we're seeing in the memory space, but analysts have been turning increasingly bullish on some of these names on tighter supplies and higher prices. Morgan Stanley out with a note this morning, raising the price target on Seagate to $337 from $270 and keeping an overweight rating on the shares there, while suggesting being underweight stocks with elevated memory exposure like Dell and HP as they turn increasingly more cautious. Memory stocks have skyrocketed this year. Shares in Micron are up more than 175% so far in 2025. Now, in the commodities patch, oil prices rebounding today after trading near 5-year lows yesterday, and that coming after President Donald Trump ordered a blockade of all sanctioned oil tankers leaving Venezuela in a bid to keep the pressure on the government by going after a major revenue source there. And lithium stocks have also been a little bright spot today after China revoked some mining permits. Albemarle, one of the leaders on the session on the S&P 500, as prices surge overseas on some of those supply concerns. So watching tech, watching commodities, but for now I'll send things back over to Marley, who's with Jenny Horn in Chicago with some of today's top movers.
Thanks so much, Sam. Yes, like you said, Jenny Horn joining us here in Chicago, co-host of Next Gen Investing, to take a look at some of the top movers today. Now, this Built for Hollywood saga surrounding Warner Brothers Discovery continued today. Netflix, the only name that's in positive territory this day of all the names involved in this story. You know, break down the latest on this.
I love that we were calling this a saga because that's truly what it feels like it has become. And we joked that this was not, I mean, like a week ago, this was not the last week we would discuss it. And frankly, it has not been. And so I think some of the language is frankly just entertaining. But as far as the developments with the conglomerates now are concerned, Warner Brothers board did announce earlier today it had unanimously recommended that shareholders reject that takeover offer from Paramount Skydance and stick with what they called a superior proposal from Netflix. So last week, we know, of course, Paramount did launch a hostile bid for Warner Brothers Discovery, taking a $30 per share all-cash offer directly to shareholders. Now, CEO David Ellison of Paramount Skydance has argued that the deal, which does have an enterprise value of just north of $108 billion, is better than Netflix's and, of course, stands a better chance of winning regulatory approval. But then Warner Brothers has countered, saying following a careful evaluation of Paramount's recently launched tender offer, the board concluded that the offer's value is inadequate, with significant risks and costs imposed to their shareholders. They went on to say they are confident with their merger with Netflix that it represents superiority, far more certain value for their shareholders, and they look forward to delivering on the compelling benefits of the combination of both. The formal rejection, though, which was fairly expected, did set the stage for a new higher bid, though, for Paramount now, which is the leg of the latest saga that I think we'll be waiting for. Ellison did say he had already been informed of the CEOs that basically the $30 per share bid was the best and final offer, but they can announce still a new offer aimed directly at shareholders at any time. So it is interesting the way that they have gone about, you know, somewhat trying to pursue shareholders instead of pursue, obviously, the board, because they're clearly not making grounds there. I just thought some of the commentary was so interesting because they were basically saying, for the 6th time now, we reject this bid. I mean, pretty harsh, but, you know, in the terms of business, I wouldn't necessarily be thrilled if I were Warner Brothers Discovery's board either, where you have Paramount making pretty negative commentary about the regulatory approval process with now Netflix.
Yeah, and it has been interesting to watch the price action in this story too as it unfolds. We are seeing Warner Brothers Discovery under some pressure today, down about 2%. Paramount Skydance was up about 8% this morning when I was talking to Alex Coffey about the latest on this. Now they're down about 4.5%. Netflix are only winner today. They're only up marginally about 0.5%. But it is interesting how some of that's changing as the narrative's changing, and as you're pointing out, it's repeated no's at this point. So, you know, we have gotten a lot of commentary from the analyst community about this, how this will be ongoing. 12 to 18 months potentially before we have any sort of resolution. And Alex Coffey even throwing out that he had spoken to someone who suggested there could be an auction process even for Warner Brothers Discovery. So
even more of the saga continues.
The saga shall continue, but we shall digress. We shall move on to another company trading lower today. It's Oracle, continuing its slide. You just negative headline, earnings dropping. Now we're hearing Blue Owl they've confirmed, at least backed out of one OpenAI data center project build out.
Yes, this is an interesting story, and I think that this news today definitely not helping build back any of that momentum. We pulled back 48% since its previous earnings report, when we saw shares jump 36% in one single session, which who could ever forget that day? But since, it's been a really different tone, really, since that we saw highs in Oracle shares. So we did see these various rumors of stalled data center funding, which initially sent shares lower, but some have argued the narrative has gotten perhaps a bit too harsh on Oracle, but Oracle shares did fall as reports Blue Owl will no longer be providing the funding for their Michigan data center. And fresh concerns about data center funding have really been weighing on shares. But according to some, again, Oracle did call the initial report from Financial Times actually incorrect. said the company is working with the development partner related Digital, and that final negotiations for their equity deal are moving forward on schedule and according to plan. But again, it's not necessarily all doom and gloom. Evercore ISI did believe the fixation on their data center timing is now, to quote them, almost irrelevant to the company's valuation. They did say the stock has already collapsed to a level reflecting a worst case scenario. And the stock has given back, of course, all those gains it once racked up after it announced that $300 billion acquisition or a new business with OpenAI, not acquisition, that would be really interesting. But they said it doesn't make sense for investors to continue to fixate on the timing of that ramp. But frankly, timing is what the market focuses on. I mean, it's all about being able to deliver on schedule, consistency, reliability, and also debt load remaining also on schedule. So I understand the conviction of perhaps we've gotten a bit overdone with some of the pressure here, but timing is everything in these markets.
It certainly is, and we've discussed a lot about how we've entered this sort of point where people want to see, investors want to see execution or reality even of something coming to fruition here, and we're starting to see some changes, delays in some of the build-outs, but people backing out of some of these build-outs, and now we're down 6% for Oracle. We are higher, though, on our next company here. We're talking about General Mills. They had their earnings report, flagged some things I think we were already aware of, but some interesting perspective about them putting some of their products on sale.
Yes, which I love to discuss price cuts for
a lot of these staples because this is now a trend we're starting to see a bit more emerge. Thank goodness, nothing but the inverse for the last several years. But net sales did contract 7%. We did see most of this decline, though, as a result of divestitures and acquisitions, while organic sales specifically were down just 1% from last year. They invested their U.S. yogurt business, though, in the first quarter of their fiscal 2026 year, selling its Canadian yogurt business and acquiring Whitebridge pet brands in the third quarter of fiscal 2025. So they've been struggling, of course, with high costs, in part because of tariffs, but shoppers have increasingly shifted to more private labels and are seeking products with shorter ingredient lists. So in the latest quarter, what was hugely positive was international organic sales actually increased 4% from a year ago. North American market did still remain weak, but we know the food service segment was flat. The pet food business posted 1% growth, and they have stepped up recent product launches as well as revamped their packaging, and say they had stronger in-store events as well as right now trying to reduce costs to be more affordable. So they did say that while some products like Pillsbury dough and Cheerios protein had seen strong sales trends, they've also seen, again, some breakup from those major divestitures and just a rethinking, I think, now of their pricing strategy going into the next year. I will say that their guidance was not exactly hugely optimistic, but they did say they're confident in their plans. They reaffirmed the forecast that they had given of basically flat organic net sales at the midpoint and about a 10 to 15% drop on an adjusted profit basis, which is why I say that they weren't exactly enthusiastic, but at least not getting worse from here.
It was interesting to see a company that said that they had lowered, roughly 2/3 of its prices in its North American business, and that they saw increased volume in nearly every category where they did that. So, just signaling Americans like things on sale, right? I think that's what we've learned today.
It doesn't feel like the cereals are on sale because I keep saying $7 to buy a box of cereal in the city of Chicago. So I haven't noticed that yet, but I'll be keeping my eye out.
Cereal that wasn't high protein did not perform well. That was another thing that they said too. All right, let's talk about our last company here, Airbnb. They got an upgrade, and interestingly, I learned something when I was reading this note today that they are entering the hotel business.
Yes, and I think that this is so interesting as well because, frankly, they've never really been a formidable threat to the traditional hotel business. And it's just, in fact, you haven't seen any degree of market share loss, any contraction of growth.
That's what I figured they would get into.
Hotel chains, RevPAR, everything remains still.
When they first came out, I was imagining hotel business.
What that means for hotels, but they typically
So this is good news, I think.
They can
both be mutually successful. But RBC, with this upgrade today to outperform from sector perform, raising its price target to $170 from $145, seeing an increasingly attractive brand monetization story, saying that first-party data is likely worth a premium in the evolving consumer AI landscape. They're bullish, though, on, again, as you mentioned, that specific entry into hotels as incremental room nights are a potential driver. And they see this now as a possible entry point for outsized profit from the promoted listings. And so upgrade momentum has been pretty strong. We have seen several analysts update their price target, and obviously 170 would imply about 17% upside from yesterday's close, but based on roughly 34 analysts US, the average price target right now is around 141 a share. So more modest upside, but there is still an overarching now recommendation of hold. So some cautious optimism here.
Cautious optimism. I did see in several of the notes with the price target upgrades in any point recently, citing potential headwind. Tailwinds from the World Cup and also the Winter Olympics. So a potential boon there for Airbnb. But Jenny, thanks for breaking down those stories for us. Airbnb about 2% higher on that upgrade from RBC Capital. I do want to check back in with Sam, though, for a look at what we have coming up in the rest of the show.
Well, Molly will be joined by the team from the NASDAQ to discuss the year that was for ETFs that included record inflows and a record amount of listings as well. We'll dive into that coming up next on Market on Close.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
Yep.
I'm Nicole Federlides live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Market on Close. I'm Sam Barnes on the floor of the New York Stock Exchange, alongside Molly Caden in our Chicago headquarters. Let's check in with these markets because we have seen a down day. We've got risk off across the major indices. We did look like we were going to start the day higher, but then things took a bit of a turn sort of mid-morning, and we did, of course, see the S&P 500 taking a leg lower. We are down nearly 1% right now for benchmark index, and of course, we did see NASDAQ also retreating quite significantly, as we did see that sell-off in technology resuming today off the back of a little brief recovery yesterday late in the session. So we're down around 1.6% for that index right now. If you take a look at names like Nvidia, Oracle, Broadcom, all of those which we have just already mentioned at the top of the show, they are seeing some heavy losses today. So that is really the drag, and that is what is really bogging down most of the markets today. So we've got the Dow Jones has also been pulled down with it, along with the Russell 2000 down around 0.8% or so. It had looked like we were seeing some degree of rotation beneath the surface earlier on. We are seeing more sectors in the red, though there are still some bright spots. But take a look at futures products. We've got the US dollar that just ticked up higher at 98 on the DXY right now. Crude oil, of course, has been a big story for us, as we mentioned. We are looking at $56 a barrel. We are tracking all the geopolitical risk premiums that's been priced in now. Bitcoin is still stuck here below the 90,000 levels. We're at 86,000 and change. We're down almost 2% on the session, and the 10-year yield is still elevated at 4.16. Of course, this is all coming as we are sandwiched between two big data prints this week. Everyone's been looking at the jobs data. We're going to be looking at the inflation out to tomorrow as well. Will that move the needle as far as what it tells us about price pressures, particularly with respect to tariff pass-through, whether this is being seen very much in what we're seeing as far as CPI?
Here we are. Technology is down almost 2%. So as I said, this really is where the drag is coming from, along with discretionary 0.7% lower and the services sector as well. Communication services, I should say, 0.5% lower. But staples holding up, which typically does in a sort of more risk-off environment. Energy is our outperformer on the day, and of course that's coming off the back of these crude prices picking up. It's also, as I mentioned at the top of the show, a pretty good day for some of these producers in the business of lithium, off the back of some of the China headlines. We've got real estate high, materials higher as well, but utilities are feeling it, and so are industrials today. I mean, these are sectors which have been very much captured bid recently as we've seen that rotation into sort of more value parts of the market out of technology, but we do have a mixed picture playing out in these markets today. But I'll send things back over to Marley in Chicago for now.
Thanks so much, Sam. Joining us now here in our Chicago studio is Jillian Delsignor, the head of retail and wealth strategy at NASDAQ Indexes. We're here to do a 2025 ETF recap with Jillian. She always comes with the trends and things for us to talk about. So, Jillian, it was a record-breaking year for ETF flows. We know that. We've talked about all of the updates every time you've come. What do you think in this year alone fundamentally changed investor behavior to drive the surge that we saw?
So I think there was a couple things at play. One, I think we saw retail show up this year in a really big way. I think, from my seat at NASDAQ, my job and my team's job is to help ETF issuers reach their clients, right, with our products in common. And retail came up in every conversation. How do we reach retail? How do we reach retail? And the good news is there's a lot of platforms now and ways to do that. And so retail, if you look at the numbers, about $500 billion came from retail investors this year, which is not insignificant when you think about $1.3 trillion in total. And so they were showing up in ways I don't think historically expected, right? You traditionally think low-cost beta, but we were seeing them show up in active ETFs. We were seeing them show up in options-based and crypto. So there were a lot of things where we were seeing retail show up in a very different way. And they were also in a bit more sophisticated way, right? I think everybody thinks retail means stocks 5 years ago, COVID. But they were really showing up in a more sophisticated way, buying dips, looking for portfolio tools, looking at active. So it really was, I think, a big shift in 2025 for us. Active, right? I know we've talked about it every time we've been here, but it really is one of the biggest stories of the year was active ETFs. We've seen their flows, they took in 35% of the flows, which is extraordinary considering their overall AUM relative to the overall AUM we have in ETFs in general. So that's really been a huge driver. You're seeing things like the options-based ETFs, the buffered, the crypto, they all fall in that category. Those are two huge trends that we saw in 2025 that really drove a lot of growth.
And we're now seeing these active ETFs even outnumber the passive ones. They surpass them. Why is the ETF wrapper so attractive now for active managers?
Yeah, it's so interesting because I think in my early days in ETFs and in my previous roles when I worked as an active manager, nobody wanted to know ETFs. They were selling against ETFs, right, for their entire career, whether you were a PM or a salesperson. The wrapper really lends itself to a new audience. Right? If you think about it, if you were running an active strategy, you may have been able to reach one particular audience with your product, but maybe not retail, or maybe not a particular type of advisor, or institutional for that matter. And so I think that the ETF opens up a whole new world of investors, and frankly, from a, not to get into the weeds, but from a portfolio implementation standpoint, it can be quite simple for a portfolio manager. You can potentially have lower fees because of the infrastructure, more tax efficiency. I really do think it all roads lead to distribution. In commercialization, I do think the ability to reach different audiences plays a huge role.
And I want to talk about that $1.3 trillion number that you mentioned before we get into some of the nitty-gritty and specifics here. U.S. listed ETFs took in $1.3 trillion this year. Is that sustainable, or do you view 2025 as an outlier?
I think it's sustainable. We've seen it always go up and to the right. Right, and so I do think, given the ongoing evolution and innovation that we're seeing within the ETF wrapper, I do think you're going to continue to see that go up. You're continuing to see outflows from mutual funds. The 401k market tends to still keep that alive, but you are seeing significant innovation happen within the ETF wrapper. You're looking at, obviously, we've talked about crypto, but private markets you're starting to see come into the wrapper. The wrapper's not perfect for everything, right? Let's be clear. But you've seen incredible innovation into markets that you never would have thought seen in an ETF. So this ongoing democratization of institutional strategies, whether it be derivatives, crypto, private markets, that's going to continue to drive. And then again, you keep talking about retail, but all these new types of investors, whether it's retail or institutional on the other side of the barbell, you're seeing a lot more investors come in and see the value of the wrapper and start to invest in it. So I do think that direction is going to continue to head up.
And there are now more ETFs than there are listed companies, which is an absolutely staggering thing to say out loud. Do you think that that's innovation, Jillian? And we haven't talked about this, but do you think that this risks overwhelming investors? And I guess I have a follow-up to that as well. Do you anticipate most of these companies, most of these ETFs to survive through next year?
Yeah, so I do think there is a healthy cycle, right? There is a healthy cycle where every year, I don't have the stat, I'll bring it to you when I see you in January. We'll look at the open-close ratio. I do think there's a healthy stat where you do see, for a host of reasons, right? One, maybe it was a theme that people thought would take off and it didn't. Two, there wasn't proper distribution. But there's a whole host of factors that lead to an ETF ultimately closing down. The size of the firm, right? A very, very large multi-billion-dollar firm can keep a small ETF open for a lot longer than a smaller firm can. Then there's a lot of reasons why things don't survive. I think the number is a little bit bloated, and I'll tell you why. I think so. We've seen a significant growth in buffered ETFs and single stock ETFs. So I do think that those two particular types of products elevate that number a little bit. Not to say that it's not still enormous, and I do think that there still is room to grow, but I do believe you will see some slowing down. But because they're having products launched literally every month on these buffers, it does bloat that number quite a bit. And then the single stocks, I mean, who knows where that's going to ultimately go. So I do think the number can continue to rise, but we have to unpack it quite a bit to really understand the volume of actual strategies that exist in the market.
All right, so let's talk thematic ETFs. We saw them pull in more than $40 billion in 2025. We've talked about some of the trends that we're seeing in the themes. But of the themes, which do you think are becoming core allocations rather than tactical trades?
Yeah, it's funny, we talk about this a lot. Our content team, as part of my team at NASDAQ, we've been spending a lot of time about this because we have such a great thematic business within NASDAQ, and we've been seeing them really become core of portfolios. Model portfolios are really incorporating things like cyber and AI, these long-term thematic themes, right? Like thematic themes, a thematic trend. I hate to use the word trend because it's not a trend, right? These are really what we consider digital utilities. If you can't start a business these days without a cyber plan, an AI plan. So we're seeing cyber, I mean, if you look at hack and cyber, SIBR and hack, we're at over $2 billion this year. So they're making their way into cores of portfolios. AI and AI tangential themes, so AI, cyber, critical materials. You're starting to see anything related to AI is really becoming far more core, and much less. There are certainly still tactical themes that you're seeing play a role, but things like cyber and AI are really becoming a lot more core to portfolios. Even crypto, I wouldn't say it's core to a portfolio, but it's certainly more mainstream than we've ever seen it.
Yeah, we're certainly talking about it. Yeah, absolutely. Well, Jillian, thank you for being with us. When we talk in January, we'll talk about that open ratio and also perhaps some of the ETF innovations investors should be looking for in 2026. But thank you for being with us. That's Jillian Delsignor from NASDAQ Indexes. And I want to send it back to Sam in New York.
Thanks, Molly.
She's a smart cookie.
On the world of quantum computing and how it can make blockchains vulnerable. I'll go and close and be right back.
Well, what a week. What a week. Yes, it was one hell of a week. Backlash, double bottoms, triple tops. Let's see. Go back down again.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab.
I'm Diane King Hall, on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes, you could have done better.
You could have done better.
Same goes for
burnt my pizza.
Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Marley Keaton alongside Sam Vadas in New York. Let's turn our attention to the world of quantum computing and welcome in our next guest. Joining us now in our Chicago headquarters is Yoon, the CEO of Boltz Technology. Yoon, thank you so much for being with us today, taking the time to join us here in studio. Now, you warn that quantum risk is coming. For investors and viewers who don't live in cryptography, what does that actually mean?
So quantum computing is a new way of computing, and it's hardware-based, and it breaks down as a completely different way of computing versus semiconductors. And semiconductors, you're very familiar with the three companies that basically take over that whole world, which is Intel, ASML, and TSMC. The world sees quantum computing as an undeniable advantage if you could get there first, and if you can do it efficiently. And the main problem for things like crypto is that quantum computing can break cryptography. The most popular cryptography algorithms that we use to protect our digital assets, like on blockchains, can be broken, and that is the main threat, the main risk. So the idea is that if you know there's a risk and you can quantify it, and you know that there's progress being made because there's actual nation states putting a lot of money towards quantum computing research, you have to do something because it's a really bad time to build a boat when the floodwaters are rising. So you need to do something, take care of it, especially when you have the solutions today. And so that's a big thing.
Yeah, you raise such an interesting point because, I mean, we're talking about the risks and potentially what we can do to address that before we've even really got to the stages where quantum computing is part of our lives. So I suppose that's good that regulation and policy can grow with it. But, here we talk about stocks all the time that are really catching a bid lately, huge amount of capital that's being poured into some of these names. I can rattle off a few like IonQ, D-Wave, we talk about these names all the time that have really shot up over the last course of the year on this thinking that this is going to be sort of revolutionary technology that's going to change our lives. It was interesting that, Jensen Huang sort of seemingly pulled the rug from underneath all that excitement earlier this year, saying, hey, hold on a second, you're ahead of your time. But now we're seeing a lot more traction that's been gaining in this market. So how should investors be thinking about this?
So I think what we found from that incident with Jensen Huang is that you got to be careful what you say. And it's very interesting that in a major conference like a month or two later, he did a complete 180, and then NVIDIA started investing in some of these quantum research companies. So I think being informed is very, very important, and also. It doesn't matter. I think there's a lot of questions going around, like when is it going to be? When are we going to have this powerful enough quantum computer that could break the cryptography on blockchains? It's becoming less and less important because Congress put into place the Quantum Preparedness Act back in 2022. And because last year, our National Standards Agency, called the NIST, approved 3 cryptographic standards that are quantum resilient. And they call that post-quantum cryptography. And so now we have the tools to replace our current cryptography with quantum-resistant cryptography, and that can serve the purpose of defending your assets on blockchains for good. Now, but there's other complications. The other complications is that there's a fundamental truth in cryptography that there's only ever been one provable cipher. It's called a one-time pad. It's impractical to use on the networks, so we don't really use it much on digital commerce. That means the implication is that everything else that we've been using and is being proposed for quantum resilience is at risk. Anytime these can be vulnerable, and overnight they could say, hey, we're going to deprecate that, we're not going to use that anymore. And that has already happened in this long 9-year process to select these post-quantum cryptography algorithms. Two of the leading runners failed overnight. So this is a real risk, and so if you take a look at the standards that are coming out, there's a lot of varieties. So we have already like 26 in the pipeline in terms of variants, and how do you choose? So the best idea is to really be flexible, be able to be what's called crypto agility. So it's a new way of doing things where you could change cryptography on your digital asset at the owner's speed, which is a very, very different concept because currently the way blockchain is set up, everybody uses the same blocks. It's like having the same locks on every house door. But now you're going to have a choice, and you get to make the choices when you want to, whenever you deem the risk is high.
So you bring up this concept of crypto agility, and I have I guess a two-part question here. The first part is, which blockchains are already taking this threat seriously and are taking what you would call a crypto agile approach here? And also, at what point does quantum preparedness and being crypto agile become a differentiator in how investors value blockchains and tokens?
So you have a very good question, is that there's probably at least a dozen or more efforts on every different type of blockchain that's out there, both private and public. So public meaning Ethereum, Bitcoin. Private, there's a lot of private blockchains that you've never heard of. Canton being one of them, DTCC, the Depository Trust Clearing Corp, has another one. And they're all concerned. But they're coming late into the game, and they're looking at which one do we pick out of this, first 18 and then the 26. There's going to be more because we've enjoyed this sort of, authority on cryptography for decades through the U.S.'s NIST Institute, but no longer. When it comes to post-quantum cryptography, you're going to have standards coming out of South Korea, standards coming out of China, Europe. Some countries in Europe are looking at setting up their own standards organizations. So you're going to have cross-jurisdictional cryptographic requirements. So everybody has to be crypto-agile. They have to think that way. Choosing one is not the answer because it costs a lot of time and money to transition from one cryptography to another if you fix it, if you make it static. The trick is how do you make it very, very dynamic and flexible so that you could change on a dime, right? And what we want to do is propose the idea that you do this and give the control to the asset owner, which is the right thing to do. It's your digital asset, you should protect it the way you want to. And we think that is the best idea. It future-proofs all blockchains. And we think that for blockchains, there's a lot of attention to it because it's the first time in mass finance, in modern finance, where the cryptography algorithm actually protects a asset value, right? So we've never had that. We've always had gates and we've had, moats and, castles. No longer. This is your asset. You should protect it the way you want to because that is the only barrier between you and somebody else who can take it.
I want to pick up on one of those thoughts, actually. I mean, you started your career here on Wall Street, and you were sort of building trading systems. You've held several roles at Goldman and Credit Suisse, and now you've obviously founded Nuts and Bolts, which I really like. But you're just one guy. You're obviously trying to do it to address the risks that you see. But you raise a really interesting point around what's happening internationally. No doubt there's this sort of growing paranoia in different countries. They're at sort of different stages as to when they believe this is really going to become a risk for them. What are you seeing as far as what governments are doing with regards to regulation and policy here?
So I think you mentioned earlier that there's a lot of craziness kind of going into the markets where publicly traded quantum companies have shot through the roof sometimes. They're very volatile stocks. And you see how much money is going into those companies, but that's mostly private money. You got some state government monies coming into certain companies, but you're not counting all the government money that's going directly to companies that you've never heard of. And if you look at how much China is spending on quantum research, it dwarfs anything else that we could even imagine, right? They have programs that are out in space already. So So this is not just a technological who's got the next best
Knife on PLTR
This
today.
is for information supremacy on a national level. So this will affect national security concerns all over the globe, and we have to do something about it, and everybody is doing that. And that's why the regulations and the time constraints, we don't see them going out any further. They're actually contracting. Everybody is trying to be prepared even faster than ever before. And so you can see that. Can you say that everybody is wrong? I don't think so. I think at this point you have so many eyes and so much validation that this stuff is real, the risk is real. But the best part is that we actually have recognized, validated solutions that we're looking at, and now the method is, how do you do this quickly and as flexibly as possible, knowing the risks of cryptography to begin with?
Well, we appreciate you taking the time to come speak with us in studio today about this very important topic. And one, too, that many guests that we've spoken to as we head into 2026 say quantum will be a theme that will be tip of the tongue for everyone next year. So we appreciate you highlighting this as we close out 2025 here. That's Yoon Ah, the CEO of Boltz Technology. And coming up, we have Options Corner. Rick Ducat will join us here in our Chicago studio to take a look at Micron ahead of its earnings after the close. That's next. Stay with us.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Close. All eyes will be on Micron after the bell as the company will report its latest quarterly earnings. Expectations are for adjusted EPS of $3.91 on revenue of $12.72 billion, which would be a record high for the company. Shares have rallied more than 175% on the year, and analysts at Rosenblatt said that record revenue expectation is coming by disciplined supply growth in recent years, along with strong demand, and sees the financial performance as supporting that growth. But we will soon know when we get their earnings after the close. But before that, we're going to talk about that today for Options Corner. It's time joining us now, Rick Ducat, our lead market technician here on Schwab Network, to take a closer look at Micron in advance of their report card after the close. So as we take a look at Micron, I did just highlight some of their substantial move to the upside, and you can clearly see it indicated here in the chart.
108% during the past year versus what was already quite a strong sector, the SMH semiconductor ETF, which is up a little under 36%. So this is kind of the strongest of the strong for this market here. But really, if you think about these different chip makers, they're not really all created equal in this regard here. The strongest are Micron and Seagate, which are the ones that focus on memory and storage here. Meanwhile, our more previously high-flying CPU and GPU chip makers, NVIDIA, Intel, Broadcom, Qualcomm, etc. Those have fared far worse during this decline here. So Micron is more DRAM, dynamic random access memory, which is faster but needs constant power, like what you'd find in your desktop computer. Meanwhile, they also do flash memory, which is slower but it holds the data without electricity. So that's kind of what they do instead of making these main computer chips that you might use in your PC or whatever.
So as we look at just Micron's chart standing on its own, as far as the technical setup, we did see some interesting price action in the wake of Broadcom and Oracle. Several of these similar companies moved in sympathy. Micron, one of them, on the heels of both of their falls after earnings. So what does the setup look like in terms of the technicals?
Yes, it's hard to imagine the missteps by, not even missteps by Broadcom. Earnings were fine. It was just giving back some of these gains perhaps here. But certainly those will be on the minds of traders here. We did not really make significant highs beyond our previous highs near 260. We did make a higher closing high, but that was only the precursor to what has been 5 straight days of declines here. We did stop today around 221 or so, roughly where we had our previous relative low, but actually a little bit lower here as we kind of near the conclusion of this trading day. Beyond that, 193, low point here, so that could be a further area of interest to the downside. If we were to look at our moving averages here, we can see that our weekly and our monthly exponential moving averages here, our 5 and 21-day EMA, those are growing a confluence near 236. The faster 5-day is crossing below the slower 21-day, so an early warning sign of potential trend change, as price also tests our trend line here in white. We do have earnings though, so that is always a big question mark here, a major potential catalyst for change. So take these things that you're seeing here with a grain of salt, such as this RSI breakdown, very common for momentum to slow as we head into earnings. So finally, if we were to look at our volume profile study, we can see that the notable volume node areas, one is right here, you're about 230 or so, 240, that's a standout point from where we are right now, but also to the downside, this area here, near about 190 is the next point of interest.
All right, and so I mentioned Rosenblatt off the top here before we got into taking a look at the charts. Have we seen any other analyst action in Micron ahead of their report?
300 seems to be the magic number here because that was the price target. Increases from Needham, Wedbush, Stiefel, and Susquehanna. Deutsche Bank was the odd man out 280 price target, but still a substantial boost from 200. These were large price target increases, many of them from the low 200s up to 300 here. All of them kept their buy ratings as well.
All right, and right now you're trading at 226.49, so pretty considerably below that area. Now, with their earnings event, did we see an uptick in the options activity on Micron today?
Yes, so what we have here, December 19th is our options expiration that will capture earnings here. That's our orange box right here, about a 9.1 potential move expected here. This series was by far our most active option series in terms of both volume and open interest here. Today was about 58% of the total volume for the December 19th contract here. That's almost 28% of the total open interest as well here. So the big strikes to look out for on the call side, 250, 300, 280. Meanwhile, on the put side, 195, 215, and 230.
All right, so that's it for Options Corner today with Micron. We'll, of course, have their earnings coming out in about 15 minutes here. We'll have those live as soon as the market closes today. But I do want to check in with Sam in New York and see who we'll be talking about for overlooked stocks today.
Thanks, Molly. Well, George Tillis has his eye on Jabal today heading into the close. He'll break down the news on that company and what you need to know about the stock coming up next on Market on Close.
How's it going? First day, so. Sometimes, you know. Next. Try again. You could have done better. Please. Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl?
Schwab, a modern approach to wealth management.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Welcome back to Market on Phones. I'm Sam Barnes on the floor of the New York Stock Exchange. It's time now for overlooked stocks. Those shares of Jabil are on the rise after a strong earnings report this morning. So I'm joined by George Siller, Senior Markets Correspondent, to help us get across this one. So we got some earnings today, and that is at least helping the stock outperform what is otherwise a down market. Talk us through the report and the reaction we're seeing today.
Yeah, actually, quite good considering the market drain that we're seeing across the board, especially the technology stack. But Jabil, certainly an overlooked stock. It's an interesting company with a very well diversified end user market base. They are essentially one of the leaders globally. It's a Singapore company that is in the electronic design and manufacturing space. So they essentially have diversified end markets for printed circuit boards and design for industry across multiple sectors. Manufacturing, they also have an automotive business, but they're also moving pretty aggressively in intelligent infrastructure. That includes cloud and networking, of course, capital equipment space, as well as data centers. And this has been a huge catalyst for the business. They actually have a mobility business that they spun off back in 2023. But even since that spin-off, top-line sales have been gradually increasing for the business. And this year, the stock is higher by about 60% on a gradual basis, considering their evolution, like I said, into the intelligent infrastructure space. But nonetheless, if you look at the report, it was actually quite good. The EPS came in around $2.85. That was higher by 42% compared to last year at $2 a share. Revenue also came in ahead of estimates at 19%. So again, you're seeing basically 2 times EPS, the sales growth for the quarter at $8.31 billion versus $7 billion last year. But also the guidance. So they slightly increased the midpoint guidance for next quarter's run rate. It looks like the EPS moved by about a dime to 247 versus 237, as well as, of course, top-line sales estimates rising by a hefty amount to 7.75 billion versus 7.5. They also increased guidance for the full fiscal year as well, and they are seeing some meaningful improvement in, like I said, their intelligent infrastructure segments, cloud data, enterprise networking. But at the same time, they're trying to divest away from Apple, because going back to 2018, Jabil was really an Apple-centric company with almost 30% of their sales. As reported, recent quarter, it's around 18%. Now, that's not necessarily a bad thing, considering Apple is one of the largest, if not the largest, consumer electronics company. But nonetheless, they're tied together quite promisingly wise, considering the relationships are longstanding.
I saw ahead of this earnings report that BFA was out with a price target boost, 262 from 255.
Knifey poo.
And they were sort of talking about, if the beat and raise were
right at 10 till
expectations, it would still present an opportunity, as far as a buying opportunity there. Looking across what the analyst consensus is here, you've got the majority of the cohort in a buy camp. 5 with a strong buy here, 2 in a hold, and 9 in the underperforming sell camp. So what's behind the conviction? What are analysts actually saying about this one?
Well, I think if you consider the business in terms of growth, the company itself is not growing. They had a really good quarter, but estimates for growth right now going forward are actually in the mid-single digits, both in sales and earnings. If you look at even margins for Jabil, I was pretty surprised at gross margins for this business, because it's a very capital-intensive manufacturing printed circuit board business, are quite low margins. So they're about 8.5% on gross margins, and net income margins are around 3%. So the point is I think that if you look at the variance between the midpoint target and the high target, it's around $20, which is reflected around 7 or 8%. Typically, if you see these high growth names, we're talking sales in the 30% range, or even earnings at around the 70% range. Just to give you some context, you see the variance between the high and the low, and even the midpoint, quite wide. So essentially, Jabil seems to be growing at a reasonable price, but it's just not a huge growth story for Jabil. It's more of a larger end market, large customer base, diversified end market business, and I think that's why it's trading the way it's trading. It's really been in a trading range in the last 3 months, not moving too much higher or lower, even though it's moving higher today based on some solid earnings. But it is, again, like I said, a well-diversified end market programmer, if you will. for manufacturing circuit boards, widely used across the board, even globally.
Hey, look, up at 1.6%. We'll take it in a down market, particularly with this pullback we're seeing in technology with all these AI jitters. George, thanks so much for getting us across that name for us today in the earnings report. George Hillis joining us there. I'll send things back over to Molly in Chicago for now.
Thanks so much, Sam and George. We're nearing the end of the market section. We'll be bringing Kevin Green in to break down the levels he's watching on the S&P 500. Plus, we'll have earnings from Micron after the bell. Market on close. We'll be right back.
Oh, no.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots.
There goes that.
Live. Subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smart with Schwab.
Morning Movers brings the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready.
Wow.
8 a.m. Eastern, Morning Movers, only on Schwab Network.
They gave that a body slam.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
We're back here on Market on Close. I'm Sam Vardas on the floor of the New York Stock Exchange alongside Marley Caden in our Chicago headquarters. So just a few minutes left to go now. Let's welcome in KG, Senior Markets Correspondent, to help close out the session. So we've got 4 minutes and 50 seconds there. KG, I'm just wondering what you're looking at as we head towards the closing bell here. Obviously, we have seen things losing a lot of altitude here, particularly when you look at technology and that breaking down today.
Yeah, we've been trying to actually hold this 67.30-ish area here. We've been consolidating there for a considerable amount of time, but that market on close order that we just got 10 minutes before the close was aggressively to the sell side here, and you are starting to see the market fail a little bit more. Now we're trading at around 67.20. So we've been able to break some of these key levels of support in the market going into the close. Not really a good sign if you are a bull. Closing on the lows is not always that great here, but once again, we continue to see this rotation trade in the market. I mean, the technology stocks obviously weighing to the downside here. NVIDIA moving to the downside, breaking, you're getting close to that 170 level. That really does not help the market, but the rotation trade is still into effect here, as you are seeing value stocks as well as dividend stocks still carrying the lead. And in fact, if you kind of look at kind of going into the close, we have this consolidation, this breakdown to the downside here, and maybe tomorrow we can actually readjust. We do have the inflationary numbers coming out. If you look at a lot of platforms, you're not really seeing a lot of estimates out there, but the Cleveland Fed does have their now forecast out there, the inflation forecast that's out there, and they're expecting a year-over-year print for headline at 3%. So basically, both of the numbers staying in line. Now, I think the key thing there is that going to be enough to kind of rally this market back and to kind of give maybe some optimism that cuts could actually still be priced in for next year, at least more than one cut being priced in for next year. I think that's going to be the case. And then we have Micron earnings after the close, which obviously probably will have a little bit of an impact on the semiconductor trade. I'm not sure if it's going to really move the overall needle, but it may have an impact on certain industries within the semiconductor trade.
All right, and KG, I saw you have a Bitcoin chart for us today, and we'd love to talk about Bitcoin. We're down to 85,000. We had 85,000 handle on the front here for the price. Just can't seem to get it back up near that 90,000, that psychologically round number.
Yeah, well, Marley, if I'm bringing a Bitcoin chart, it means something has to be going on, because I usually don't follow it that much. But technically speaking, you are seeing a situation where the market is pulling back. We have a 3-year weekly chart here. And even if you look at the daily, we had 3 waves to the downside, and I'm a big believer of that Elliott wave theory. So we did try to have a little bit of a counter trend rally coming back, testing key areas of support, but it's still holding the primary trend. Now, it can continue to move lower, obviously, if volatility and lack of liquidity in the market is kind of creating the environment to sell some of these risk-on type of assets here. But this might be one of those assets that actually does rally very aggressively if the economic data tomorrow does actually align with the bulls. And I think that probably will be your first indicator. Also, just note, overnight, when you're kind of looking at some of this price action, even the S&P 500 caught a bid last night. When you're looking at cryptocurrencies, they caught a bid last night, and you're seeing a lot of the selling happening in the U.S. session here. So look at the overnight price action. Maybe some buyers really do try to step in, and I think if it does break this level and move to the downside, let's say it's 80,000 or so, you get a little bit more concerned that we do see more pullback in the broader equity market. But once again, coming back, retesting a key area of support, maybe we actually get some buyers to really step in. I think that would be conducive also for equities to at least move higher in the near term.
Speaking of that, it does very much look like the market can't shake the AI jitters right now, KG. And I mean, we did have a bit of an attempt for a recovery yesterday. We saw some sort of late in the session type buying for technology. We saw a nice little rebound. But I mean, is there anything that sort of stands out to you around the technicals that sort of gets us out of this rut right now?
Well, you know, 2 things. I have an S&P 500 chart within there as well as 6-month daily chart. Here's the first thing. You had the announcement with Amazon. The stock was moving up around 1.5% earlier this morning. Now the stock's down about 0.5%. These news items are really not holding for the technology trade, and what you would like to see actually is probably a calming down of...
Is there a bubble? That's the question. That is the question. Don't get scared. Oh shit. Jimmy had a red day today. I'm going to go and pay my taxes, and I'll be back.